speak to them because...
Yeah, we've had some good variety of opinions.
Yeah, and people are trying to invest to pay for retirements and kids' educations. That's
financial freedom.
Right. That's a noble pursuit, and I thank you for adding to the discourse.
Thank you, Scott. A good writer and speaker. I'm not going to do my Scott Nations impression, even though I do a bang-on one. The last
I want
point
to
is,
see that. I didn't know that.
It's gone out before. The last to that point, I think this is like the nobility of asymmetry. You know, you said noble, the pursuit, the nobility of asymmetry.
Take advantage of it.
Yeah.
Take advantage of it if you can, because again, if you're trying to pay for a retirement or kids' education, grandkids' education, take advantage of all the tools in your toolbox.
Scott Nations, appreciate it very much. Thanks, sir.
Thanks, man.
Founder of Nations Indexes. Thank you for watching Gamma On, our limited series, all 10 episodes. Appreciate you coming along for the ride. You can rewatch, re-listen on Spotify and YouTube. Remember to subscribe for even more Schwab Network content. I'm Oliver Rennick. Thanks for tuning in.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Schwab.
Have a choice in how you invest with Schwab.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Good morning and welcome to Morning Movers. I'm Diane Kinghall, live from the floor of the New York Stock Exchange. It is Wednesday, January 29th. Guess what? We're halfway there. Let's get started with what's on the move this morning. All eyes on the Fed today. The Federal Reserve set to reveal its latest decision on interest rates. Rates are expected to remain unchanged in the range of 4.25% to 4.5%. But investors will try to read the tea leaves on the direction of rates for the balance of the year at Fed Chair Jerome Powell's press conference. On the earnings front, Starbucks is in focus today after releasing its latest quarterly results. The Java Giant beat earnings expectations, logging a profit of 69 cents a share. But same-store sales fell for the fourth quarter in a row. Later today, Big Tech takes center stage. We'll hear results from more than a third of the Mag 7. The street is gearing up to hear numbers from Tesla, Meta, and Microsoft. As a group, the Mag 7 is expected to report earnings growth of more than 20%. But let's widen out and take a big picture check on where futures are set to start today. We're seeing a little bit of mixed market action. You can kind of expect to see that ahead of a Fed decision today because investors will be looking for that, and especially the commentary after the decision to just try to assess where things are going. So you're looking at S&P minis pretty flat right now, just below the flat line. Big Tech is still trying to gain some more ground. You're looking at NASDAQ futures up a little more than 0.25% as tech bulls try to claw back more territory after that big rout that we had that was fueled by the news about DeepSeek at the beginning of this week. Dow futures off a little bit this morning, pretty flat, matching the movement we're seeing in the S&Ps. Russell, small caps look like they may be catching a bid, up a little more than 0.1% when we look at futures action. But let's dive into some earnings. For that, I want to welcome in Jenny Horn, markets correspondent, to get a closer look at Starbucks. All right, Starbucks out with its latest quarterly numbers. Investors, analysts were looking to hear not just about the results, but what's next. Take us through some of the numbers and then some of your takeaways from their earnings, Jenny.
I know, and I know, Dan, that you mentioned the fact that we saw, a pretty substantial now negative comps as far as year over year, which is now the fourth straight quarter. So I think concerning, but also they did see some financials that were at least better than expected. For example, same-store sales was the big decline for the fourth straight quarter, but they did highlight the fact that earnings actually did top expectations for the quarter as well as revenue, but again, I think much of the weakness that we're seeing this morning has to do with the now fourth consecutive quarter of losses. But CEO Brian Niccol said they're turning around the business and they're going back to their original Starbucks strategy. They did highlight they have room for improvement, but they're making progress as planned, and they have confidence they're on the right track. He did add the company has seen a positive response already to the early steps it has taken. Those tweaks included removing extra charges for non-dairy milk options, focusing its marketing on coffee, and slashing about 30% of its food and beverage menu items by the end of this fiscal year. So again, I mentioned earnings that beat. They topped expectations by about 2 cents a share. So revenue did also slightly beat expectations at $9.4 billion. And again, Starbucks has been cutting back on its deals. So its discount and transactions fell 40% during the quarter, which is substantial, which they did credit a lot of these pullbacks and discounts for their overall improvement for their chain's sales during the quarter. So while it's not great news for us as consumers, Diane, it's definitely good news for, I would say, the overall improvement plan and now the company that is under new leadership, frankly. Niccol's also been making more and more trips to China. They did actually highlight that same-store sales in China, which is their second largest market, fell 6%, fueled by a 4% decline in average ticket. So they've been leaning into international growth, but as we know, it seems like reliability within other regions, especially within China as of late, is not necessarily there. So bit of a mixed picture. There's definitely still, though, improvement that can be seen. It's definitely still something to like here for Starbucks. It's been a long time coming, it feels like.
It does. And I mean, we know that it's on this kind of recovery road to finding its identity. And so Brian Niccol trying to go back to the roots of the company. And one of the things I liked is they brought back all the, things that you can do at the coffee bar yourself, so you don't have to ask the barista for everything. Can I have a stirrer or, this or that? So I think, one of the ideas was that with that is it creates more efficiency and reduces the amount of time that a barista is going to have to deal with you and move on to actually doing the next order. I also noticed he, poached some executives from Taco Bell, which we know that's, he has some history there. So not surprised to see some of the shakeup in the executive ranks. Any other takeaways from their numbers, Jenny?
Well, if you can recall, and first of all, I do really love the fact they've brought back some of the condiments. I agree. I hate bothering people. So I bring it back to the consumer. I don't want to bother the baristas. They have like a million orders to fulfill. So I agree. But in October, the company did slash its forecast now for fiscal 2025. They were really also backing away on this earnings call from that target of saving $4 billion in supply chain cost efficiencies by 2028. So they didn't really say much on that. But that was a number that had been actually really unveiled by Nichols' predecessor. So that wasn't necessarily a target of his, is my understanding. But I do think that they're trying to get more and more away from like cost saving. I think they're trying to operate as efficiently as possible. That might not amount to $4 billion in supply chain efficiency. So notably, they did back away from that. But that was part of the reason we saw them suspend their forecast, which, as it turns out, these results were not maybe as bad as feared.
Yeah, and I mean, I think the idea here, especially when you see, kind of the impact or the movement in the share price this year, basically for investors, this is a bet on Brian Niccol, which he has done turnarounds before. And so this will probably be a timing thing and how much, what an investor's time window is when it comes to Starbucks. Thanks a ton, Jenny Horn, co-host of Next Gen and markets correspondent on the Schwab Network. Thanks for breaking down those numbers for Starbucks. All right, Kevin Green, senior markets correspondent, joining me now to help set up some of the other action and things that we're watching today. Fed is a big focus today, KG. I know the expectation is we're not expected to see movement on rates, but what should we be prepared for?
I would say it's going to be the commentary coming from Chairman Powell. Obviously, kind of looking at their forecasting metrics and if they are able to try to put some numbers to work when it comes to the fiscal policy from the new administration. I think that's going to be a key area. I think something that also goes underlooked when Powell speaks, usually during the Q&A, is he'll actually mention the Fed's PCE expectations or their model. And so that'll actually give us some better clarity as to what they're looking for on Friday. But overall, once again, I think it's going to be about the fiscal policy. And I don't believe that he's going to be as dovish as Waller. I don't think he's going to be hawkish at all, but I don't think he's going to be as dovish as Waller. And I'm curious to see how the Treasury market or the yield market's actually going to react to that. I mean, last time we did see a pretty significant drop after his press conference here. I'm not sure if he's going to go 2 for 2 on a massive move to the downside. Usually that's not the case, and usually the market's up understands exactly where he's coming from here. But once again, I think it's just going to be around the fiscal policy. I think that'll be the big fireworks for today. And then also if President Trump has any type of commentary, negative or positive, when it comes to Chairman Powell and his delivery.
Yeah, it's so funny that you mentioned Waller, because I literally was going to ask you about that. I mean, I wasn't expecting him to be as dovish in terms of the presser, because, he tends to me, strike the balance and speaks a more measured way. One of the things I think that sometimes some people that we talked to have questions about was, if this is a pause, as we're expecting, is this a prudent pause? How do you think the market is reading it, KG?
Well, I think the market obviously really does want rate cuts, but at the end of the day, the data is not really supporting that. And so until the data actually does support that, either with inflation coming down and or the labor market actually cooling off, I think the Fed has to actually kind of stay where it's at right now. It's not the risk of cutting too early is that inflation remains sticky or reaccelerates to the upside, and then you have something that looks like the late 1970s, early 80s, right? X the oil embargo. So I think that's going to be the biggest risk, and I think the Fed actually does understand that. I think the market once again just wants to see rate cuts, and rightfully so. Cheaper capital kind of spurs economic growth, and so that's a spigot that the market really wants to see. But I don't think the Fed has the data right now, and what's actually very interesting is that CPI print, everybody was kind of cheerleading it, but it was still very hot. It just was lower than the street's expectations, but it is showing a small reacceleration when you're looking at CPI. PCE might be a little bit different, but I think Powell also might comment on that and say, look, the trend in inflation is not going in the direction of the Fed. And if he kind of doubles down on that message, I think that's where it gets a little bit bearish in the market.
All right, and I know we've got some earnings to chew on today. We've got some coming after the close today, but before that, we got ASML, and that looked good, especially when you think about what we saw with regard to the hit that tech stocks took this week, especially in the semis. So what are some of the numbers that came out from ASML, KG?
Yeah, a very low bar when it came to the earnings for ASML, and then also maybe some of the commentary also provided a little bit of comfort for the stock here. But we did see actually net bookings grow 169% on a quarter-over-quarter basis. Now that completely knocked it out of the park when it came to the analyst expectations, and you are seeing both a beat on the top and bottom line. Now we did see an initial spike in the shares of around 11% before kind of pulling back. Now it's up around 5% here, but they did provide stronger than expected guidance when it comes to not only fiscal year 2025, but also Q1 2025. They did make mention that DeepSeek actually could be very bullish when it comes to demand for chips for them, and they believe that that's going to be a positive. On the other side of that, they did mention also, though, that China sales most likely, or the proportion of revenue coming from China most likely will decelerate over the next couple of quarters just because of some of the issues that we are seeing with sanctions and things of that nature. So they're expecting a little bit more of a normalization. That might have been the only thing that was slightly negative for the company when it came to their conference call. But overall, it was a really good report. Once again, very low bar, trying to break out to the upside here today. Let's see if it's going to be able to hold its gains.
And then I want to hear some of your thoughts about some of the Mag 7 that we're going to hear from today. We've got Tesla, Microsoft, Meta. I know Meta recently revealed those plans of spending between 60 to 65 billion on AI infrastructure. What are you expecting to hear on the earnings front, KG?
Well, obviously, the conference call is going to probably take a little bit of a different turn because of the DeepSeek news, and I'm sure a lot of analysts are going to ask about it. I think it's too early to call when it comes to any type of adjustments for CapEx spend, especially for this year, and maybe even for 2026. So I would kind of suspect that we might continue to hear an affirmation of what their current guidance is going to be, and then also maybe a tone that they may make adjustments if they do see fit. Make sure that they're deploying capital in the most efficient manner for the company. And I think that's exactly what we're going to hear. I don't think you're going to hear any type of adjustments, massive adjustments when it comes to CapEx spend, which is kind of what the market was pricing in to start off. And then also kind of looking at their current quarter and if they are seeing demand for the AI products that they have available right now. I think Microsoft's going to be a very big key component of that. Their Azure platform is expected to actually see a really nice, healthy gain when it comes to usage, and I believe the estimates right now sitting at around 31% on a year-over-year basis when it comes to growth for just the Azure product offering alone, and the market's expecting around a 12% increase. Around a 12% increase because of the AI product offerings within the Azure suite to really drive that. So I don't expect any type of major fireworks to the downside when it comes to CapEx spend. I think it's going to be all about consumer demand and how they see their business moving forward.
Yeah, that makes sense. And I can't see them moving too much away from, this DeepSeek was surprising information, but I imagine they will have their feet held to the fire on the conference calls, the earnings calls. Kevin Green, Senior Markets Correspondent, thanks a ton for both the setup for today and what to expect after the close. Coming up, time for our chart of the day. That is going to be Meta. We've heard the fundamental case for earnings, but what does the chart say? We'll dive into that next on Morning Movers.
Every morning, our analysis is your blueprint for the day. Bonds, stocks across all asset classes on Morning Trade Live on the Schwab Network. Weekdays at 9 a.m. Eastern.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
A fresh take on the hottest trends in the market, from every click to every tick.
There's no fear of missing out on next-gen investing. 1 p.m. Eastern, only on the Schwab Network.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
We're back on Morning Movers. Shares of Meta Platforms hit an all-time high yesterday ahead of its earnings report later this afternoon. Now today, KeyBank is boosting its price target. Before the quarterly results, it's boosting the price target to $750 a share from $700. It is keeping an overweight rating on the stock. Meta stands as the clear beneficiary in KeyBank's sector as cost efficiencies and longer useful lives and app developing and user acquisition cycle and more gradual CapEx ramps creates an upward bias. This is its view to its 2026 estimates for revenue, EPS, and free cash flow. And time now for our chart of the day. Joining us for that is Rachel Deschelle, contributor, Schwab Network. All right, Rachel, let's talk about this chart for Meta, and we'll talk about the trends, especially, I guess, recent trends that you're seeing on the chart. Can you take us through some of that?
Yeah, of course, Diane. Thank you for having me on today. This is going to be a fun one to actually look at today. So I know that just looking at the short term with Meta, we've seen over the past year just it making higher highs and higher lows all year. So we've seen that this has been a clear uptrend, definition of an uptrend. And even just looking at just the last couple days of trading action, especially on Monday, we saw a bullish large engulfing candlestick where we saw the body of that candle or the distance between the high, the open and the close completely engulf the price action of the 2 previous days of the body of those candles as well. So typically we see that type of movement or that type of power, those engulfing candlesticks at market bottoms, which is interesting because we're actually right now at making all-time highs. So in the short term, we're seeing that there's a lot of demand. There's been a bullish push there. But I would say in the short term, the support levels that I'm looking at are definitely between that range of 652 to 659.
And it's interesting to see that, especially that note you mentioned about the patterns that you saw Monday and how it performed, especially when you compared it to not so much broader market action, but in terms of peers in the tech sector. But for Meta, what about when you widen out? You talked about the short-term picture, but what about when you widen out and get a longer-term view on the chart?
Great question. So that's one of my favorite things to do is actually just zoom out and look at trend on various time frames, because I think a lot of traders know at this point the strongest trends and the best risk to reward setups have an alignment across those time frames. So when you're looking at your process, it's very helpful to just look at this trend on various time frames. So here I see an alignment across various time frames, looking at that 1 year, 1 day, compared to now looking at the 5-year weekly. And I just wanted to call out a couple points too. So I changed this scale of the chart to a logarithmic scale rather than an arithmetic scale. And the main difference between that is just the log scale is better for those time frames that are a year or longer, just because it represents that data on those percentage changes rather than just absolute values. So that's why, Diane, you'll notice that the scale on the right-hand side of the chart looks a little bit different than an even price scale. But another thing that I wanted to mention too, when looking at that longer term trend, was I marked out that Fibonacci retracement drawing.
Okay.
And that's typically a tool that a lot of traders will use to identify those price levels in the market where the market may pause or reverse before continuing that trend. So I drew those levels from the 2021, late 2021 prior cycle highs to the bear market lows of 2022, which really shows the depth of that basing pattern that we saw, which is about $300. So just kind of projecting those Fibonacci's into the future, it looks like we're right below that longer term resistance, right around, I would say, 688 or so. So that's where in the shorter term, we may find a little bit of resistance where traders could be taking a little bit of profits.
All right, that's a broader chart that we're looking at for Meta right now in the setup for earnings. It reports after the bell today. Rachel Giselle, thank you so much for taking us through the charts on both the short-term and longer-term basis. Coming up, time to talk to Fed ahead of the decision on rates later this afternoon. We'll discuss what we can expect to hear from Fed Chair Jerome Powell and more. That's next on Morning Movers.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Every morning, our analysis is your blueprint for the day. Bonds, stocks, across all asset classes on Morning Trade Live on the Schwab Network. Weekdays at 9 a.m. Eastern.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Shares of F5 rallying this morning after earnings came in above estimates. The cybersecurity firm posted a profit of $3.84 a share on an adjusted basis. Revenue rose 11%. Software revenue jumped 22%. Systems revenue was higher by 18% year over year. On the heels of that, it is boosting its forecast, projecting annual revenue growth of between 6 to 7%. The company CEO said it can simplify the complexity of widespread hybrid multi-cloud adoption in ways competitors cannot, and is well positioned to help businesses implement AI on a large scale. Welcome back to Morning Movers. I'm Diane King Hall here on the floor of the New York Stock Exchange. All eyes on the Fed this afternoon at 2 p.m. Eastern for its policy announcement. Joining us now to discuss what we could expect to hear from Fed Chair Jerome Powell this afternoon is Yelena Shaletyeva, Senior U.S. Economist, the Conference Board. Yelena, thank you so much for joining us today. All right, let's talk about expectations for the Fed. I don't know that anyone is expecting them to move on interest rates. When you look at the CME Fed Watch tool, it's almost 100% probability that they're not. Let's start out with what your expectation is.
The action itself is not the focus. I don't expect any significant changes to the statement either. Maybe a little bit of a change around the labor market given the latest payrolls report. We will probably see some discussion of the Fed ready to be patient to assess, the impact of the new administration policies. And, you know, Powell will probably leave a lot of optionality for them to act in terms of the size of the next move or the timing of the next one.
I feel like in the last meeting of last year that was when the door was open to optionality, especially in the language used during the presser afterwards. Would you agree that that was your assessment then?
Yeah, absolutely. And even if you look at the statement, you know, the current language leaves them a lot of wiggle room for the next move. Even if it's a rate hike, which we don't expect, but that language would allow them to do that.
Is a pause now wise in the context of the latest data we have on the labor market? And, you know, I know we don't have a PCE print until Friday, but the CPI numbers that we got recently.
I think it's less about the data probably because we kind of have a rough idea what PCE will look like. This particular print will probably be in the realm of like consistent with the 2% target if you just look at the monthly data, but you need to see more of this monthly payments to make sure that it's moving towards the 2% target. I think it's more about the policies, the new policies that will affect inflation picture and growth picture as well.
I expect he'll probably get questions at the press conference about that, new policies in particular coming from the White House. I noticed that, you know, when he comments on that, he's pretty measured in how he comments on that. What are you expecting to hear in terms of that and the balancing act that will have to happen? Because there is going to be a balancing act on, you know, the monetary policy front as a result of you know, tariff policy.
So let's talk about tariffs. I think it's very complicated, and the details is what matters. We may get some details this coming weekend as well, right? So the size, the sequence of how these tariffs are put on, I think they will do some tariffs. It's not just the negotiating tactic, it's real, I think. So, but to the extent at which it affects inflation and growth. So we talk a lot about inflation picture. Yes, tariffs are inflationary, but at the same time, you know, how much will it affect growth? If you impose tariffs on Canada and Mexico to the extent that was floated, it will disrupt auto sales, auto industry, supply chains. How disruptive will it be for GDP growth?
Yeah, I think you make a great point about sequencing and how that will matter, because even like when we got, I know you don't talk earnings, but just in the context of this conversation, numbers from GM and what they were modeling in terms of their forecast, and you know, it was better than expected, but a large part of what they, you know, say for instance, their parts are manufactured in Canada, Mexico, and they said when they modeled their numbers, they did not model tariffs. And so I think to your point about sequencing, it is the sequencing that matters. You know, when will these be enacted? Is this going to be February 1st, is what was threatened? And I agree. I don't. It's more of a matter of when. But I want to ask you, I want to go back to your thoughts on the labor market, especially because the labor market has been stronger than expected. If the labor market continues to hold up the way it has, what do you think that does for the path of the Fed for 2025?
So, labor market in broad strokes, I think it's stable. It's not deteriorating. It's really at a full capacity. So we have been trying to catch up after COVID. We were hiring people, a lot of people. Now it's kind of like the glass full kind of picture. You don't need that extra growth in terms of new employees. But at the same time, companies are holding on to the existing labor force just because they, you know, they learned it the hard way. So I think that's what we're going to see going forward. barring like any major disruptions, of course.
And then one more question for you. In terms of you said you don't expect hikes this year. How many rate cuts do you expect to see this year?
So we think the Fed will stay on hold until the second half of the year, just to figure out what's going on with the new policies. But then we do expect 3 cuts in the second half of the year, just simply because the economy is slowing down. It is slowing down naturally from the big oomph in the post-pandemic era. Consumers will step back a little bit, and businesses, it's very uncertain because uncertainty about policies is really affecting business investment. So I think what's going on right now, and we'll get another read on GDP tomorrow, is very strong growth right now could be potentially partially impacted by businesses and consumers stocking
back
up
on spending. And stocking up. Yeah, that's a good point.
Totally. And I think we will see the unwinding of that as the year progresses, and just naturally growth will continue to slow down. So I think the Fed will resume rate cuts to shield the economy from the effects of potentially tough policies. Think about 2019 and what's cut at that time. So if you think about that episode as as some pattern for what could happen, that's a possibility.
I forgot about that. Thank you for reminding me of that. All right, we'll have to leave our conversation there. That is Yelena Shaletyeva of the Conference Board. Thank you so much for joining us today in the setup and the preview of the Fed later today. Coming up, we'll check in with Kevin Hinks. He's over at the SIBO. We'll look at the day ahead and what to expect from today's trading session. Morning Movers will be right back.
Every morning, our analysis is your blueprint for the day. Bonds, stocks across all asset classes on Morning Trade Live on the Schwab Network. Weekdays at 9 a.m. Eastern.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Morning Movers. I'm Diane King Hall, coming to you live from the New York Stock Exchange. Time now for the economy check. For that, I want to go over to Kevin Hinks. He's live from the SIBO in Chicago. All right, Kevin, let's start out with what you're watching in today's session. It looks like in the pre-market, NASDAQ 100 futures indicating that the tech sector will get some more dip buyers.
Yeah, exactly right. You know, number one, there's so much coming out in the afternoon today, Diane, that I expect a lot of dry powder for the morning trade as traders wait to see what's going on with the Fed, what goes on with Jerome Powell, and then Tesla, Meta, Microsoft with earnings out after the bell. This is we're in the middle here of the gauntlet this week. A lot of economic data that we still have coming out Thursday and Friday, and we got mortgage apps this morning. 30-year mortgage still unchanged at 7.02%. That's going to weigh on mortgages. You see it in purchases down 0.4% and in refis down 6.8%. So another drop as, lenders need those 30-year mortgage rates down below 7 and closer to 6. That will, increase demand for overall mortgages. It's just not happening up at this 7% level. Now, there is some breaking news right now. DeepSeek no longer available in the Apple Store and the Google Store in Italy. That's breaking right now. We'll see what that does to NVIDIA and Broadcom and Marvell stocks as this whole DeepSeek day 3 plays out in front of us. But right now, futures just a little bit lower, mortgage apps just a little bit lower, and we wait for a massive amount of news coming out in the afternoon, Diane.
Yeah, it seems like everything, when we think about what's coming this afternoon, is a little bit either on edge or wait and see mode. I'm seeing the dollar move a little bit higher. Yep. What are you paying attention to when it comes to the dollar or other asset classes, Kevin?
My big three that I look at every day: yields, the dollar, and crude oil. I'm watching those three. Why? Crude oil is so vital for inflation. The U.S. dollar that's been stingy back up over 108 is something that we have to pay attention to. And then yields, the most important thing. And what we'll see some movement on or some volatility in today is probably yields as Jerome Powell speaks. Now, I expect Jerome Powell to do his Bill Belichick imitation today and say as little as possible in the press conference. Why? Because normally, Diane, in a Fed meeting where there's no movement, in history, we wouldn't even have a press conference, but he has one. He doesn't have to put out an SEP. That'll come at the next meeting in March. There's no real forecast. So I think Jerome Powell's going to stay on script, try to get out of there as quickly as possible, and just say, we're data dependent, we're waiting. There's almost a zero chance he's going to move on rates. So I don't expect that to happen. But what Jerome Powell says in the press conference, he usually makes headlines whether he wants to or not, Diane.
Yeah, that's a great point, whether he wants to or not. But I also love the analogy with Bill Belichick. I doubt he'll come in with a sweatshirt like Bill Belichick.
Say nothing. Say nothing.
Right, exactly. All right, Kevin Hings, co-host of Fast Market. Thank you, Kevin. Time now for an earnings alert. Let's bring back in Jenny Horn, co-host of Next Gen and markets correspondent, taking a look at T-Mobile after its latest quarterly numbers. Take us through some of the details in its earnings report, Jenny.
So a lot to like here, Diane. I would say that we looked at Starbucks earlier. That's a bit of a mixed picture, but I mean, T-Mobile, a clear leader in its respective space, and today only showing further dominance after climbing about 9% as much as I saw pre-market this morning, after what we saw was a blowout fourth quarter profit, revenue that beat expectations, and strong now net customer additions. The company's profit of around $2.57 a share did easily top forecasts, while total revenue came in around $21.87 billion, also did pretty handily beat the $21.3 billion expected. During the quarter, they did highlight that their net customer adds were around 1.9 million, well ahead of the 1.74 million expected. And also, they were able to give some pretty nice guidance. And their CEO did say that they've seen a monster fourth quarter, really, for T-Mobile, adding that 2025 will be even more exciting. They did issue their best ever start of the year guide. They said they expect to add between 5.5 million to 6 million customers in 2025. Also did say that two of those figures are well above the 5.4 million that the street had been expecting. So as we know, when we look at Verizon, AT&T, all of these names have seen really stellar earnings. And what's been amazing is they've actually been able to outperform even what the street, the market maker move, has been expecting. I mean, we were expecting a pretty modest move in T-Mobile, and up 9% would put it well above what the options market had even been anticipating, Diane.
Yeah, some sleeper hits from all these telecoms, from AT&T, Verizon, now T-Mobile. Certainly something that we clearly need to pay attention to. Jenny Horn, co-host of Next Gen, thanks a ton for breaking those numbers on T-Mobile. Coming up, we'll get you ready for today's big tech earnings with a closer look at Tesla, Meta, and Microsoft. That's next on Morning Movers.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
A fresh take on the hottest trends in the market, from every click to every tick.
There's no fear of missing out on Next Gen Investing. 1 p.m. Eastern, only on the Schwab Network.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Believe me, when it comes to investing, you'll love Carl's way. Take a left here, please.
But there's a...
Carl's way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Welcome back to Morning Movers. I'm Diane King Hall, live on the floor of the New York Stock Exchange. Big tech earnings in focus this afternoon, with more than a third of the Mag 7 on tap to report its results. Joining us now, Melissa Armo, founder and owner of the stock Swoosh. Melissa, I know we've got a lot to unpack here. Why don't we start out with the road ahead for Tesla? We know the expectation is for them to report, for Tesla to report revenue of more than $27 billion, EPS expected to be 75 cents a share. But sometimes it's obviously not about, for any of these companies, a lot of it's about guidance, but also what does the future look like, and that really matters a lot, especially when it comes to Tesla. Is that your point of view for Tesla?
Definitely. And I will say this, the market has been rallying, but Tesla really hasn't been going with the market the last few days. It's kind of been lagging since 2025 started. And remember, we never got to that $500 target in Tesla at the end of 2024. We got close, but we didn't quite get there. Tesla had such an enormous move since the election, November and December, that my expectations for Tesla are that it could move higher, but finally get up over that $500 number. I would be shocked, to be honest with you, if Tesla reacts negative on the earnings tonight. Again, it's best to wait to see exactly what the stock's going to do unless you're already currently in the stock. But I have high expectations of this. They've been moving forward with AI. Musk is into this robots, and it just seems like he's always at the forefront of everything. So expect that he's going to discuss AI and new things that they're going to do in the future. So I really think that what we saw in 2024, the last earnings for Tesla, are the start of something big. The stock had been in a downtrend for quite a while when the market was bullish, and then it finally flipped around, like I said, last earnings and then the last 2 months of 2024. So I think it could have a huge move. Tesla is one of the stocks that I wouldn't be surprised doubles in the next 12 to 24 months, just even from where the price is at today, which is around a little bit under $400 this morning.
Do you think that when you say you wouldn't be surprised to see it double, do you think that's about the deliveries, the amount of vehicles it moves, whether it's its current lineup, the new lower price model, which we don't have a lot of details on, or the robo-taxi service that's supposed to launch later this year, or simply his cozy relationship with the president?
But it all goes together, don't you see? I mean, again, one of the problems with EVs has been the cost and then the lack of charging stations. So I wouldn't be surprised with his relationship with Trump at some point down the road, whether it's this year or next year, that start to implement something where then they will have more charging stations, and then it'll be easier for people, plus the cost having been lowered, to actually use electric vehicles. It's very difficult if you have to charge the car. It takes a long time. There's not that many around. So again, it's not as convenient as you'd like to think. So I think his relationship with Trump, benefits him greatly, to be honest with you.
Okay, and then let's talk a little bit about the other heavy hitters from the Mag 7 that'll be reporting later today. Got Microsoft in focus as well as Meta. Why don't we pick up with Microsoft? Expectation going into that, Street looking for earnings of $3.11 a share, revenue of more than nearly $69 billion. But I wonder if the focus is not even going to be that and its performance to that, but if the Street will be asking questions about how much does this DeepSeek news pose a threat to Microsoft and its positioning within AI. What's your view?
Well, again, 2 days ago, the stock was down absolutely huge when that news came out over the weekend about DeepSeek, and then obviously NVIDIA was down as well. So it's a concern. All of these companies are really in a race to move ahead with AI, but the problem is that they've invested so much money into it. And when DeepSeek came out, obviously they had something where they had invested so much money into it. So it will be interesting to see if they discuss this on the call. But after Microsoft was down huge, it had an enormous rally. And I know we're going to talk about Meta, the same thing too. Meta actually had a bigger rally. There also is talk still about this TikTok. Could one of these companies potentially buy TikTok too? And will that be discussed on any of the earnings calls tonight? I don't think Musk is going to buy TikTok, and even though people were discussing that, it could be maybe Microsoft or Meta. Meta, to me, seems like the more likely pick for that. And that almost got to $700 yesterday. So I don't think of all these companies, which are definitely going to affect the market between now and tomorrow morning, I don't think all of these companies are going to react bullishly. Something might fall on the earnings tonight.
Just to really quickly jump in, I do think Meta does make more sense as a likely fit, but I don't know if they would be the front runner as far as the some of the details that I've seen or commentary that I've seen. But really quickly, what's your expectation for Meta to come up in its earnings call or with regard to its numbers, Melissa?
Well, it's been doing very well. In fact, Meta's been moving ahead of the market. Remember, the market didn't make new highs yesterday. It's been a little bit sluggish, even though it rallied, had that huge gap down the other day. Meta really didn't react that negatively to that news and then flipped completely around. It made brand new all-time highs yesterday. Again, if that continues, it will definitely get over 700 in the earnings. And if it doesn't, it could fall. But I don't think that's a stock that could fall that much. And even if it does fall and gap down on the earnings, it could get bought. And don't forget, we have the Fed meeting today. So it's kind of like a cyclone tonight because we have Fed today. Then we have all of these three earnings, and it's going to be crazy trading between now, tonight, and tomorrow morning.
It's true. There is a lot to move on today, a lot of catalysts for market action today. All right, Melissa Armo, thank you so much for the setup into the big tech earnings we've got today. She's the founder and owner of the Stock Swoosh. Coming up, we've got Options Corner. We'll take a look at Coinbase after an upgrade to the stock. Mizuho boosting its price target as well. Rick Ducat will take a look at the chart. Alex Coffey sets us up with an example trade. That is next on Morning Movers.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Welcome back to Morning Movers. Shares of Coinbase slightly higher this morning after Mizuho upgraded the stock to neutral from underperform. It raised its price target to $290 from $250. The firm says that Bitcoin price and Coinbase shares are highly correlated, and analysis of Bitcoin adoption growth points to further upside in Bitcoin price over the medium term. Mizuho also mentioned the more friendly regulatory environment under President Trump and Bitcoin ETFs that may increase Coinbase competition. Time now for Options Corner. Joining us now to take a deeper look at Coinbase is Rick Ducat, lead market technician, who I also call Duke of Data. All right, Rick, what are you paying attention to, or what trends are you seeing on the chart for Coinbase?
Yeah, so I mean, just we hit some yearly highs recently, 349.75, just kind of trending down from that point here. And if we could advance to our next chart in the control room there, we can see that, you know, Bitcoin and Coinbase are very tightly correlated. So the fortunes of Coinbase seem to kind of depend on Bitcoin really there. So you'll be able to see that this red line here is correlation very high, mostly around the time is near 1, which is almost perfect correlation here. So keep that in mind as we look at this, Diane.
And then when you pay attention to or take a look at some options activity, what kind of options activity did you see in Coinbase yesterday?
Sure. If we could advance to our next chart, the big open interest areas, the biggest one, February 21st, 320 calls. Other ones on the call side are January 31st, the 365 and 310 calls. On the put side, it's all in March 21st, all the big open interest activity. So the 200, 220, and 180 strikes. These are where the put interest is, and up here is the call interest. So if we could go to our next chart, the biggest trade yesterday, it was actually 2 trades. One of them, they were both call verticals. One looked to be a closing trade, one was an opening trade. The closing trade was plus 4,000, January 31st, 322.5, 360 call verticals. It looks like from going back and looking at the volume data, this was indeed a closing trade. It looks like they would have made about $2.1 million, keeping most of that credit received based on the prices that those trades would have taken place at here. But the opening trade looks like it was once again opening a short call vertical, 305, 345. It would need to stay below this break-even line of 309.02 by that February 7th date here. The credit received is about $1.6 million, and this was about 13% of yesterday's trading activity, Diane.
All right, that's some options activity that Rick caught in Coinbase. Rick Ducat, lead market technician. All right, now to take us through the example trade, it's Alex Coffey, co-host of Next Gen Investing. So how would you structure an example trade on Coinbase off the back of this upgrade from Mizuho, Alex?
It's actually the mirror image of the type of trade that Rick was just looking at selling a put vertical below the market. We have earnings slated for the week of Valentine's Day, so I've elected to go to the week prior, which is the February 7th expiration, and look at selling a put vertical below the market, neutral bullish strategy. It is the 270, 265 strikes for that put vertical, $5 wide, looking for at least $1.50 credit. That would give us a max profit of $150, a max loss of $350, and a break even of $268.50. Stay above that short strike. In this case, that's $270 through the expiration date, which is not this Friday, but next. And this can make max profit, as those options would be expected to expire worthless. If it does go through that, again, break even $265 or $268.50. And then max loss is basically going to be anything below $265. You'd expect these options to go through the assignment and exercise process, offsetting for that max loss of $350. Diane, this takes into account sort of the recent pullback in shares and also that upgrade. We got a name that's pretty volatile. It has a correlation to Bitcoin, neutral to bullish strategy.
Given that correlation to Bitcoin, is there anything that could happen that would cause you to adjust or make a different move with regard to this trade or before the expiration?
Yeah, I think so. Oftentimes we talk about these risk-defined trades, Diane, and we talk about sort of the risk being controlled at order entry. Obviously, if your opinion changes and you have an opportunity to take it off for a small loss or break even or small gain, that might be in the cards for some investors. But oftentimes with these, say this trade, you might see Bitcoin or Coinbase rally up. Let's say it goes up substantially for whatever reason, and suddenly this trade was going from $1.50 to like 50 cents. Well, now that kind of changes your risk reward. You'd be risking $4.50 with only a chance to make $50 more. Many traders would think about taking that trade off early for a profit if that was the case. So it just depends on the individual, how much time to expiration, and what your opinion is for that stock.
All right, Alex Coffey, co-host of NextGen, with an example trade for Coinbase. It's got some earnings coming the week of Valentine's Day. We'll see if it gets any love. Thank you for joining us today on Morning Movers. Be sure to download the Schwab Network app. I'm Diane King Hall. Stay with us, though. Morning Trade Live with Oliver Riddick is up next.
Join me, Oliver Rennick, alongside Schwab Network's options experts as we explore the second derivative. Gamma On is a brand new limited series to take your trading skills to the next level. Subscribe to Schwab Network's YouTube channel now.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide. no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Good morning and welcome to Morning Trade Live. I'm Oliver Rennick. It's Wednesday, it's January 29th. We're almost through the first month of 2025, and we've got a busy couple days ahead of us. Some earnings starting to fill in from big tech overnight. We'll talk about those numbers as we prepare for Mr. Jerome Powell and the Fed. What kind of language are we going to get from the Fed chair? What kind of decision? What kind of expectations and commentary we're going to have for 2025. Should be an interesting session as we have been very focused on big tech. We've been very focused on the up and down over the last 2 days, down and up rather, selling on Monday, buying on Tuesday. So now we get the tiebreaker day as stocks largely recovered most of their losses since the end of the session on Monday. So we've had a nice little run and a comeback with some big winners. You've got Meta breaking out. You've got Apple catching steam. You've had a lot of interesting stuff happening. Cloud stocks breaking out yesterday, even after the concerns on Monday that we'd have to share AI demand with China's DeepSeek. It was a good spring back on Tuesday. So right now we're kind of mixed, a little bit of selling in some of the tech stocks after earnings yesterday. We'll talk about Corvo with a fade, Apple supplier. So that might be something to give us some insight into what's coming down the pike with some of the big tech earnings over the next couple days, but that'll revert back to the AI story in a pretty big way. So we've got to balance that with, of course, the macro discussion. Bonds and the dollar have been pretty quiet, but today could be the day for some movement. We've got a little bit of movement in the futures overnight with the dollar firm. Bitcoin rallied and then kind of cooled off a little bit. So you're not getting a lot of particularly strong insight on what the market thinks is going to happen here. And if you look at the last kind of couple of weeks in bonds and the dollar, it's been calming down a good bit as well. So we do have to, of course, get ready for the Fed. Danielle DiMartino Booth's going to help us do that as we prepare for Jerome Powell later this afternoon. And earnings and trading. That's what we're doing today. It's going to be a busy session. It's going to be a busy show. Let's look at a couple charts here. The overnight movement in the dollar is, again, pretty interesting. Greenback just seems to be a good thing to hold when you go to bed. Buy some dollar futures, set a stop, and it's been a pretty darn good trade. The overnight default has generally been supportive for the greenback, even with yields near the lows of the last 5 days. 10-year futures down here in the white, dollar up here in the blue. A lot of times these are moving quite close to each other, so I would look for maybe a little bond fade or some dollar fade, depending on what happens today, but that's probably going to be a question for 1 p.m. Central Time. Either way, though, this is what you're probably going to want to be focused on, at least in and around the Fed. If you don't get any big movements in dollar and bonds, then we go right back into the tech story, which is, I think, likely going to be still the dominating force, as there's not a ton of uncertainty around the Fed right now. Perhaps there was some injected with the very dovish comments we heard a few weeks back from Christopher Waller. Will Powell be able to deliver that type of very reassuring multi-cut language? Probably not, but there isn't a lot of big expectations built in for the very short term. If you zoom out on the chart of both these assets for the 10-year and the dollar, I think you'll find that the technicals suggest some fairly cozy levels up here. You had this big move throughout the Fed's cutting regime since September last year. Here's where you see the correlation, the 10-year and the dollar show up pretty clear. On the longer term, the two don't depart from one another too much. So there obviously is a very macro backdrop to the dollar's rise. That's not just tariffs. It's the same message that's being sent through bonds and yields and the better than expected economic data we've been getting. So many calling for a recession. It hasn't happened. Instead, we've continued to see firmness in the labor market, and now the Fed may be unable to cut as much as folks wanted. That's kind of where you're getting into some of the tension, given that we heard Waller suggesting we could be cutting as early as the spring. Who knows what's on the table here for Powell? But the chart has a lot of volume that's been basically trading for both these right around where they are right now. For the 10-year, we've had a lot of volume around 4.6%. And for the dollar, we've had a lot happening here and a good bit of chop right around 108. So it seems like both kind of supported at the moment, given a little pullback from the highs, still within this trend upward. But you'd have to have something really notable to kind of break the chart. Because if we bounce back, then you're still in this trend higher, which has been okay generally for the stock market. And if we break down, for the most part, that's well received, unless it's for the wrong reasons. But if it breaks down the dollar and yields on Powell, then that probably means he's being accommodative. So watch these today, but also, of course, watch just the futures in the S&P and the tech trade, hoping for bounce back in the semiconductors, but that might be a bit of an uphill battle today. We'll talk about the Corvo numbers in a second. Here's the up and down for the S&P futures, which, keep in mind, did not put in the all-time high. The index did, but the futures still trading below from where they were about 30 days ago. So that's our setup. Let's go to the SIBO. Mr. Kevin Hanks, host of Fast Market, standing by, getting warmed up here this morning. Kev, are we going to have a big day? Is it going to be Powell or is it going to be tech?
Well, I think if you're Jerome Powell, you're trying to get out of this announcement and press conference saying as little as possible. Frankly, you're trying not to make headlines. You're going to try to do your, like I told Diane King Hall, you're going to do your Bill Belichick imitation. You're going to say as little as possible and get this done with. Normally, historically, there wouldn't even be a press conference after a meeting like this. But in the new evolution of the Fed, he's going to have to get up there and answer questions. And he won't want to make headlines, but he probably will, Oliver, in some way. And so if you're looking to the end of the day and earnings in Tesla, Meta, and Microsoft, hold on a minute. You got Jerome Powell to deal with at 2:30 Eastern time first. Now, mortgage apps, a number that we got out this morning with 30-year mortgage unchanged at 7.02%. That's heavy. That weighs on mortgage apps. Purchases down 0.4%. Refinances down 6.8%. So the composite on mortgage apps down 2%, Oliver. That's not the big news today, as it's pretty much expected. They need the housing sector needs rates lower. Now, Jerome Powell, what he's going to say around 2:30, like I said, is probably as little as possible, and then all attention goes to the end of the day where the gauntlet of large cap tech continues with 3 massive earnings reports, all having to do with AI, all having to do with CapEx spending, and all having to answer questions about what DeepSeek, by the way, breaking news around 7:30, DeepSeek, not on the Apple App Store or the Google App Store in Italy. Take that for what it's worth, but that's the news this morning. You've got NVIDIA a little lower, and you've got Broadcom a little higher to start the day. Besides that, you mentioned the dollar now back above 108. That's slightly problematic for the overall markets. Don't know if it's enough to move the markets just now, Oliver. We are looking to 2:30 and then after the bell.
Yeah. After the bell, going to be busy, to your point, the gauntlet. Yes. Love that, especially with Meta making highs within all of this discussion. That was pretty amazing. And Microsoft, always a company that seems to come to the rescue on earnings right when we need them. Times of uncertainty from COVID and after the last couple of years, Microsoft seems to deliver. So a few reliable names you would think. Tesla, maybe just the volatile one. We had so much that was centered around Trump policy and the last 2 weeks post, coming into the inauguration and out of it. It's almost like we've kind of drifted away from some of that narrative. I know people are looking for tariffs and whatnot, but all this DeepSeek stuff has kind of usurped it. So once you get the Fed in the picture, we start talking policy again.
Yeah, I think 3 big names. The sentiment is different on all of them, right? Meta, the sentiment is really positive. As they think AI, with the money they're spending, is going to go right to the ads and the ad segment and really help them out. Then you've got Tesla. The sentiment is fairly negative on them until they get to that next generation, which is robotaxi. And then there's Microsoft. That's the one that's unknown. What is Satya Nadella going to come out with after their earnings and talk about? Remember, Meta Platforms $65 billion in CapEx spend. Microsoft's $80 billion in CapEx spend. So, CapEx is going to be a big topic as we get to the end of the day today, Oliver. I think there's going to be a lot of discussion on what DeepSeek means. Does that change anything, or does their spending stay as is?
Yeah, well said. Interesting chart for Microsoft. Hey, this morning we got a little data with mortgage apps. Pretty notable negative print there. And housing, I don't think going to love that. That sector's already been under some pressure since late last year.
Yeah, you got a 7 handle on the 30-year mortgage. You need a 6 handle, Oliver. It's really that simple. We need those rates to start working their way lower, and then the housing market can wake up from its little hibernation of late, Oliver. But yeah, a 7 handle that is unchanged from last week, not a good number for mortgage apps.
Okay. Appreciate that, Kevin Hanks. Thanks for the intro there. For the session ahead, let's talk some of the earnings from last night. And let's talk some chip makers. Jenny Horn with me here, hosting Next Gen, looking at ASML, looking at Qorvo. Let's start with Qorvo, the Apple supplier. Gets about half of its revenue from Apple. Was up last night and then came off. So what's with the second thought here?
Yeah, so the second thought is confusing because initially surged as much as 13% last evening, and then saw, better than expected earnings reverse, though, due to these comments, I think perhaps made about sales relating to its largest customer. So I think that the commentary around Apple is what sent the initial spike then slightly lower. They did say that for fiscal 2026, they're still forecasting revenue to our largest customer to be flat to up modestly. That's per their CEO. They did not directly. It's obviously Apple. So I think that is really what drove a lot of you could see perfectly illustrated there. The volatility post-earnings. So I think that what's amazing is the fact that they did say this customer, while they do expect some modest growth, that they are not seeing the same degree of growth from Apple they once did. They are forecasting now for their fiscal 2026 about $3.85 billion. That would be growth of just about 4%. So revenue is slowing. And I think that has not been a necessarily Apple-specific story. That's been Qorvo, but I guess they're one in the same when Apple is 50% of their revenue. Right. So consistent revenue slowing, if not more negative trends as far as forward-looking revenue, that's not exactly what you want to see.
Yeah, it's kind of interesting that the market freaked out on the commentary when that conclusion was pretty clear, I think, from the numbers, because there was contraction in revenues from a year ago. They did beat the expectations. The guidance was, slightly above where some of those expectations were. So it wasn't like a clear, massive blow the doors off number when they delivered it. But I guess maybe the market was kind of already rallying throughout the day maybe, and there was just some lingering bullish sentiment perhaps after the close. Apple's run the last 2 days has been really impressive. So this unwind is a little bit problematic maybe for the strength in Apple the last couple of days, because we were kind of scratching our head going, all right, what was so exciting about Apple these last 2 days that was making it trade as a bastion of safety? So,
or anything to be concerned about? Because, looking at the same ahead of their earnings, we were expecting 5% contraction on revenue. We were already expecting contraction on their bottom line. Yeah. None of this story was exactly double-digit percentage growth for the foreseeable future. That just hasn't been the case for Qorvo. I also think it's important to keep in mind that, yes, roughly 46% of their revenue is Apple. Apple is not obviously 46% Qorvo. It's not necessarily a direct correlation of how Apple will fare. Also, I know that Apple has been very much strategically trying to cut ties with some of these third-party vendors to do a lot in-house. I will wonder if we'll get any update on that. We'll get answers, obviously Thursday, I believe, is when they report. But I do think that this is just one small niche of Apple. It's not going necessarily indicative of the health of the company.
Yeah, they buy the parts, and then whether or not they sell the phones that use them is TBD. Okay, let's talk ASML here, because this one has had a pretty rough go of it the last year. It's sort of been the center of negativity within semiconductors, kind of the old school suppliers and more cyclical, kind of slower moving businesses. I mean, the fact that this got hit the last couple times around, I guess maybe primed this stock for some support possibly?
Yeah, we were in a much different place. I mean, we've seen 2 substantial days of sell-offs in this stock, which is now reset it at a substantially lower range. I actually appreciated, though, on their earnings call, some of the commentary from their CEO that said that perceptions of AI spending are skewed by the massive investments that are being made by these hyperscalers like your Alphabet, your Meta, your Microsoft that are spending, I mean, billions with the most advanced chips. And he went on to say the number of chips related to that is actually pretty small, and did say that right now they actually say the DeepSeek AI product launch, they actually feel it could be a good thing for chip demand. So they were trying to spin this maybe as positively as they could. This did wipe, I mean, billions off their market cap even earlier this week, so it's not like they weren't hit by that. But I thought that was an interesting way of, like, you can't beat them, join them, basically to tag on to the DeepSeek success, where the CEO was like, hey, this is not necessarily a bad thing. There was also a lot to like within the report. I mean, earnings did beat. I think that the fact that he was basically able to come out and say, we're not going to be rivaling DeepSeek, we're going to be joining them in their success, is part of the reason we saw a pretty decent reaction.
Okay. So some bounce finally for ASML.
Needed it.
Yeah, I do feel like Qorvo maybe, I mean, I don't know which one's going to matter more for the whole group necessarily. I do think the clear ties to Apple make Qorvo interesting. The fade there, because last night it looked really encouraging the way that was rallying. I do think that when you've got such a intense, like 35, 40% drop, like 35% coming off something like that from the highs for ASML, that, you know, anything that sounds like it's going to lift their spirits is probably going to be welcomed at this point. So I'm not surprised that they're kind of spinning everything as positive. And overall, you know, needing of chips, whether it's Chinese or U.S. AI.
Well, something I think that for actually both of these companies, because even though this company is based, I believe, in the Netherlands, that it still faces the same issues. Both of these companies are facing some degree of uncertainty regarding the situation with China. Like, forget DeepSeek, forget about even what happened this week. There's still going to be export and import controls put on, I think, both of these companies, what they're expecting, that could be hugely expensive and also hugely dampen some of their demand. So I think that some of the underperformance is more just like tied to that macro situation, less like earnings maybe can move the needle when you have a looming threat of all things China.
Yeah, okay, nice. ASML with a little bounce, Qorvo with a little give back. Thanks, Jenny. Good look at the semiconductor trade this morning. All right, we'll see how they even out. A little battle there for the early reports from tech hardware companies coming back. Let's talk FOMC. Let's talk the Fed and Mr. Jerome Powell. Danielle DiMartino Booth has always got a hot take on the macro. She's coming up next.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device, for free. Schwab Network.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Stock futures a little changed right now. Bond futures also a little changed, a bit into the dollar, but a focus today on the Fed that will compete with our big tech conversation. Joining us for some macro thoughts, Danielle DiMartino Booth, CEO and Chief Strategist for QI Research. Great to have you. Good to see you this morning, Danielle.
Good morning, Oliver. How are you on this Fed day? You're right. There's going to be some competition coming up at 2 p.m. Eastern.
Yeah, what do you think? Powell going to be splashy, or is he going to be calm and quiet?
I think actually that the goal today is for him to do as little to the markets as possible. We've seen quite a nice rally in the bond market. In fact, despite seeing a 75% retracement in tech losses from Monday on Tuesday, you know, the 10-year benchmark yield managed to stay pretty low towards the 450 area. And I think that markets are planning on Jay Powell not being Dirty Harry Jay Powell. They're planning on him being calm and intimating that he's going to be data dependent and that a March rate cut might be on the table.
He's going to be end of Gran Torino, not beginning of Gran Torino. Clint Eastwood, maybe.
Good way to
I wonder who in that conversation Christopher Waller is. I mean, how will his follow-up be to those very dovish comments from 2 weeks ago? Because that was like the last time we heard a major like Fed speech move the market. And it kind of seemed like since then, bonds have been pretty continually bid.
They have indeed, and Waller, as you rightly point out, is considered to be kind of the closest confidant on the Federal Open Market Committee of Jay Powell, and his comments really were followed up by a release by the Cleveland Fed, their new tenant rent index, and Waller spoke specifically to the weakness in using imputed shelter, and that the Fed should rather use more real-time metrics. And then the Cleveland Fed new tenant index went from 1.6 year over year in the fourth quarter to negative 2.4%. So that really is, it was Waller mentioning it. It was Jerome Powell mentioning it at his December 18th press conference. We'll see if he follows up by saying that they're following market metrics that are a little bit more real time, as opposed to kind of imputed arcane owner's equivalent rent that really moves a lot more slowly than where the market is right now for shelter, which is 46% of core PCE. You have to pay attention.
I mean, that really is kind of the debate, it seems still, housing data and how quickly it's going to kind of disinflate as the numbers catch up a bit. That seems to be the pushback I get from folks who say, hey, look, the inflation numbers are misleading, right? A lot of it comes down to housing.
A lot of it does. And, we've seen 500,000 apartment units nationwide come online, come out of the construction pipeline in 2023 and in 2024. There's at least another 500,000 coming out in 2025. And we are indeed seeing, it's just the law of supply and demand. We are seeing rents in real time come down. And I think that that's what's got markets encouraged in terms of future Fed rate cuts, as well as when you get conference board data out like we had yesterday, where you've got the majority of Americans expecting a weakening in the job market. That also will get the Fed's attention. That's certainly going to be a subject of discussion at today's meeting before the statement's released.
We saw mortgage apps this morning looking pretty soft again, which I guess speaks to the point of the need for supply and perhaps some reduction further in prices. In terms of the other data they're looking for, Danielle, for jobs or employment, do you think that, well, I guess I should also say, like, inflation expectations the last couple of readings were fairly sticky too. So if Powell does choose to be a little bit more balanced than Waller, what type of data do you think he balances it with if he says, look, we don't need to cut right now?
Well, you're right to point out inflation expectations, and to see in one survey, University of Michigan or Conference Board, but to see conflicting directions from the perspective of households, where they're saying, well, we expect inflation's going to rise in the future. A lot of that is headline risk that's emanating from the new Trump administration and concerns that we have about tariffs and the fact that households, U.S. consumers, remember the last time that the trade war did end up manifesting in higher goods prices. But that's a real conflict with concerns about losing one's job. And, I always tell people that when it comes to something as important as housing, there is one thing that is more important than mortgage rates, and that's whether or not you anticipate having a paycheck.
Okay. Danielle, what then do you see as the path here most likely for their timing on cuts? Take me through the trajectory that you think we're going to get this year.
So, just using a very simple one-factor regression based on consumers saying jobs are hard to get, that implies that the unemployment rate should be closer to 4.6% compared to the 4.1% that was released most recently. So I think that Powell is going to be very definitive in saying, if we see further weakness in the labor market that validates households' concerns, then they're going to be leaning more on that labor mandate as opposed to the inflation mandate. And again, we're going in with about a 33% chance, you've got it up on the screen right now, of a March rate cut. I could certainly see that moving up to 50% here in the weeks that come if we continue to see, 3-year highs in continuing jobless claims and an increase in the unemployment rate.
The reaction if we get cuts that are in line with what the market's been pricing right now, Danielle, do you think that keeps bond yields from pushing higher? Or if the Fed keeps cutting, do we see the September to December trend where Fed cuts and yields go up, curve steepens?
Well, I do think we are going to continue to see the curve steepening, but I think that it's going to be more a factor of the market pricing in more than 2 rate cuts in 2025. So I think we're going to see the short end of the yield curve, the 2-year Treasury note yield, come down further. But I don't anticipate too much upward pressure on the longer maturity 10-year note, simply because we know from our experience in 2018, 2019, that it takes a good year before we see tariffs show up in higher goods prices.
That's a big element of this for many folks' analysis, trying to figure out tariffs. How directly do you think Powell and team can model that stuff out when so far we've kind of heard mostly rhetoric, like even in the first swing of executive orders in the pen, like tariffs are not there yet?
They're not there yet, and that's true. But Oliver, I really don't believe in coincidence, and I don't think that there was any coincidence in the Fed's Public Affairs Office releasing 2019 FOMC transcripts. They're released with a 5-year lag. They were released just a little while ago, and it basically walked through the episode of the 2018-2019 trade war and how that ended up showing up as negative global trade for the year. I think they're trying to say that by releasing 2019, here's our game plan if Trump really does push forward with tariffs. And of course, we could see this as soon as February the 1st in terms of what's being threatened for Mexico and Canada.
The other element perhaps under discussion here is Fed balance sheet, QT. How much does that move the needle, Danielle? Where does that rank in this conversation in your mind?
Well, I don't, again, think that there's any coincidence in there being a lot more focus these last few days on whether or not the Fed is going to finally start to comment on the balance sheet quantitative tightening, when they're going to stop the roll-off of treasuries from their balance sheet, if they're going to lean harder on mortgage-backed securities roll-offs to make up for low prepayment speeds in recent years. So I think that the media today in the room is going to be very forthright in asking for Powell for more details about what the Fed's plans are. We have seen major Wall Street banks push back their anticipation for the end of quantitative tightening, really from May, June now until September, October.
Okay. All right, love it. Good setup. Anything on your radar economic-wise? Give me the update on kind of your overall economic vision, Danielle. Do you think these efforts from the Fed will stave off worsening in the economy?
Well, I certainly do think that that is the hope. U.S. consumers are still battling with some of the highest interest rates on record, whether you're talking about credit cards or auto loans. So I think that there is definitely relief that is wanted by the U.S. household sector. By the same token, of course, we're going to have a little bit of downside to the fourth quarter GDP report that we're expecting out this tomorrow morning, specifically because the trade deficit did come in so much higher than what was expected, which will detract from GDP math. So it'll be interesting to see whether or not we continue to see cross currents in the data. Of course, we've seen some strong regional Fed manufacturing surveys. Are we going to see an upside in ISM as well? A lot of data coming out between today's meeting and when the Fed meets again on March 18th.
Okay. All right, so we're looking for Powell to try and toe the line, be a little bit more balanced than Waller, but still get us ready for March cuts. Kind of sounds like the plan.
I think that that's what to expect today.
All right, great stuff. Danielle, thanks a lot for being here. Appreciate your time.
Thank you for having me.
Absolutely. Danielle DiMartino Booth, CEO and Chief Strategist for QI Research. Right, nice. There it is. A very full look at all the elements for the FOMC this afternoon. We got time until then, though, and the market has been certainly active in these last 2 days. So will the looming event of Jerome Powell keep a lid on what we can do here, or are we just going to ramp it up and follow through from yesterday's strength? There's the bell that'll lead us to the answer. We've got small moves so far right now at the open, with indexes prepared to shift just basis points from where we closed yesterday. There was some overnight follow through, as you saw there in the NASDAQ, but right now coming into the session, 6 basis points. Bitcoin looking pretty big right now, 1%, and the dollar also up about 30 bips. Those are the notable moves so far. Maybe crude oil down 1%, maybe NVIDIA down 2%. But for the most part, there's not a lot of clarity here direction-wise. Big tech pretty mixed. Apple giving some back. We talked Corvo earlier, the supplier that gets about half its revenue from Apple, did exceed some expectations, but apparently the commentary wasn't confident enough in the outlook, and that chip maker's rally from yesterday afternoon has faded. So that is a fairly notable swing from overnight. But right now at the open, you're getting a pretty good bid into the market sector-wise. You got more up than down, but small moves. 30 bips is the advance for communication services, best performing sector here this morning. Tech down 0.75%. Semiconductors up just 30 bips. So a little bit of a mixed bag, a little bit of a quiet start. Probably going to see a little bit more action though. And we've got a good bit to discuss too as far as earnings, as far as stock stories go, as far as the momentum of the market from yesterday's move. Mr. Kevin Green was pointing out some very interesting chart work for us yesterday, including a bullish hammer and then engulfing candle in NVIDIA yesterday. That stock starting off a little bit slow here at KG, but the market's got a lot ahead of it today. And we did see a bit of a sluggish start yesterday, too, at the open. In fact, we saw some early weakness and selling around the open yesterday before we ripped back. So it seems like we should take some time to settle in here. What's first thing on your list to look at?
Yeah, look, I think if we're looking at the intraday levels here, obviously we got to be mindful of them, but they can obviously break either to the upside or downside fairly quickly, just depending on what Chairman Powell is going to say. Now, typically what we would see going into a Fed meeting is actually a very compressed day, right? A 30-point, 40-point range-bound move either to the upside or downside when you're looking at the absolute move to the upside or downside. And that's what I would actually kind of expect for today. So an inside candle for the most part, and then potentially a breakout to the upside or a breakdown to the downside downside here. I would say that the 61.30 level is kind of that area that I'm looking at as far as for the market to be able to achieve today. If we do get some bullish commentary from Powell, or if the commentary just comes in line with what the street's actually expecting right now. And any type of breakdown in the market, looking at that 50-day moving average is your first area of support. Next one's going to be the 20-day moving average, which also coincides with that downward channel that we had broken out of, but obviously came back and retested. So downside, I actually moved that negative gamma level to 5,900. And what we are seeing a little bit, Oliver, when it comes to positioning is actually a spreading out of these levels. So it's really trying to confirm that the market's really not expecting any type of real compression over the next couple of trading sessions. We are looking for a defined direction either to the upside or downside. And that's kind of being symbolized by those levels moving out. And really it's kind of that downside that it went from 6,000 going down to 5,900 here. Some interesting positioning when you're looking at the downside puts that are being bought today, but I mean, some of them have a 4 handle on them. I don't think that might be the case here, but you are seeing a little bit of hedging activity to the downside for the most part to start off the day, but volatility is still relatively cheap going into this report, not only on the equity front, but also when you're looking at Treasury vol. And so this is kind of just showing the levels today. 61.30, positive area, positive gamma pressure. That's where you're seeing a lot of calls being sold. 60.70 kind of getting, I think that's going to be more of like the fulcrum meandering point, if you will, going up into the meeting. And if we have any type of breakdown, looking at 6,000 as being that first level for buyers to kind of step in.
All right. So we are trying to fully close this gap, but we haven't quite yet from Friday into Monday. So what do they say? Gaps always get filled. Yesterday I described the bounce back as in some way one of those sort of like automatic days where your options are either break down catastrophically, which is just not a frequent occurrence, or you recover and you bounce. So to some degree, bulls kind of had to step in yesterday to prevent like a major drop off, like a VIX 30 type situations. But it also didn't mean that we had to rally as hard back as we did and almost fully close that gap. VIX down, to your point, below 17 again is kind of acting like DeepSeek was a little bug on the windshield.
Maybe a tiny bit. Obviously, when you're looking at the market weighting of a lot of the stocks that were advancing yesterday, that really drove the market higher, even though we only saw around, 30%, 28 to 30% of the stocks actually in the green in the S&P 500. What I will kind of say, though, when you're looking at these gaps being filled, they say it's around 80%, 75, 80% of gaps do get filled eventually. And we already actually kind of back tested and filled 2 of them. If you're looking at the S&P 500, the E-mini S&P futures here. So that's something to be mindful of. What we're kind of seeing here, 20 VIX calls are actually getting a little bit of a bid, relatively cheap. Last time that I checked, I think they're going for only about 85 cents to $1.20 if you're looking at the bid-ask spread. So there's somebody that's buying in a little bit of protection to the upside if we do see a little bit of a vol spike here. But, given the fact that we already had an aggressive sell-off in that last meeting, are we going to see the same type of effect today? That would be actually very surprising to me. Usually you don't see back-to-back 1%, 1.5% sell-offs because of a Fed meeting. So it kind of leans, once again, kind of a little bit more to the bulls, especially that hammer candle that we have on the S&P 500 from yesterday. Looking at the internals for the Mag 7 and the strength and the aggressive buying that we saw yesterday here, I would not be surprised today, Oliver, if we actually do make new all-time highs getting that 61.30 level. I mean, that seems like the trajectory that we're going to right now. That kind of goes counter trend to that vol argument that vol should be a little bit higher. And even though vol should be higher, doesn't mean that the markets automatically go down. But there seems to be already enough positioning here, especially on the Treasury front, when you're looking at Treasury vol being very low. This is probably one of the lower Treasury vols that I've seen going into a Fed meeting, regardless of if we have SCP or not for this meeting. So the market right now is saying, hey, we're bullish. We think that Powell's going to come in line, not really spook the markets. And if that's going to be the case, I think we rip higher. And then after that meeting too, then we focus on the mega cap earnings. And once again, we talked about this yesterday on Market on Close. What's the likelihood that you're going to see any major executive adjust their CapEx spend for this year or even next year when it comes to guidance?
It'd be suicide. That would be
exactly.
Yeah. Okay. So the anchor of big tech in the afternoon, I think also is keeping that vol pinned lower, to your point, because the miss rate of these companies is so low that generally we should assume it's going to be a positive thing. unless otherwise, barring some unforeseen incident. As far as the bond vol goes too, given the conversation with Danielle there, it does kind of seem like we are in a little bit of a kind of lull for like Fed uncertainty, where we've kind of got the idea. Nobody expects them to do anything today. Some people expect them to maybe do something by March, but with so much swinging around right now, policy-wise, market-wise, March seems like a long ways away. So, at least that's kind of my opinion. It's only, a month and a half or whatever, but love the context on the charts and the strength in the charts. Appreciate it, KG. Maybe some seasonality for vol, suggesting VIX should be a little bit higher, but we've got big tech firming up from yesterday. Makes sense. Some markets looking pretty firm. Let's talk about a few of those other names that gave us reports from last night and this morning. Diane King Hall joins us from New York. One big winner in tech this morning, Diane, is F5. Yeah, breaking out. Was already up a ton the last year. Kind of a quiet little mega winner within the data center security, software play. Tell me about it.
Yeah, I mean, to me, this was a sleeper hit. They beat expectations, as you know, on both the top and bottom line, and their forecast looks good for F5. So you are seeing shares move higher. They are off the highs of the session, but obviously we'll continue to see if they recapture that high that they hit earlier in the session. Adjusted EPS was $3.84 a share. Revenue, $766.49 million. Again, both beat expectations. They boosted their fiscal year 2025 guidance. They're now projecting revenue growth of between 6 to 7%. They're projecting growth in terms of profit, EPS growth to come in between 6.5 to 8.5%. The company talked about, the CEO talked about this, just seeing the opportunity in terms of hybrid, multi-cloud, and AI emerge, and they think that they have a competitive advantage. Again, they say that those are the main areas. Analysts, the way they're looking at this is they see, some of the strong leadership there. You are seeing analysts have to reset their price targets off the back of their results, especially you had, several analysts in the neutral camp on this, and they're having to readjust off the back of this.
Okay. If you were neutral on this stock, you have been behind. 159, the low in May, trading 285 right now. Pretty good stuff. To your point, kind of a sleeper hit, leading the S&P 500 this morning. I see HPE moving, which kind of fits with this a little bit. That stock's up this morning as well. But the rally in ASML is also helping chips out. Corvo, little change too, even though it faded. So we've got a pretty decent little start, despite NVIDIA getting hit right now. F5, even if it's a sleeper hit, is still a hit and tells us that there is this kind of second, third wave of AI impact still happening.
Right, and it tells us that there's more meat on the bone. I mean, I think, the market, to your point, it seemed to be rattled at the beginning of the week by the threat of DeepSeek and how much did it mean. And if the numbers were as accurate, I mean, that remains to be seen if they were as accurate as we were led to believe, if it really was that, around 6 million spend on that, and then how much of that was actual chips that they were, legally exported chips. So there are some different factors there that have to be taken into account when we consider how meaningful of a threat DeepSeek is. And then you have analysts pointing out, okay, one, the market was probably oversold off the back of that just that knee-jerk reaction. And then number two, it doesn't mean it's a zero-sum game. In other words, this could give credence to the fact that there is more room for growth within this AI trade. And you're seeing that. And I mean, even when you had some of the analyst commentary or analyst expectations leading into the numbers, there was the expectation of a rampant demand, and you're seeing F5 as a beneficiary of that rampant demand.
All right. Big one. I like the way you put it. Meat on the bone of AI. Speaking of meat on the bone.
I know.
We got another one.
Brinker.
How about veal chop?
Yes.
We got Brinker, ticker EAT. I was goofing around so much yesterday talking about Maggiano's in the lead up to this stock. I'm like looking at it this morning. I'm like, wait, I thought they reported yesterday, but that was just the preview. They're up another 11.5%.
I know. This one is, you're seeing a big move here in Brinker, and they did, I mean, it was led by Chili's in terms of the results, but you even saw growth at Maggiano. Adjusted EPS for Brinker was $2.80 a share. Revenue was $1.36 billion. That beat expectations. In terms of their projections for fiscal year 2025, they're projecting revenue to come in between $5.15 to $5.25 billion. That's higher than what the street has been expecting. They're projecting adjusted EPS of $7.50 to $8. That's also higher than the view on the street. Comps rose, I mean, significantly. I was like, is this accurate? Comps were up more than 27%. The big winner there was Chili's. You saw comps for Chili's up more than 31%. Maggiano's increased by a single digit. Chili's, their growth you saw an increase in traffic. They talked about their investment in advertising. And I remember them talking about they were going to do more of that advertising, to bring more customers in. And it seems to work without affecting their bottom line in any kind of difficult way. And so you're seeing shares jump more than 11%. So a strong quarter for that. And Oliver, it reminds me of, we're starting to hear from, we heard from some analysts that are more constructive this year on the restaurant industry. And so obviously we're seeing this play out in the early innings. You saw Wedbush we talked to earlier this week. Now they are more constructive on QSR, so the quick service restaurants, than, say Brinker. I'd have to check and see if they have a note on Brinker, but it's not just Wedbush who is constructive here on restaurants, and they see solid expectations for the industry and solid growth for it. And then, even think about how the labor market is holding up. That bodes well. And then how inflation is overall improving. That bodes well for the restaurant industry.
Chili's, just a beast, I guess, and people haven't quite figured it out. I guess the cats on Wall Street haven't been eaten with Main Street, because there's 16 holes on this stock. Okay, and there's 22 analysts that cover it. There's a lot of analysts that cover Brinker. I mean, it's a pretty major consumer business. And look at this chart. This is almost as absurd as how they all hate Palantir. It's like hilarious because it couldn't be more different. But there's not a lot of charts that just go straight up basically and to the right, and nobody gets along for the ride. So I think these guys need to head down to their local watering hole and figure out, what's going on, because Wall Street's totally missed this.
They're missing this one. They did 100% miss this one.
Wow.
I mean, even when you widen out to a longer, several years long chart for Brinker, I mean, it's a big miss.
Yeah. My most frequent investing regret, not buying what I love, because I've always loved Chili's and Maggiano's. One time, my family, we were driving through, I forget what state it was, on a road trip, and we asked somebody if there's somewhere to eat around, and they said, there's a Chi-Chi's around the corner, a Chi-Chi's. And we were like, a Chi-Chi's? What are you talking about? Because the L is like the pepper?
Yes.
Yeah,
yes.
So running family joke on Chili's. Hey, tell me about T-Mobile real quick, Diane, because this one was a big winner for a while, but it seems like AT&T's kind of making a comeback.
They are, but T-Mobile did do better than expected, and in a similar kind of story in terms of the subscriber growth. Now, you did know this a little bit coming into it for T-Mobile in terms of what their projections were. So they beat on both top and bottom line. Adjusted EPS $2.57 a share, revenue $21.87 billion. Their guidance was strong as well. This is the best start to the year in terms of guidance for T-Mobile. They're projecting to add between 5.5 to 6 million customers this year. In terms of the last quarter, they added 903,000 phone customers. That beat estimates. And then in terms of internet customers, they added 428,000. That was better than expected as well. And they had, unlike the AT&T and Verizon, they had boosted their forecast for new customers off of their Q3 report. So at the time, they were the only one who had beats in Q3. So that makes sense why they were the winner compared to, say, AT&T and Verizon. But that last quarter of last year was really strong for all of them. And you are seeing shares rise nearly 7% right now.
Wow. All right, nice swing back to the highs from T-Mobile. I thought maybe the big AT&T rally was going to suggest that the legacy names were starting to recover some of their lost ground. But I guess right now the wireless companies are figuring out that consumers are willing to spend, maybe not quite as rigorously checking some of their expenses. So then again, T-Mobile's kind of had that deal perspective for them. So it seems like they still got a nice mousetrap they're using. Thanks, Diane.
All right, you got it.
Good stuff on the Movers. Host of Morning Movers, Diane King Hall, coming up. Let's prepare for earnings. Meta and Microsoft. Two very different charts, with Meta making all-time highs in the midst of the DeepSeek sell-off.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
After Jerome Powell, we've got big tech earnings. Meta, after making all-time highs, is a highlight. Microsoft, another one that always seems to deliver right when you need them to. Joining us, Dave Mazza, CEO at Roundhill Investments, father of the MAGS ETF. What's up, Dave? Good morning.
Morning. Pleasure to be here.
Hey, your MAGS ETF has been a focal point for us again this week in trying to figure out the direction of the market. My guy Kevin Green was telling me yesterday the chart for it looks pretty good right now, despite pulling back a little bit off the highs. What do you think these companies need to deliver to ramp us back up to records?
No, you're right. The MAGS ETF really hasn't slowed down, even with some of the volatility. We've actually saw really strong inflows into the fund on a year-to-date basis. As people are still positioning to what has been the winners, even with some of the talk about rotation. I think heading into earnings tonight, and we got 3 of the MAG 7 coming up with Meta, Microsoft, and Tesla, is really going to be paramount. I think there's different stories for each of the names. As you alluded to in the intro, Meta is a company that, on a fundamental basis, people could say, well, look at the issues with DeepSeek, whether that's true or not, and that stock, probably should be down a bit more. But the price chart on Meta continues to look great, has tons of momentum behind it. I think looking for earnings tonight, we're really going to see what's going on with Llama 4. They've already pre-announced their CapEx, but I do think at this point, and especially with Microsoft, investors we're getting to the point where we need to see clarity on when the ROI of all this investments comes to fruition. And so, especially in the context of what DeepSeek may have potentially done with increasing efficiency.
We're going to talk about these options trades in a moment as we do in this segment. But for the ETF investor, for the more kind of passive investor, I'm curious, Dave, how big are the flows? How big is this product becoming? I mean, you guys really nailed it with this thing, I got to say, because the concentration of the market is such a big story. And if you are in the market, you're getting skewed towards these companies, then it seems like why not just then go for the gold and take these companies out on their own? You're up 57% in the last 52 weeks on this, whereas the NASDAQ, which is like the bastion of tech, is only up 22%. So how are people fitting this into their strategy?
Yeah, no, it's interesting. So you're absolutely right. The Magnificent 7 ETF has really been embraced by investors and traders, especially we see a real increase in volume around earnings events, and we would expect to see that today because you're absolutely right. Because of the concentration in the market, the Magnificent 7 has essentially become the market. And we're seeing a large group of investors, particularly as this fund recently crossed $2 billion in assets under management, just make that trade, to your point, saying, let's remove the tail of exposures. Just give me the names that actually are driving the market higher and potentially outperform. Now, of course, that concentration could come with a risk, but what we've actually seen is on some of the downside, the Magnificent 7 has actually held up better. I mean, just look at it year to date. We have Meta up over 15%. Of course, there's been a bit of a pullback in some of the other names, but that sort of basket, these stocks actually work really well together because Magnificent 7 is is traded back to equal weight every quarter. And so you actually inherently, with that equal weighting and concentration, are benefiting from selling your winners, taking that profits, and then rotating back into the laggards in the Magnificent 7 group.
It does kind of almost feel like you've invented a sort of new way to invest, because there is also just this idea that you should invest with conviction. There's been a lot of studies. I've seen the reports back in my equity reporter days about the concentration studies within portfolios, where once you get beyond like 25 stocks or something, they all just kind of start bouncing off each other. So the idea that you can invest with conviction in a group that has enough kind of like product diversification across these 7 companies that you can get quite a bit of different looking charts for each of them. I mean, Microsoft looks totally different. I mean, Microsoft looks like a company that's just been kind of churning along, whereas Meta rips in the middle of a DeepSeek sell-off that's causing a drop in NVIDIA and others. So you're getting a surprising amount of dispersion within just only 7 companies.
Well, yeah, so there's sort of an interesting interplay going on, to your point. So as you noted, there's been tons of studies that actually a lot of people over-diversify, and concentration, because we've been taught to diversify, tends to have a bad name. But what's interesting is when I think about diversification, it's really your asset allocation mix. It's less the diversification that you have in perhaps the names that you like or the individual stocks in a portfolio. And so this strategy, this ETF, does exactly that. So the impetus originally was to create a precision tool for investors and traders to access these names. Of course, we couldn't have predicted just how robustly these names would have outperformed. But look, going ahead, to be quite honest with you, the market itself, and in turn the Magnificent 7, has become more fragile. Even though I still think there's quite a bit of a bullishness in the markets, whether that's animal spirits from retail investors, a continuous bid into passive being driven by target date funds, and things of that nature. Plus, these companies have delivered on revenue and earnings, unlike the rest of the market. And so it's really hard for me to be able to see durability in a rotation until we have clarity from sectors outside of big tech, of the Magnificent 7, to do so. And to your point, even though it's just 7 stocks, there's thousands of companies that each one of these names own. So investors actually, because of the concentration in the market, because companies like Meta, Alphabet, others have really scooped up a lot of attention, and other companies, whether that's in the social media space or in the consumer goods space, that you can really benefit from having that more precise exposure.
All right. Case well made. Thanks, Dave. Appreciate the update on the thoughts and how folks are using it. Good stuff.
Thank you.
Let's look at some options. Let's trade it. George Tillis joins us for a look at Meta and Microsoft. All right, so there's the basket approach, George. Give me a bullish trade on Meta. Hit me, because we got like 3 minutes.
All right, sure. Yeah, if you're bullish on Meta, obviously this one's expected to have quite a bit of volatility. About $43 is the expected market maker move. That's a 1 standard deviation move by expiration on Friday. So what we're going to do is we're going to sell the near-term options to capitalize on this high implied volatility expected move by structuring essentially a long call diagonal spread. So this is a bullish trade, and what I'm going to essentially do is I'm going to sell an out of the money option, the 720 call. That's again going to expire on Friday, and then I'm going to use the proceeds from that expensive option to finance a February in the money option. I'm going to buy the 660 call. So I'm selling the 720 that expires Friday, buying the 660 call that expires in February on the monthlies, and these are 23-day expirations. So if you put all this together, essentially you would outlay about $25 a share or $2,500 a contract. So in essence, if you do see the stock stay well contained within the confines of that market maker move, then ideally that 720 will expire worthless, to which time, if you do hold that February contract, you would essentially have about 685 would be your break even. Again, if you hold that February expiration or February contract to expiration.
Okay. All right. Buy 660, sell 720. Okay. Why not? I mean, pretty straightforward call diagonal. You get to take part up until a point, and obviously you've got a little vol bid in here, so take advantage of it. I mean, 720. I think you're having a good problem if you're maxed out on this, right? If Meta rips to $50 or $40 or whatever. How about Microsoft, George?
Yeah, and so in this case, if you look at the stock, we're actually trading still well below the lows that occurred back in July. So, I mean, this one's just been trending sort of sideways over the past 6 months or so. So, in this case, if you're bullish, we have to kind of give additional time and not worry so much about the volatility move in this case. So what I'm going to do is outside of the market maker move, actually I'm going to go out to February with 23 days expiration, and I'm going to buy a bull call spread. So I'm going to define my risk, define my return, and then let this play out over the next 20 or so days. So I'm going to buy the 445 call, and then I'm going to sell the 455 call against it. So altogether, this would cost you about $4 a share or $400 a contract. So in essence, this is a slow grind higher kind of trade. 449 is your break even, and then at 455, that's where your max profit is achieved at $6. So I'm outlaying $4 to potentially make $6 in this case, and that only occur if the stock hits 455 or higher by expiration. Based on the current price, it's not too far off, but keep in mind there's a lot of volatility out there in this market, contingent upon what's happening with CapEx and all the AI news around some changes that are expected to come.
All right, nice. Like the trades, George, a couple bullish approaches and different charts. Do you think the kind of vertical is a little bit more geared towards the stock that's had a little bit more chop, whereas kind of the more aggressive approach for Meta seems to work with the trajectory? Thanks, GT. Nice look at some of the big earnings. We'll talk Tesla when we come back. That's next up on our list here. Be right back.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome back to Morning Trade Live. We're in hour 2 of our show here. Stocks trying to firm up a little bit. You got the Russell up about 0.5% right now. You got Bitcoin up 1%. A lot of big tech stuff still under some pressure, though. Small caps are going for it with bonds still firm on the session, but not a lot of clear catalyst for this shift towards small caps. Often when the Russell does make a notable move, I look to bonds for the answer. But actually, treasuries have kind of softened up in the last 5 minutes, so make of it what you will. But the small caps are ramping up. I mean, that chart just went vertical. But big tech in the Mag 7 are a little bit under pressure here with NVIDIA down $3.50 about. We'll continue our discussion about earnings with Tesla next up on the list. Shares trading below $394 this morning. Tesla still sitting on a cool double in price over the last 52 weeks. We'll take a look at some of the options and volatility going into that report as well. This afternoon is going to be an exciting one. And speaking of Tesla, the man who runs that company, Mr. Elon Musk, is a close ally of the man who runs the country, Mr. Donald Trump. We're going to talk about policy as it intersects with energy from the administration, and that's ahead of a look at some charts, getting ready, and looking at some important names, I think, with IBM actually having a great year behind it. We'll take a look at the chart there. Ahead of its report, ServiceNow breaking out after a big run in cloud stocks yesterday. We've got that number coming after the bell, too. And then Western Digital, one of the underperforming semiconductors, which is actually up today, will also give us earnings. So a lot of prep. Get your pen, pad, or your platform and get ready to roll. I got Alex Coffey with me here in studio, host of Next Gen Investing, and I got Kevin Hanks joining me from the SIBO. Kev, what's with this Russell ramp? Anybody watching that down there?
I wouldn't say that is the focus today, Oliver, but look, I'll tell you what, one way you can look at the Russell, look at the strength in banks today, in financials. That is a sector of the U.S. economy that continues to power higher. So when I break down the Russell, I look at financials and, well, they're not the leaders. It looks like more industrials in the Russell 2000 that are leading besides anything. But
no,
yeah, you've got
regional banks are up 1.5%.
Up 0.3%. Yeah, but it's financials.
Yeah.
Right. That are up in the S&P. You know, Oliver, I don't know the Russell like the back of my hand. I think it's heavily interest rate sensitive. As you know, a lot of these companies are smaller, the interest rate sensitive. A lot of them are not profitable yet. But what I was really looking at, you mentioned right at the top of the hour, was how about this? NVIDIA down, but AMD, Broadcom, and Marvell all higher with NVIDIA lower. That is an interesting thing catching my eye this morning. You know, you've still got, if you look at the quotes, you've got 1, 2, 3, 4, 5, 7 sectors of the S&P 500 higher and 4 lower. So it's still a relatively positive day, just not showing up in the numbers. And you know why? Look at the visualized chart. It is heavy, Magnificent 7 on the downside today, Oliver. And that, as you know, just overwhelms the rest of the S&P 500. So, you know, a dollar that was about 108.25, 108.20 level, now looking right at the 108 level. It's backed off a little bit, but I still think we're dry powder, Oliver, and we're waiting for 2:30 Eastern and then 3 o'clock Chicago time for earnings.
Yeah,
so
true.
I think it's a big day. I think the markets are moving in relatively small ranges. I wouldn't make any more of it than that right now, Oliver.
Hang with us there, Kev. Mr. Coffee, jump in here. A little bit of a Russell rip. To Kev's point and mine, the interest rate sensitivity of that group makes me look at bonds, but nothing particularly unique happening. It seems like, to Kev's point, dry powder start to the morning. NVIDIA down $3.50. Maybe someone finding some dry powder there still, but overall, this is a market that seems, a little bit at ease. I mean, we're not doing much. It's like we could have easily sold off hard yesterday. Instead, we ramped back, and it seems like we're pretty calm this morning with VIX, sitting at 16.5.
Yeah, I think I echo largely what both of your sentiments are in terms of, kind of waiting. I think the market is perhaps positioned, and maybe that was part of the exaggeration of the selling that you saw earlier in the week. There's sort of that surprise deflationary shock with the DeepSeek stuff, but then there was sort of probably a rush to kind of position and hedge out things ahead of the Fed, ahead of all these mega cap earnings, and it was sort of this scramble that was set up to begin the week. So you look at where we're at now, a lot of that de-risking that you may have thought might happen going into some of these events maybe was just sort of accelerated because of what happened with that deflationary shock earlier in the week. I echo Kevin's sentiment about today. I mean, today is early in the session. I think the day will ultimately be decided by Jerome Powell and things later on today. But early in the session, this is a mega cap tech weakness story. And so what is the index that has the least exposure to that? The Russell. What is the one that is not market cap weighted? It's the Dow. So I look at this and say, kind of an inverse of yesterday, the same way that yesterday was inverse of Monday. But the it's been de-escalating in terms of volatility, at least so far, until we hear from the Fed, which I would expect that to wake things back up.
Great description of de-escalating. I'm on board with that description. I like that. That's kind of what I was trying to drive at. So well said. Bonds up 11 bips. The thing is, because we had that DeepSeek sell-off, and the way you describe it is a deflationary event, I think is also pretty astute. We had a huge bond rally to start off the week, which is why, Kev, I feel like I've got here to keep fading bonds, because there was a start to the week that was so strong in bonds that I feel might have preempted what could have been a bond rally on Powell. Did we forward that and now kind of shift the expectations maybe around fixed income, depending on what Powell does?
Well, I think Monday's bond rally was what was the appropriate response to a risk-off environment. That's what I see as now the dust is settling, and we're trying to figure out, is this a good level for bonds, or is this a level that we should move off of? And I think Jerome Powell will have something to say about that today. I think his comments will initiate or be the genesis of the next move in yields. So, once they're here, I don't know if anyone wants to make a big move before he speaks, because, the fact that he's not going to move on rates today, does that lean his discussion dovish, right? When he lowers rates, does he come out hawkish? It's one of those situations. What tone does Jerome Powell come out with, or does he just stay to the script and try to get this done with as quickly as possible? I think that's what bonds are waiting for. Stocks will probably pivot off that for a while, but then we got to the end of the day, Oliver, and that's going to be a major move. And the topics that they're going to cover, like CapEx spend, it's going to be must-see TV for people in our business.
Yeah, probably a pretty thin line of, thin margin of disappointment for CapEx.
Sure.
All right, thanks, Kev. Appreciate that. Alex, let's talk some Tesla to that point for this afternoon. It seems like Meta and Microsoft, even though the charts look very different, thematically are very similar. Tesla in a world of its own. This one, to me, does still have some of that AI stuff into it, for sure. But, like, for them, it's way, way down the road in terms of, like, the robo stuff they're talking about. Obviously, it's here in terms of the robo-taxis, but, like, the way they talk about their humanoid robot and all that stuff. To me, this is still very much a policy play in many ways. So how do we read into earnings on that?
Well, let's tie this to the news that we got this week and frame, what were the big takeaways? Well, the big takeaway was that potentially these models need a lot less compute power to actually be run, okay? That is good news for companies that are investing in chips to build out these models and these different things. So the deflationary aspect and the negative impact, to me, is actually limited to hardware adjacent type plays. It's not necessarily negative. If it ends up being the case, negative for the companies that are investing. It may be negative for Microsoft because it has ties to OpenAI, and OpenAI might have been undercut a little bit here. But as far as Tesla, I mean, if anything, this just gives them a chance to, do more with less, and so, or show that it's possible to do more with less. I don't see how that's at all negative. What Tesla does that's different than many of its peers as well is that it has a successful product that uses the proceeds from, which it is an earnings positive company with a lot of free cash flow, to fund this R&D. So it's not like the Rivians of the world or the Lucids of the world that are trying to just get to break even so that they can survive from an ongoing standpoint. Tesla's already proved the concept. Now it's priced in a way, and this is where it gets a little bit more polarized when it comes to Tesla. Is it going to be a major AI breakthrough winner down the line and come up with some technology that allows cars to drive for themselves, and that's going to take over, allow for autonomous driving, major battery storage breakthroughs and, sustainable energy, things like that? Or is it a car company? Because if it's just a car company, it's overpriced, right? And so you look at its peers in the case of Ford or GM, these traditional automakers, they carry way less market cap and way less, earnings multiples. So that's your downside, is that they don't become a winner. But there's I think a belief that they can. Now, for this particular earnings, you're expecting 75 cents for EPS, again, a positive number. And what we're looking for is $27.5 billion in revenue. So it goes to show they make a ton of money, and they do so in a positive free cash flow way. Then they pump that money back into R&D. They collect so much data, the more cars that are on the road. Yep. They've had this strategy of start with an expensive product and continue to kind of commoditize it and get things more scalable. They have taken margin hits recently, so margin will be scrutinized, I believe.
But every car company has to.
Yeah, no doubt, and especially when you have a disruptor like Tesla coming in and willing to do that, it's essentially the Amazon model in a very different way. Amazon had no problem, Walmart had no problem cutting into their margins to make things very difficult on their competitors. And then in the end, if you put enough pressure on your competitors, some of them fold or they have to combine, and things happen that put you in a favorable position. But I thought this was interesting, Oliver. Just today, you've had, I'm just counting here, let's call it 7 analysts updates that I'm compiled on my Bloomberg here. 2 of them are neutral, 3 of them are bearish or have like a sell equivalent rating, and 2 are outperform. So even amongst people who look at the exact same metrics can agree to any degree.
All over the board.
From $157 for a 1-year price target to $500.
It's kind of always been the case for Tesla, right?
It has, and it is increasingly polarized. If anything, the fact that you actually have peer perform and neutral ratings now is what makes this different. It used to be everyone was either super bullish or they are super bearish because, hey, it's going to be this breakthrough technology company or it's a car company.
Yeah, the binary make it or break it days are past them, but now the question still, it may not be as binary make or break as it was when they were trying to ramp up production, but when you have the valuation as expensive as it is, there certainly could be significant volatility if the market sees or hears something it doesn't like. And again, but I don't know if earnings are necessarily going to be so volatile because so much of this hinges on policy, and if and when that comes through, maybe you'll get the swing in one direction or another? Give me a last thought.
Yeah, I mean, I don't know that the policy stuff is big of an impact, I think, that you do personally when it comes to Tesla. I feel
like that big rally was, you saw the stock go boing on the election.
Agreed, but some of that could have been, perhaps the risks that were thought if it didn't go that way. And so I don't want to get into, what will happen. I don't think that, the government is suddenly going to, favor Tesla, for example, and that's going to be but possible.
I probably would disagree with you there.
I mean, we'll find see. Out. But when we look at this particular company, I think one thing that's always stuck out to me is that earnings aren't as volatile as you think they're going to be typically, because we already know the numbers from a delivery standpoint. And so margin will be scrutinized, and then the words of Elon and team will be scrutinized. But it's not quite as volatile as you think it is oftentimes around earnings.
Yeah, all right, nice. Great analysis and great report. Thanks, Alex. Really good stuff. Nice setup here to Tesla. Let's trade it. Scott Bowers with us, too, CEO of Prosper Trading Academy. Chime in, Scott. What do you think?
I agree with you, Oliver. I think that when it comes down to it, this could be right now more about policy than what we're going to hear on earnings. Now, you and I talked about this exact topic last week, 1 week ago today, and I'm going to give you the same kind of rhetoric and the same position that I talked about last week.
Okay.
I don't think that earnings are going to be a big impact.
Okay,
I could
so you're with Alex
absolutely
on
be
that
wrong.
part.
I'm with Alex on that part. I am with you that the policy part is a big player here. So what I did last week, which is the same thing I'm doing now, is I sold an iron condor looking for Tesla to really just consolidate between basically 390 and 450, which it did. I took that position off. It wasn't a huge winner. It was a nice small winner, but I'm putting on now the same sort of position for earnings today. So I'm selling the 370, 360 put spread on the downside, selling the 435, 445 call spread on the upside. I'm collecting $4.50. My break evens at the end of the day Friday are 365.5, 439.5. Anywhere in there on Friday, I win. If it moves outside, if we do get, an outlier move, okay, I know what I can lose on this thing. But again, I love the kind of the consolidation and not that a Tesla earnings report is ever just listen and then move on. There's always some excitement with Elon in there, but I really think this one's going to be more or less a non-event.
All right. Nice. Putting the money where the analysis is. So looking for, look, the other thing, too, is that Tesla kind of has been carving out a little bit of a range here. It's a tricky chart in the last, basically since the peak to say it's uptrending or downtrending, because you haven't been making lower lows, really.
Exactly.
But you have been making some lower highs, so it kind of seems like you're trying to appreciate both ends of it.
Exactly. And again, I've got 365 to 440 is my range where I make money on this thing at the end of the day on Friday. And as always, I put a trade on that I know my maximum risk. So if I do get that, wider than expected move, I know what my risk is.
Okay. So you've got defined risk, you've got defined range, and looking for Tesla to calm down a bit, or at least stay where it's at. So fits with Alex's assessment, like the trade. Thanks, Scott. Appreciate it. 450. Yeah. All right. Scott Bauer, CEO of Prosper Trading Academy, ahead of the Tesla report. Like that setup. We're going to shift gears a bit when we come back. Questions about policy in the energy category might be a little bit more discreet and clear, given one of the early executive orders from President Trump was regarding energy. We'll be right back to talk about how the rest of the world might react to U.S. drilling, baby drilling.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Crude oil down below 75 bucks again. Perhaps some pressure entering the energy price as the Donald Trump Part 2 administration expected to keep the spigots flowing at least. Joining us, Vikas Trivedi is a global energy strategist at Macquarie Group. Vikas, good to see you again. Thanks for joining.
Yeah, thanks for having me.
What do you make about all this drill baby drill talk? I thought we already were drill baby drilling.
We have been. So it's not new. It's, I think it's a new branding of what's been, well underway for a decade. So we don't expect a lot of change in the trajectory of U.S. oil production as a result of the new presidency. We do think that a lot of the regulation and some of the burdensome frictional costs will go down and make things easier. But in the end, the drilling will be driven by economics, the returns that investors are demanding, and what the world can handle in terms of new supply from the U.S. Those are the real limits. The rest of it has not been a big constraint.
In terms of locations and potential areas opening up, we hear a lot about Anwar. We hear a lot about how there could be more pipelines built. I mean, is there a gold mine? Is there a huge amount of oil that's currently inaccessible these companies want to get to?
No. I mean, look, there is, okay? It's just not a lot on a global scale. Could it be meaningful for certain companies that are involved? Absolutely. But, are we going to be back at 1 million barrels a day of U.S. oil production growth as a result of the reopening of some of these areas on federal lands, Alaska, as you mentioned? The answer is no. Like, it is very unlikely that it would open up enough new drilling, and it's not needed, right? You would crush the price of oil along the way. To the point where it would sort of be a circular thing where it's like, okay, I got the chance to produce a lot more, and now my price is down below my break even, and definitely below what my investors require in terms of not just return on capital, but return of capital, right? Give me my money back via dividends and share buybacks.
Okay, so that's I guess the only then possible kind of solution to that potential imbalance, where if like, all right, I've got more access to drill, but it doesn't make sense for me economically, would be if some of those other, I guess, frictions were removed somewhere else. Like if I could drop my break-even rate way down, then okay, maybe I would pump my numbers up even more. But is that physically possible for these for most drillers?
No, it's not. Look, the frictional cost that'll be reduced will be meaningful, but I think, it'll be in the order of a couple of dollars a barrel of margin.
Okay.
So if I drop my break even by a couple of dollars, will that really be enough to turn up the production by a lot? And once again, I think the answer is no.
The potential for price then, though, is there a cap on it? So maybe this doesn't drive prices, or maybe it doesn't drive volume way up, but how will that correlate to price? Will there at least be like a cap where then, okay, if there is like a lot of pressure to produce, then as soon as oil goes up, then we're going to jump on that?
Yeah. Look, there's a lot of debate in the oil market for shale running out of good geology, running out of easy production growth. We think that is not the case. You know, if you give shale the price signal, it can grow. It can grow to meet whatever demand scenario the world will throw at it. Right now, the demand scenario is sort of lukewarm, right? It's a little above 1 million barrels a day of demand growth, which is not even matching the normal trend. But let's say we get a great demand scenario and the world needs it. Maybe you have outages elsewhere. Absolutely. You know, the shale can grow, and it can grow profitably if the price is right.
Okay. What do you think is possible from the rest of the world? How will they answer this? If they do hear a lot of this rhetoric, will they try and get in on it beforehand, try and undercut? What is the pumping potential of Saudis, Russians?
Yeah, look, the rest of the world can really crank it up if they want to, if they feel like they need to get ahead of the U.S. growth. But I think there's been a lot of learning amongst OPEC and other producers in the world, which is to don't jump the gun. Just let's just see how this plays out. Let's see how much production growth the U.S. actually can deliver, and then we'll respond. You know, if we need to do a market share battle, which we've seen in the past, we'll do it. If we maybe need to cut more, right? If you're OPEC, they've done that. They've been very nimble and not as tied to any, real strong bias about, hey, we need to do this or that. It's like, no, we need to manage the market in the most nimble way. And they're acting a lot more like an oil trader than a cartel. And I mean that in a positive way, with flexibility in their approach.
Okay. So it sounds like there's a little bit more optionality maybe from some of the major producers around the world. 6 months from now, price-wise, care to throw a dart at the board? Vikas, what do you think for crude?
Yeah, absolutely. Look, we think you still have a nice upside in the works right now over the next few weeks, next couple of months, and it's Russia-related. We think what's happened is the market has been faked out by previous sanctions and supply disruption risk. You pay for it, the front rally, spreads rally, the curve rallies, everything is, reflecting supply disruption, and then the disruption never comes. And after a few of those that have happened, the market's fading this, saying, look, I don't really care. Like, yeah, maybe it's real, but I'm not paying for it. And actually, ironically, this one is the most real. The Russian sanctions that are underway, they're already showing real disruption in trade flow. And big buyers of Russian crude are slowing down their purchases in real time. So we think that'll play through. Like, that's going to be reflected in higher prices. And then at some point, if oil gets too high, something will have to give. Either OPEC comes back on in a big way, or the U.S. growth machine really gets cranking. And the third one is, we start doing waivers and other things with Russia to get the oil back in the market. Well, let's say it's starting to approach 100, possible, unlikely, but, we think it'll be rising. And then at some point along that 6-month path, we think these adjustments will happen. OPEC, the U.S. growth, some waivers, just to relieve the price pressure. We don't think the Trump administration is going to be okay with, $100 oil and rising refining margins, which all show up at the pump, right? So that's the constraint.
All right. So we kind of go up and then come down.
Yeah, that's our view.
All right, cool. Love it. Vikas, thanks a lot. Good conversation.
Okay. All righty. Thanks.
Yeah, super helpful. Vikas Trivedi from Macquarie with the take on crude there. A good reminder, too, of Russian sanctions pinching a little bit of that supply, perhaps in the short term. All right, we're coming back to talk some charts and look at some earnings, continue some of the tech chat. Got a couple important ones coming this afternoon. ServiceNow, after yesterday's big cloud breakout, is one that stands out to me. But Western Digital and IBM have roles to play in all parts of the AI trade, memory to data centers. IBM's been on a pretty nice little recovery.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, Our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Let's do some earnings prep. Mr. Ducat, Mrs. Horn. Okay, let's get ready. Service now. I feel like it's kind of the big one here because yesterday's big cloud breakout was huge.
It was huge, and actually, this is easily the most encouraging of the charts, which frankly I'm sure is a huge surprise. But we're still up 46% on the year, and still, I mean, seeing some pretty decent upside as far as like not only like what we've seen over the last year, but so the last 12 months at this point. I will say that we saw expectations beat in terms of revenue by about 2% last quarter. We saw revenue around $2.8 billion. That was up then 22% roughly on the year. And overall, it was a satisfactory, really quarter for the company with impressive beats across their various metrics. Also, though, decelerating growth in large customers was a huge theme echoed last quarter. So they added 32 enterprise customers paying more than $1 million annually to reach a total of just over 2,000. It's always, to me, amazing how, like, relatively small, I guess, this company is as far as like its overall enterprise accounts. But this quarter, Street's expecting around 21% revenue growth to just shy of $3 billion, slowing again from that 25% increase we saw the same period a year ago. But adjusted earnings expected also to rise to $3.66 a share. I don't know if we've been talking about a name with earnings still ahead this week yet that has seen 21% revenue growth. I mean, these are pretty astronomical numbers. We've been talking nothing but like contracting growth, in line, modest growth. 21% is 21%. So that's, I think you got to give credit where credit is due. This name has outperformed a very difficult volatility storm that it's way on tech right now.
Yeah, that's good double-digit number to expect. I mean, the chart looks pretty great, Rick.
Yeah, pretty strong. Hard to quibble too much with the results that we're seeing here from a bullish perspective. I would say, though, that more recently it was looking like momentum was slowing down and we were perhaps becoming more range-bound here. So we had this high point right here. Then we had a gap up. It was the subsequent low point, 980. During our last rally, we made our way up to our high point there around 1158 or so, falling wedge type shape. Then we regrouped, pushed back into the channel. Now we made some new intraday highs yesterday. Today we have backed off a little bit, slipping below that previous high point here. So momentum interrupted. We did not make our way into the overbought area this time. That would have been a sign of strength coupled with a new high yearly close. So when we look at volume profile and standard deviation channels, we can see the heavy volume areas are here, here, and here in the near term, at least we're close to where current prices are. So around maybe like 140, 1050, and like 1020 or so, around those areas here. We can also see that there's quite a bit going on here. There's our old trend line, our yearly linear regression line, our line of best fit based on closing prices, and our orange 63-day EMA, all coming together around that 1050 level. That looks like it could be key to the downside. Meanwhile, to the upside, +1 standard deviation channel, channel, the upper boundary of our price channel, those all both come together around 1192.
Okay. The fact that we kind of bounced around up here and then ripped back higher, kind of slingshotted our way to a fresh breakout in service now after this pullback was kind of threatening the down channel. Boy, I feel like that's a pretty good little momentum shift to have.
Yeah, it was a turnaround there. I mean, it can be tough when you get these situations where you close beyond an important boundary. It was a bit of a fake out, though.
Exactly.
Notice that we were treated to this volume node. We didn't actually make it to the point of the gap at all. We didn't fill the gap either. Those were maybe some clues that easy to find in retrospect, harder to assess at the time.
Okay. Good looking chart for service now. Nice fresh high, so pressure's on. A little bit of a sell-off this morning, down to 1.8%, with the market kind of flat, maybe a little bit of nerves, some profit taking ahead of the report. IBM, let's go there next. Pretty decent chart by IBM standards last year, and it seems like they have been taking part in some of the data center and cloud enterprise demand, security, and a few other items too.
I mean, absolutely. The name that still does remain up on the year, which is something. And if you would have told me IBM would have been one of the most interesting names that we were talking about in this like week of major tech earnings in 2025, I would have said you're lying years ago. But they've really carved out, I think, a niche for themselves in the AI world. They also do have, I mean, acceleration in their Red Hat business. Also updates to the $7 billion closing of their acquisition of HashiCorp. So all these are subject to come up later today when we get those results. Now for 2025, we are expecting them to guide for about 7% year-over-year growth. I mean, that right now is per Bank of America, but I've seen a lot of analysts that are sort of targeting around that 6 to 7% growth for the full year. Now, as far as updates for this current quarter, again, momentum in the AI space is expected to be, I think, a continued driver. We're also expecting their enterprise AI business to reach about $1 billion in terms of the end of the fiscal year, with a book business of generative AI exceeding $3 billion, at least through its inception to date. Recent, again, AI news from IBM is all across the board, but the rise of SAP with their IBM Power virtual server, which does aim to support these various AI business-powered operations, as well as the next generation of their IBM's Granite AI models, and these are all per IBM. So there's like a lot to like when you just search IBM AI. They've been busy for the past quarter. And I think that also, like I mentioned, the fact that they have a $7 billion acquisition closing, I think that updates on that. Also, there's still the thinking that we are in a strong refresh cycle. I'm not necessarily saying I fully support that, but they do benefit from, I think, the renewed interest in like the PCs and like the electronics and all these things that there's still the belief that we're going to see this bottoming of the PC market, and that IBM stands to benefit from the continued uptrend in demand. And we've just been saying that now for like 7 straight quarters. I'm a bit of a skeptic.
Yeah, the other stuff has been driving it more, to your point, the AI.
Yeah, this is more of an AI story, absolutely.
Yeah, don't forget they had the old Watson, RIP to that guy, got killed by NVIDIA and the Blackwell. No, it still is kicking. Rick, chart-wise, what's going on?
Yeah, a nice rally for sure in this name here. However, it comes with some caveats. We made our way up to these highs here. We managed to eclipse them during our last rally, but then we saw a pretty quick retreat back to a key level here. That was an old high there, and then a subsequent low near about 215. From there, we've been mostly hanging on to our 2 moving averages, yellow 21-day, orange 63-day, clustered together between like 221 to 224 or so. Now we can also see this longer-term white trend line going across these lows, connecting here and here. That's been broken. Now it's become resistance. It's a source of upside, difficulty there for the bulls in this name. RSI also shows that much like price, we had this blue trend line here that was broken. RSI did pretty much the same thing. Now we've reasserted ourselves somewhat. We are above the 50 midline as we still struggle to overtake that old trend line. So now if we were to incorporate these other studies, well, there's some nodes here, here, and here that are close to current price levels. Most notably, that 215 level, that low point, and then before that, the high point, that's a node. And then right about here, near about 225, that's the site of these indicators that I mentioned previously, and our linear regression line, our line of best fit. Finally, to the upside, heavier trading near about 232, 233.
I respect the chart, and I think it's quite interesting because we slip below this uptrend line in the area you've got circled here, but then we're still above the moving averages. So kind of the further you zoom in, it seems like on the short term there's still some pretty good support. And we did put in the higher high and higher lows, so it's kind of got this upward momentum still, but a little bit of slowing on the margin of that momentum. It seems like a decent setup for stock that's been trending higher, as long as they don't miss earnings to find some further support. It's interesting look there, the way it kind of slipped under the trend, but then held above another one. So a little competition in the NVIDIA trade, or rather the IBM trade lately, but looking pretty decent. Western Digital, last one here, Jenny, down pretty low compared to most semiconductors.
It is, and it's only risen now 5.5%. I think even just shy of 5.5% over a 12-month basis, which I think speaks to, again, like the area in which they're operating in the AI hype cycle, frankly. So we do have earnings expected. They're expected to, I mean, we did see that estimates now have actually been revised slightly downward, which I think is probably fittingly so. But consensus right now for revenue is pegged at around $4.3 billion. That would indicate, though, an increase of about 40%. So that's something. At least we're expecting some recovery. Well, also, we've seen in the last 4 trailing reports, actually, an average surprise to the upside of 64%. So I guess this name, you can make the argument, it moves on earnings. Yeah. I think historically, we haven't really seen it move favorably, but we'll have to, again, wait and see what right now we do get. They've been able to actually, in the last year, slightly outpace the industry's growth as far as their bottom line, but again, that's like really reaching, I think, for like the bullish case, because, I mean, look at the underperformance of this name for the better part of the last year. They did provide some preliminary results, though, for their upcoming quarter, with revenue now expected to be at the midpoint of their previously issued guide of around $4.2 to $4.4 billion, which was given back in the first quarter of their fiscal 2025. So we do already know a lot of what we're sort of getting. Like, we already know that prior guide had been for $1.75 to $2.05 for earnings. We're expecting the lower end of that range. But as we know from Boeing teaching us a valuable lesson this week, you can come out, you can give preliminary results, and you can still miss that. So it's not a shoe-in that we'll get these exact figures, but I do think there's a lot of like the expectation for this report now priced in.
Yeah, okay, fair enough. Interesting setup here, Rick. I don't know what to make of it. Take me through it.
Well, I mean, for starters, the prevailing pattern seems to be more of a symmetrical triangle with our 2 trend lines beginning at our 52-week highs and lows. So we can see that now price has started to take a turn for the worse. We are falling below our moving averages here. After a gap down, we have given up all 3 of them in rapid succession. Our yellow 21-day, orange 63-day, purple 252-day exponential moving averages, which are clustered quite closely together, which suggests there's not really a strong trend direction one way or the other, which makes sense given that we've seen these choppy prices that have kind of just been zigzagging back and forth.
Yeah. Jenny's point, too, about volatility on earnings, kind of got a little spring coiled situation going on here a little bit.
Exactly, yeah. Low volatility can often be a precursor to high volatility when the breakout eventually happens here. Notice as well that momentum, despite this false breakout type situation that we had there, you could have drawn an accompanying trend line in price like that there. So a kind of a disappointment for the bulls. We're back below that 50 midline, hanging on to this green trend line though, so potentially maybe finding some support here. Now, to look at our volume profile, not a ton of help here. Most of the trading is just right in the middle. Our point of control is near 66.30, right above where we are now, but not a good sign that we're drifting below it here. So recent lows line up with the -1 standard deviation channel near about 61, then another set of lows there, 58.82 before you start getting into this volume node down here near 57. To the upside, filling the gap would take us right to the level of that linear regression line near about 67.35.
All right, so you've got some areas to think about when the range compresses the way it has been. Kind of helps you figure out levels, but it also looks very live for like directional movement, you know, either way. Seems like the spring is loaded here for Western Digital to some extent. Thanks, Rick, for the chart. Thanks, Jenny, for the look at the expectations for numbers. We'll check out the market session when we come back. We've got some red across big tech. Mag 7, pretty sluggish this morning. Not a lot of big updates, though. You do have the S&P now down about 1/3%, so we have softened up a tad.
accelerate your market knowledge,
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Morning Trade Live. I got Alex Coffey and Mr. George Tillis joining me for a little chat here about the session. NVIDIA is down 4.5% right now. George, what's up? Why won't people just buy the stock and hold it?
Well, I mean, obviously there's a lot of reasons, OJ. To be honest with you, I think we've seen the cycle top in NVIDIA. I think what we'll end up seeing is slowly the stock drifting to the downside over time. I think this is a manifestation of excessive capital expenditures, which again, the problem with NVIDIA has always been, what about the future replacement rate of all these GPUs that they're outlaying and selling to the marketplace at premium prices right now? So I'm really cautious on NVIDIA. It's not to say that it can't go higher from here. I think that we've actually seen the cycle top in NVIDIA, and we won't necessarily see those levels again until we go through a whole from a bullish to a bearish, and of course back to a bullish cycle.
What do you think about that, Alex?
I think he just described a Cisco 2000, 2001.com top, and I think that makes sense because we just had news this week that you might only need 1/20th amount of these chips to do what these companies want to do. So it's great news for those who are investing in AI and building things out, and it also opens it up so many more can actually, participate in this, from, universities to other things, because you're not going to need perhaps as much compute power to actually play this. So it's not going to be a game that's limited to Alphabet, Meta, and Microsoft and, Apple if they want to play. It's perhaps going to be, a lot of these other companies and companies we've never heard of and people we've never heard of that are going to perhaps make breakthroughs in this. So win if that's the case for consumers. Win for those who want to be investing into AI, but doesn't mean that it's a win for the companies that make the GPUs and these chips and data centers that are required to build them out. So like everything, things become commoditized and obsolete. And so I'm not going to say NVIDIA can't rally, $25. I mean, it can do that in like a day. So I'm not going to say that because that's all it would take to get back to the highs. But I think George makes a compelling case.
Yeah, I think so too, because we've also just have a lot built in for expectations around a lot of stuff in the market that is connected to a lot of these AI themes. It's just the chart for the broad market doesn't look too scary just yet in my mind, but you got banks doing well, you got other stuff. Those are two separate stories. The fact that financials have been firm around earnings this season and are leading today with the breakout, that's got to be worth something to talk about, George. Regionals are up 1% too. The fact that NVIDIA is breaking, but the market's not really breaking, it's only down 0.25%, is fairly encouraging.
It is. I mean, it's a challenging environment because just the size of NVIDIA is just enormous. And so you have to consider where all this money is going to go. And ideally speaking, it is moving into other areas, weaker areas of the stock market, or underrepresented areas. Let me phrase it in that context, which includes, the materials space. If you look at industrials, if you look at financials right now with the yield curve widening out, they're benefiting. I just think, NVIDIA, the expectations were so lofty in that stock. Now you've got to deal with the repercussions of where all these hundreds of billions, if not trillions of dollars is going to move into. So, ideally speaking, I think Alex brings up the important word is commodity. Artificial intelligence is becoming commoditized. It doesn't necessarily mean that because NVIDIA may not move the way it has in the past, that the markets have to roll over. I think it'll pose a challenge for like the NASDAQ 100. We could certainly see the S&P overthrow to new highs, at least in the near term. I don't think that's, completely out of the realm, as there's a redistribution of capital towards other areas. I think the software areas, communication services areas, companies like Meta Platforms will benefit from commoditized AI. Apple, I think, has got the right strategy around AI because they weren't really in the business of developing their own. So they're essentially going to now be harvesting all these AI apps and ecosystems within their platform. And I think that's a good strategy. But nonetheless, this is going to be a difficult environment going forward just because of the expectations everyone had on NVIDIA. And questions are, what are we going to do now?
Yeah. We're still above 120. Seems like that should be somewhat of a line in the sand, but it definitely is not a great start to the day. Maybe folks are selling NVIDIA to make some room to buy bonds. I don't know. Bonds have kind of faded a little bit from the early morning, but I just feel that we're focusing on NVIDIA for a reason here, Alex, which is that the FOMC, this is not going to be a surprising event, I don't think.
Look, I think what we're describing is a game of hot potato that I think has been a real risk for the market for 2 years now. Now, those who've had the stomach to ride the wave to the upside inevitably aren't going to sell the top. But when they start to see signs that cycle peaks have happened, they're going to exit those positions. And so I look at this, and I think what George is describing is really just concentration risk and talking about the fact that NVIDIA has been such a power for this market. But you had 55% of the NASDAQ higher on Monday, and we were down 2.5%, 3%. So there's real concentration risk in the market.
Yeah. Thanks, guys. Good thoughts. Nice job, George Tillotson and Alex Coffey, for a lot of help this morning, gentlemen. Thank you for joining Morning Trade Live. Trading 360 with Nicole Petalides is up next. I will see you about 2-ish p.m. Depends how long the presser goes and how interesting it is. Join me, Oliver Rennick, alongside Schwab Network's options experts as we explore the second derivative. Gamma On is a brand new limited series to take your trading skills to the next level. Subscribe to Schwab Network's YouTube channel now.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
morning. We're 90 minutes into the trading day. Welcome to Trading 360. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange. We have a mixed market for you here at this moment. Of course, it's Fed Day. Our 360 Spotlight will be joined by Rebecca Walzer, who will take us through her stock picks. She's looking at Snap, Fortinet, Lockheed Martin. She had also called for a big pullback in AI stocks. We saw that this week. Many of those are still down. Disruptor today, F5 Networks rallying to all-time highs after reporting its earnings well above the analyst estimates. And our panel is standing by to take a look at Starbucks. All the news on the coffee chain moving to the upside, beat expectations on some metrics, revenue, earnings, but same store sales saw a dip again. We'll go into that a bit. In the meantime, right, and I can almost say cheers if I get it in there. I was holding my Starbucks cup for you. 60.48, down 18. We're at down 1/3 of 1%. The Nasdaq down 1/3 of 1%. Dow is up at 28 points at 44,876. The Russell's up slightly. So this level of the S&P 500, 6,048, but for the week still down 0.9 of 1%, and the Nasdaq is down 1.7% this week. Oil and gold. Gold is up over $5 today. Oil is holding steady around 73.50 here. The VIX is at 1672. The 10-year bond yield, bonds in focus today with Fed Day, 4.54%, and Bitcoin at 101,980, up 0.75 of 1%. Now for a look at some of the top moving stocks in today's market, I'm joined by Jenny Warren, markets correspondent here on Schwab Network. Good morning to you. I know you're taking a look at Brinker rallying to all-time highs after the earnings. Let's hear a little about that.
Yeah, Nicole, I will say that a name that stunned us earlier this week, we were looking at this name on Morning Trade Live saying, wow, I mean, what an outperformer in the restaurant space. So if you liked it, I mean, a few days ago, you'll love it today because now we're up another 16% plus. I mean, just slightly over 16% on this session, which would put it on pace for its largest percentage increase since July of 2020, which is frankly amazing in its own right. Stock's now up 36% this year and up about 20% this month. So in a very fragmented, difficult operational environment that is all things the restaurant space, Brinker has somewhat figured it out fabulously. I mean, I think that hugely this is attributed to their growth at Chili's. And I was actually reading a Raymond James note that said that the growth in the comps we're seeing at Chili's specifically is otherworldly. The chain's comps are up 31% year over year, well above the 20% expected by the street, and also even this analyst's own forecast at around 23%. But the gains did come from primarily a 20% jump in traffic and an unexpected 6.5% increase in mix. So all that should be said that Chili's is crushing it. That's been truly their really brightest spot. But also there was things to like as we saw overall increased traffic. Actually, and looking at the entirety of their comparable sales, those were up 27%. Again, an increase on a year-over-year basis. Their sales growth saw a 20% increase in traffic. And they said that overall, the operational improvements were a huge reason they saw some increase in their value as far as like transaction per consumer. So beat top and bottom line, gave some pretty strong guidance. And Chili's is apparently the restaurant stock or the restaurant part of this stock to watch because that name is continuing to show upside that is even significantly above the already high bar that had been set forth.
All right, Jenny Horn, thank you for that big move there. New all-time highs for Brinker. Good to see you. Thanks. Let's get some insights in the news shaping the markets. Noah Hammond's with us, CEO of Advisor Shares. Thank you for being here. So the Nasdaq's still down 1.7% this week. Names like NVDA down 14%. Vistra is down 19% this week. So while we had a little bit of nibbling on the dip, we certainly haven't recovered the losses. Some of your thoughts about what has gone on this week?
Well, interestingly enough, you guys were just talking about Brinker. That was going to be my focus in terms of talking about what I think investors might focus in on this year. And I was going to craft it around the word themes. Restaurants is one of those themes. We've been trying to promote the idea that there's a lot of investment opportunity in tortilla chips as opposed to computer chips, and hearing the numbers that you guys just described for Brinker International, up 16% today on top of, before this being up 14% with the numbers I had. I didn't know that they were going to beat earnings as much as they did, but that's an important focus. Restaurants over the course of 1 year up 30% versus the S&P 500 being at up 22. 1 year numbers for Brinker is up now closer to 300% as opposed to the 1 year number for NVDA, as an example, up 94%. So, and that's, including their big drawdown that they've had for a few days. So themes we think are going to be important for investors. The 5-star EATZ ETF is the top holding, is actually the EAT stock of Brinker International.
Yeah. I know you have chip stocks in focus. Do you think that there was opportunity? Were you buying when we saw a big sell-off on Monday on the heels of what happened with DeepSeek? And would you continue to buy some of these names?
Well, right, we weren't buying immediately from when the news hit. We were really trying to understand what was going on. It was a big shakeup, right? One of the things that I think about in terms of a chart that I saw last year as we've seen this run up in spending and growth in the AI and the chip space was the number of software engineer jobs that have been declining, right? With AI kind of taking over that role. And so the news that we saw with DeepSeek was a big surprise, right? So little capital, so seemingly few people, and so much software efficiency in a weird sort of way. It's funny that AI didn't, tell us this would be existing out there, and that was much easier to accomplish. So I think for us, it's caused us to reassess valuations, spending. So when we saw the move, we didn't jump right in to buy, but chips and technology and software services, and maybe going back to the themes idea, software programming might be an area of focus this year, knowing that these efficiencies still exist.
So at this point now, do you feel more positive about the year ahead since you are finding some opportunities? I mean, would you say you're more bullish?
Very much more bullish. We think this new administration is going to be all about growth. It might come, though, in some of the areas that we haven't seen historically, especially seeing the impact we saw in the chip and technology space. So I would look at financial services off to a nice start this year. If the market and the economy can, both come back, really probably more the economy, and keep the market where it's at, then there shouldn't be any need to adjust interest rates. Will continue to be great for financial services sector, but look at industrials as well. We think there's going to be a manufacturing and a growth renaissance within the United States. You could still have choppy markets, but we're expecting a much stronger economy this year.
So it's interesting. I mean, you have financial services, industrials, I guess some manufacturing too. When would you say you like tech? I mean, you mentioned some of the chip stocks. We have a lot of the Mag 7 names now reporting, right, this week, next week. Do you like those names?
I still like the names. I like what they've been able to invest in their businesses. I like the growth that they've seen. Netflix reporting their numbers just recently now. Some of those fixes come from them, making sure they're staying on top of things like logins, which have motivated more people to sign up. But you've seen leading indicators show us that I think we're going to continue to see strong tech numbers, but certainly the news of this week would cause some pause to say maybe the spending doesn't have to be quite as much as we think that it does. So I think that's the only question, is where on the tech side of things. But the numbers that are coming out now, I think, will be great. Subsequent quarters, maybe some shakiness.
Yeah. So as you're looking at eats and some of those Brinker names and food, right? You have industrials. You're really trying to diversify because you're looking at the other 493 names and feeling bullish overall. I understand what you're saying here. For 2025, which you think will be an exciting year. On the other side of it, one area that you talked about was maybe crypto, and then you said maybe you backed off on that a bit, or what did the DeepSeek impact on Monday change in your thought process for 2025?
So it probably didn't hit crypto quite as much, and I'm still bullish on crypto this year, especially if there is going to be a U.S. strategic reserve, and hearing more of that at a state level and with other countries and with other companies. It just seems like the pressure, at least around Bitcoin from a crypto perspective. I know there's a lot of other things going on in the crypto space, but we're still bullish there. But that is based on seeing more countries, more companies, the states embracing that more. But certainly chips, right? It would change my mindset on on the chip side for this year maybe being lower than expected, but software services and the companies that provide them, especially in the AI space, being a little bit stronger. But for now, still optimistic and bullish on the crypto and Bitcoin space. I do question maybe a little bit of the premise around it if we are going to have budgets and lower deficits and manage our spending and have a really strong U.S. dollar. Part of Bitcoin's story is to be able to offset that inflationary and that lower buying power that you get over time. But that might fix itself maybe with this new administration. I know that's a big stretch and a big goal, but it's seemingly maybe heading in the right direction.
I want to get to the Fed, but I just want to stay on DeepSeek for one more second. And that is that because everybody was really taken aback on Monday, right? I mean, you always think about there's going to be black swan events. There are going to be sell-offs, and some of them are going to be deep. And, for example, we saw many of those names. I've noted Vista earlier, and we look at Constellation Energy, and some of those names were down over 20%. NVIDIA went down to $117. Can that happen again tomorrow, the next day? Should people be prepared for some big swings when it comes to AI names or any sort of tech names like that? You don't see swings like that in Meta and Apple and Microsoft, but you do in the other names.
You do, and I think that's in part why we are trying to take a measured approach, right? You asked a second ago, did we buy in based on the news? And we didn't quite so quickly, and it was in part trying to understand it a little bit better and the implications and making sure that, we're getting correct and true, information relative to, this app. And so I think it's worth assessing it. Could it be rocky a little bit? Yes. Do you see these companies pulling back in their investments in the growth of cloud storage and chips and automation and artificial intelligence? I don't. I see the spending continuing to grow there and looking for more of that growth. It could just be rocky a little bit. So I would just caution investors to be patient with things like that. And there's nothing wrong, given the gains we've seen in these Magnificent Seven stocks, nothing ever wrong with taking some of those gains off the table and putting it to work in other areas. Restaurants, industrials, plenty of opportunities in the market.
Let me ask you about the Fed. Your thoughts on the Fed's moves for this year? I saw for March, there is now a little more on the side of a cut, right? We were seeing that it wouldn't be till June when you look at using the tools. Now it's looking a little more likely for March. Some of your thoughts on what the Fed may or may not do or what they should do?
Well, certainly don't, envy Jerome Powell in the position that he's in now with Trump in the White House. Trump is going to do what Trump normally does, which is be very vocal about the things that he wants, and he's already come out vocally about maybe seeing lower interest rates. My guess is that was just sort of priming the pump a little bit, right? I think to the extent that the administration sees some weakness in the market and they understand the impact that then, voters see in their 401k statements at the end of each month, they're going to probably manage that maybe more aggressively than they need to. One of their tools is going to be interest rates. So I actually hope they consider not changing them maybe at this next meeting and giving them some more room to work with. But I think that will be a function of how the markets react to all the changes that are coming and how vocal or not vocal the White House is being relative to where they want to see those rates go.
Noah Hammond, CEO of Advisor Shares. Thanks so much for being here. Good to see you. Plenty more to come here on Trading 360. Up next, it's the big three. 3 stocks, 3 charts, 3 trades. Rick Ducat will go through the technicals. Don Kaufman takes us through the trades. He'll look at the healthcare ETF. He'll look at silver, Meta. We'll be right back.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing,
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange, and it's time for the big three. 3 stocks, 3 charts, 3 trades. Rick Ducat will take us through the charts. Here to take us through the trades, Don Kaufman, co-founder of Theo Trade. And we want to get to your trades, of course. But first, with this crazy week, what did you think of the market action? Did you see a lot of opportunities? Do you think it happens again and then there'll be more opportunities?
Yeah, I think this, look, this is just another portion in the series of volatility that we've ultimately seen. And that's not going to go away anytime soon. There's no question that mega market cap tech right now is on the dance floor for some sell side activity. We're starting to see some of that and some of that unwind. And I think we're going to see, again, a huge amount of two-sided trade right now. And it's a difficult marketplace to navigate for more investors, but this is a trader's marketplace. We love it. Lots of two-sided trade.
All right, so you see some action ahead for 2025. Tell me about XLV. We look at the healthcare ETF. Some of your thoughts.
Yeah, the first thought that comes to mind over here is here comes RFK. And in doing so, after he is confirmed, we may actually see a little bit of nervousness inside of healthcare overall, just a little bit of a pullback. As you guys can see in the price action in the chart that Rick is going to show you in a moment, we bottomed out. Some of the fears actually dissipated. I think some of that fear is going to come back very, very shortly here. I'm not asking for a significant pullback, just a very small pullback. I'm putting on a very mild bearish trade, take advantage of what I think is going to be some short-term fear in this marketplace. And I got into the ETF side of things, XLV specifically, because most of your major healthcare companies are going to have earnings right now. I wanted to circumnavigate that, go at the core of basically healthcare. This trade is the February 28th expiration. I am buying a 147 put. I'm selling a 145 put. It's just a $2 wide put spread done for a $1 debit. It's risk a buck to be able to make a buck. Why do you want risk one to be able to make one? Because there's a great probability in this particular case of making that dollar in the trade.
Okay, let's see what Rick says about the charts. You mentioned Rick in the charts. Here we go.
I was never super clear why they chose XLV for this ticker. It doesn't seem to be any V in healthcare here. But V is an important letter for this chart here because we had one big one here and another big one here. So this notable type of swift drop-off and then very rapid resurgence is something that can give us important price points to watch here. So the conclusion of our first V-type shape here gave us these highs right around 147.50. That also matches up roughly with this blue downward sloping trend line that you could draw. So this was a key area here. Then the bottom of our next V gives us the lows. So around 136 is where we bottomed out. We saw a little bit of improvement during the next decline. RSI improved as well. Notably, we did not cross into that oversold area. Then we made our way back up once again, rapidly crossing above all three of our moving averages, 2163, 250 two-day exponential moving averages here. RSI backing off a little bit as we stumble at this old resistance level once again here. And, when we look at a little bit more information on these charts here, we can see that the volume is pretty important for this one here, right around where we are, because we're very close to that point of control, the area of heaviest trading here. To the upside, another node comes in near 149. Then we've got a low point and then subsequent high point to watch out for near 151. To the downside, we've got our moving averages, but first, look out to fill that gap, 144.61. Below that, -1 standard deviation is in confluence with our yellow 21-day EMA. And, this is basically the levels that in question for Don's trade. These old highs to the gap roughly lines up with those strike selections.
Okay, look, as you see this, I don't know why there's a V, actually, in healthcare ETF either. Maybe Don Kaufman does. Don, some thoughts?
Yeah, no, you know what? I actually agree in the 147 half. The 147.50 actually looked back like a 3-year chart, and that actually looks like some pretty good resistance in there. But the one thing, you know, Rick, that you're not going to see in the chart is again RFK, and that's going to generate a degree of fear in the healthcare ETF and possibly cause a little bit of a short-term pullback as he's confirmed in the coming days.
All right, let's check out silver here. Right now, we're seeing it sort of in this, it looks like it's been in this whole long channel for a long time. Had a pop to $31 and change, but the SLV has been, you know, it hasn't been the greatest trade of all time. 1 year, though, is a nice performance. Let's hear what Rick says. I'm sorry. First, Don, silver.
All right, so the silver trade in this particular circumstance is, well, partially because the FOMC meeting today. So what are we going to get out of the FOMC? A lot of indecision. I mean, I really think that's what the press conference is going to be about, indecision. We're going to have to wait and see, you know, what the Trump administration does with tariffs. So there's going to be discussion of tariffs. That unto itself can actually bring metals a little bit higher, obviously going to have influence in the U.S. dollar. So you got the Fed, you've got tariffs. Throw a little treasury debt in there because that's going to be a big discussion over the next couple of weeks. And I think you actually have a really great recipe for bullish in metals right now. And that's exactly what I'm going to do. Now, I don't often just take an outright like long position, but in this case, in SLV, once again, going to the ETF, I'm actually going to go out to the March 31st expiration. I'm just going to buy a 26 call. It's a slightly in the money call, a little further out in time. And I did that to really kind of circumnavigate some of the decay rate of just buying an at the money option. So I went slightly in the money. I'm going to like navigate again around some of the decay rate there. Buy a 26 call. It's for about a $2.22 debit. Again, give us a nice bump higher in silver, maybe in the coming weeks. This trade can even be rolled out in time if profitable.
And look, when you read through, I mean, you always see gold as a safe haven, but silver too. People look to gold and silver during times where they have geopolitical uncertainty. They look to silver, and I know you're talking about the trading of silver, but the big picture is you have tariff uncertainty. That's going to continue to be a big story. Let's look at the silver chart here, Rick.
Sure. So this one a bit more gappy than your typical chart. It is an ETF, so it's got it's a little bit harder to make sense of some of the gaps here. But you know, the general concepts remain the same. So we had this period back here of a rally, then a bit of a decline / consolidation. But this gives us a low point from which we can draw our trend lines, starting at those 52-week lows all the way back there, connecting these subsequent lows. But more recently, it's looking like we've pretty convincingly said farewell to that old blue trend line here. We have left it behind. Now the prevailing pattern looks like it begins here with this uptrend going along these lows and this downtrend starting with those 52-week highs. Now, more recently, we've also broken through this downtrend, it seems like, as well. So this lower, modestly sloping upward trend line is the area to watch. But also look here, we've got this gap that we formed, and then we made our way back up to that area very quickly. We've repeatedly tested it. We filled the gap. We're just primed for a breakout, perhaps, it seems like here, as price makes increasingly higher lows but keeps bumping up into the same resistance. So this is about where the break even for Don's trade would be. That would be looking for a push back above this ceiling here and into further elevated price activity here. RSI also showing a little bit of improvement as well. We lost our green trend line, but we can also see that prices rose not a huge amount, but we had an improvement in RSI and those highs there. So perhaps some steam building up in this name. If we were to look more closely here, a lot going on in this area. The area from 2750 to 28 is a lot of support. That could be a key area to watch. Point of control, moving averages, then our trend line down here, maybe near 2650. To the upside, look to fill this gap here and these low points that we established near 2950.
All right. Thank you for that. Don?
Yeah, that's once again what's not in some of the technicals over there. Of course, it's some of the risks of tariffs, some of the risks of the Trump administration. And really, as I said a moment ago, I think metals are well positioned here for just a little bit of a pop to the upside, specifically on some of those fears. I mean, that's what the marketplace is seeing two-sided trade based on right now. Some of the volatility it's just uncertainty. Markets typically do not like uncertainty. We're getting a lot of two-sided trade in tech, a lot of two-sided trade even inside of the U.S. dollar. And we're going to see a lot lot more of it today with the Fed meeting. Obviously, PCE data coming out later in the week, and always the possibility of a tweet at any moment here about tariffs.
Okay, yeah, exactly. And there's so much about tariffs. You know, is it going to be sort of just set, or is it going to be throughout the years? Are they going to be, you know, ever changing on different sectors? And that seems to be part of the issue and discussion. Let's take a look at Meta reporting today, right? We have Tesla, Meta, Microsoft, Apple this week. Apple will be tomorrow. Some of your thoughts on where Meta could be headed here. 1 year, 70% and new highs.
All right. Well, Rick, you're not going to like this one, but I don't like Meta. I don't have to like Meta. I don't even want to like Meta. You know, throughout the course of Monday and Tuesday, I was making a lot of phone calls to other traders. In fact, a lot of the traders from Charles Schwab, I was discussing this with. How is Meta the beneficiary ultimately of competition from like DeepSeek? And you know, there's not too many explanations that make a huge amount of sense in there. First of all, Meta's CapEx spending is through the roof. The rally that kind of kicked off literally just a few trading sessions ago, I mean, it took Meta really from 630 to 680, just completely unfounded, and that's before the earnings. I think a lot of really good news is kind of baked in here. So unless they hit it literally out of the park, something amazing announced over here, you could see Meta pull back. I am taking an earnings shot and an earnings shot only. What I mean by that is Meta is poised, based on its options activity right now, to move about $50. That's what we term expected move. You have this $50 expected move. Well, I'm actually taking a January 31st expiration. I'm going to buy the 645 puts. I'm going to sell the 640 puts. So I'm buying like an out-of-the-money put spread with literally just to the 31st of expiration. So it's $5 wide put spread. This one's done for a $1.40 debit. It can make as much as what? You know, the opposing side of that, which is $3.60 on the chance that Meta does see some sell-side activity off of this latest earnings announcement.
Okay. He doesn't like Meta. That's what he says. Is he being controversial? Rick, your thoughts?
I can see the thinking behind that. You know, I'm more neutral. I just try to give a chart read one way or the other here. But if I were to think about it too, I mean, the metaverse was a flop. It seems like it was a big waste of money. The VR glasses, no one seems to be super interested in. Social media apps in general, they don't last forever. Remember, you know, MySpace, Friendster, stuff like that. Instagram, Facebook, maybe they won't be around forever. Who knows? I'm not saying one way or the other they're going away, but, you know, maybe it's not as rosy of a picture as it might feel like. So when we look at the chart, though, I mean, it's hard to argue with the price action. It's going up pretty strongly here. We had a repeated ceiling at this level near 597. We had this low point right here. Put them together, it gives us a situation of increasing lows with consistent resistance at a high point here. Kind of the thinking behind an ascending triangle type shape. It's not really an exact pattern that matches up with that, just kind of that general thought there. So we can see as well, though, from this high point, we had a little bit of a give back here. Then we pushed up pretty strongly into some new intraday highs yesterday here. RSI also broke that trend line and pushed into the overbought area. So if we were to look at some other key price levels here, well, we'll have to stretch out our chart a little bit to look up at that +2 standard deviation channel coming in near about 723 or so. That could be one upside area to watch. The +1 channel comes in near 667. Beyond that, though, these old highs, 638, that seems like an obvious point to keep an eye out for a potential pullback. And then, you know, then it's up to you. Do you decide that the trend's going to continue, or is it a false breakout that's going to collapse?
Okay. Thank you both so much. A good look here on the big three today. We looked at the XLV, silver, Meta, did some charting, got the trades, and we'll have more trades later in the show, for example, on F5. Thank you, Don Kaufman. Thank you, Rick Ducat. Great to see you. Coming up next, stand by because Rebecca Walzer is here, 360 Spotlight. We'll talk about, first of all, her call from last year about moves of 30%. She was thinking a sell-off 30%, particularly in AI stocks. We got a lot of that on Monday, but she does have some stock picks here in the current market. We'll be right back.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage and insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Welcome back to Trading 360. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange. Glad you're with us. It's time for our 360 Spotlight. She's back. Rebecca Walzer is here, president of Walzer Wealth Management, to take us through her thoughts on the big sell-off, which she was talking about, a big sell-off. We'll get to that, and some stock picks for your portfolio. Good to see you.
Great to see you, Nicole.
So this week I pinned something that you and I had discussed last year in the fourth quarter. You were saying 30% sell-off, 30% sell-off, particularly in the AI names. You were expecting a slowdown. Was that it? Was that sort of what you were thinking?
Yeah, I mean, I think Monday was a lot more price action focused around what was going on with DeepSeek, and I don't think that is exactly what I was talking about. But what we have, and to explain it as simply as possible, is anytime there's new technology, and I'll give credit to Alan Greenspan, because that's the .com. Anytime you have a new frontier of technology, Nicole, I call it irrational exuberance, because before monetization, when you see it take off and be capitalized with really high price earnings ratios because it's not monetized yet, then you know you have irrational exuberance. And so my whole point is that the runway is here for AI, robotics, quantum computing, and blockchain. However, it's not yet monetized. It's still in the R&D and implementation phase. And so until it gets monetized, we will continue to see volatility and we will continue to see pullbacks.
So a day like what we saw on Monday, where you saw NVIDIA down, Vistra was down over 20%. So many names were down over, 15%, 20%. Do we see a day like that again, or do you say those are the buying opportunities?
I mean, those are buying opportunities. I think that the equity market right now is overbought in general. I don't really support the PE ratios that we have based on the fact that a lot has not yet been monetized. Once we're monetized, we're off to the races. There is going to be a change, a sea change of the entire way we do everything. So once we're at monetization stage, the PE I'm not concerned about. But as we're getting there, that is a concern. So, the thing is that yes, little things like this can come out, Nicole, whether it be in Taiwan with chips or it be in China with AI development that doesn't require all these expensive, whatever it is, that shows you how fragile this frontier is. That's what people need to understand. It's still not monetized, and so it's fragile.
So with an equity market that's overbought, and I guess you're referring to not just the NASDAQ, you're talking about tech stocks, but the S&P as well.
Absolutely, yeah.
So what is someone to do if you're saying it's overbought? I mean, should they just keep buying on dips, or what do they do in 2025? And then I want to get to the stock picks.
Yeah, I mean, it depends on where you're at as an investor, right? If you want short-term price action because you're just really looking to be aggressive and get some, there's growth, there's movement, there's stuff that can be traded, and actually you can make money, and that's price action. If you want something that's more long-term and you're not really concerned about the volatility, buy into NVIDIA, buy into some of these AI companies, but know that, hey, I'm not going to look at this for 5-10 years. It's going to be a long-term runway. And if you want more
more results sooner if you're more income based, then you're still going to have to look at your value stocks that are not a part of NASDAQ.
Right. I get what you're saying. So you have a few names you brought to us. Snap is on there.
Yep.
Why did Snap jump out at you?
We think that Snap could actually really benefit from the TikTok situation, with this IT kind of situation going with TikTok. Right. Snap has like 443 million active daily users, whereas obviously TikTok has 1.5 billion. So if TikTok doesn't get bought, we think Snap has a great upside potential, but we also do think that if there's any kind of consolidation, if another IT company buys TikTok, then we do still see Snap having a competitive edge because of where they are.
I mean, this was $17 almost a year ago.
Yep.
Now it's $11.
Exactly, and it's off. It's off of its.
The upside potential. I mean, do you think it can go back to the highs?
I mean, it's got 9% growth year over year, and so we think that it is in a good position, and it is, it's really off of its all-time high. Revenue $1.55 billion in the quarter, so I think it's a potential good buy.
All right, let's take a look at Fortinet. Also here, this name hit a recent high of 101. 1 year, well, I'll do 6 months. It's up 72% in 6 months.
Yeah.
Some of your thoughts on Fortinet?
It's some of the cheapest cybersecurity that has integrated AI, Nicole. So if you're looking for, hey, what are the ancillaries to AI as it becomes monetized and usable, then you're going to look at companies, cybersecurity companies that are really bringing in AI to the front. And we're starting to see a lot of enterprise development of Fortinet because of their integration of AI. So they're kind of on the forefront of that, and that's why we're picking them.
Yeah, and it's interesting because this was really exciting. I'm actually pulling out to see a 3-year chart. Yeah, you know what? It's still, the 101 is still the highest in 3 years.
Exactly.
Because it was so in favor, and then it sort of really crashed down, and everybody was scratching their heads, but it's back.
Yeah.
And it's definitely a winner and has had some great momentum.
Yep.
Last but not least, you have Lockheed Martin.
Yes.
Aerospace and defense. What's the thinking behind this?
So Lockheed took a $1.7 billion write-off in 2024 that was unexpected. It hadn't been expected to be written down that fast, so they really came off of their high. They missed EPS in a big way, so this is a big dip buying opportunity. Literally, they are 26% off their all-time high, 9% off of their most recent high. They have a PE of 18, so we still think that the PE is reasonable. And their dividend, Nicole, even with the write-down that was unexpected to take in 2024, they're still maintaining a $3.30 dividend a quarter. So if you're looking for value, long-term growth, and obviously with the Republican administration and this being a defensive sector area, we feel that Lockheed is going to do well in the next 4.
So when we think about the S&P, just a sort of final thought, we had 2 20% years. No one could have anticipated that.
Yeah.
Now what? Do you think we could have a winning year on Wall Street? I know there's uncertainty with geopolitical events, tariffs. No one knows what happens there. The S&P for the year, do you think it's a win?
Gosh, it's so hard. I would say that with the Trump 2.0, someone who now understands how the sausage is made and doesn't have to get reelected. So this is a very different administration than we saw the first time around. Very, very big into deregulation, a big projection of M&A activity, Nicole, as you know, for 2025. However, all of that being said, I can tell you there's a lot of bad actors in the world that are really anti and this administration and anti-American dominance of AI, cyber, everything. So I think China's going to give us a really, really push this year, and we will see. We will see if we get this market is priced to perfection. Anything that does not come out perfect is going to be disruptive, and you should expect disruption just like we had Monday. That's what I think this is the note. Hey, we can win, but we are very fragile. So any disruption, and watch out.
All right, Rebecca Walser, great to see you. Walser Wealth
Nicole.
Management. Thank you, Rebecca. Coming up as we talk about disruptors, how about F5? So we saw the earnings. It's been a winner. It got a lot of price target raises, new highs, and George Stillis is standing by. He'll break down the numbers. He'll also have an example trade for us on F5. We'll be right back.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage and insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Welcome back to Trading 360. It's time for the disruptors. George Silas is here, senior markets correspondent, taking a look at today's company, and that is F5, which is hitting new highs, had blowout earnings. You know, that's how they are referring to it in the headlines. You know, what did you make of some of the numbers as you comb through them?
Yeah, I think they're actually quite exceptional. I mean, if you consider the market that F5 participates in, it's essentially an enterprise network hardware and software company. And, you know, there are obviously some problems with NVIDIA right now associated with that company being the lead architecture or architect in the parallel semiconductor space. But all of the AI that's going on right now is being commoditized, and all that data needs to be transmitted through networks, and that's essentially what we're seeing with companies like Juniper Networks and F5, Cisco, Aristanet, which is a large network gear provider as well over the past year. These stocks have performed very well, and I think there's potentially some additional room going forward in this particular space, but also in the software space as well, which F5 also participates with application security and load balancing software for hybrid cloud environments and data centers. But if you look at the report, the numbers were actually quite good, even prior to them beating both sales and earnings. But the estimates were $3.36. They came in at $3.84. That was 32% higher than last year in earnings growth. And if you look at sales for the quarter, Nicole, they were higher by about 12% to $766 million. Now, one of the things you'll notice is that the stock is moving, you know, aggressively to the upside. It's quite volatile on an intraday basis, but if you look at the analysts as well, some of them are upgrading their price targets, but keeping essentially a market perform rating. For instance, Jefferies increased their target to 315 from 225, and they maintain a market perform or hold rating. And Piper Sandler also maintains a sector weight or a neutral rating at around $304. And the reason being is if you look at the growth estimates for F5 moving forward into 2025, they're still expected to grow. It's just they're not going to be seeing the growth that they actually saw last year. And so therefore, we may end up seeing sort of a stationary balance in trading, even after a nice run up over the past year, higher by over 60%.
Yeah, and look, we're seeing the whole group with up arrows, but nothing like the way F5 is performing on the heels of the exceptional earnings that you're talking about and the strong guidance. So how would you go about an example trade today, George?
Yeah, Nicole, if you look at the price action today, it's quite volatile. And I think overall, based on today's trading range, there's a possibility that the stock will retrace back towards about the midpoint of today's range, which is essentially roughly around $290. So what I'm going to do is I'm going to go out to March with 51 days to expiration. I'm going to sell with the assumption that the stock could retrace back to 290. I'm going to sell a bull put spread. It's basically selling a put vertical for a credit. I'm going to sell the 290 put. Then simultaneously, I'm going to buy the 280 put below that. So we're going to do this or sell this for a credit of $250 a share or $250 a contract. So in essence, the whole objective is, time value or time decay, an erosion of that premium to zero under the assumption the stock stays above 290 by expiration. But you have to consider that the reward of 250 needs to be offset by the risk, which is 750. And that full risk won't be an occurrence or won't occur unless the stock hits 280 or lower by expiration. So it's bullish trade, but it allows some flexibility and pullback in case it does come back to the 50% point of that trading range today.
All right, George, thank you so very much. Every day looking at our disruptor and with an example trade. George Silas, thank you. Coming up next, our 360 round, all about Starbucks. You had Brian Nickel come on, obviously a lot of confidence in him to lead the way. There were some bright spots within the report. You had a beat, new yearly high. Now what, though, as we look at 2025, And we have our panel ready to have this discussion. We'll be right back.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
It's time to look forward
Find the next trend.
from every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Welcome back to Trading 360. It's time for our 360 round. We bring in our panel to talk about Starbucks, and a lot of folks believing in the progress, believing in the turnaround. You see a lot of analysts raising their price targets today after the company came out with its quarterly numbers. The same-store sales still dropping, but January saw the most traffic, so there are bright spots here. Andrew Charles, equity analyst at TD Cowen, and RJ Hotovy, head of analytical research over at Placer AI. Thank you both for being with us. So I'll start with you, Andrew. What do you make of it? Is Starbucks a win? It's up 6.5% today.
Yeah, absolutely. Steps in the right direction. And so we were really pleased to see North America same-store sales that down 4. Investors were basically there, but a hair better than consensus at down 5. Beat driven by international. And what I think you're really seeing in the stock today is these improvement in January, their expectation for the fiscal second quarter be positive with same-store sales, overpowering increased G&A investments behind the new corporate restructuring they're going to be doing, with unfortunately some layoffs coming as they streamline the organization. So good to see in the stock today progress with sales overpowering the increased G&A.
And what's your price target right now? It's at 106 and change. What's your price target right now, Andrew?
Yeah, we have a $115 price target. The way we get there is we put a 25 times FY2 PE, which is their normalized level, on our 2027 numbers. So we're looking through the foundation year. We know that 2025 EPS is going to be challenged by investments and challenged sales. That's going to really weigh on the earnings growth of the company. We look through that, and so we're putting an FY2 multiple on FY3 is the way to think about it.
Okay, look, a great move here. 107 was the high. This is a 52-week high. There's been a lot of belief in this name. RJ, your thoughts?
Yeah, I think a lot of my sentiment is similar to Andrew. What we liked is there were some real positive silver linings in the quarter. First off, we saw traffic increase among the non-frequent visitors, so your more occasional Starbucks user, as they were pulling back on discounting. That's a real positive indicator for this company going forward. It shows that some of the throughput and bottleneck issues they're working through. And more importantly, this has been an area that they had started to lose customers to other chains. So I think that's important to take on. They also saw improvement during that morning day part, that breakfast day part. Starbucks, that's traditionally been their strongest day part. It had been a little bit weaker the last couple of years. That is where we saw growth into it. And as Andrew mentioned, we saw sequential improvement as the quarter went on, January being the best month for performance. Some of that is year-over-year trends with weather last year. But all in all, there's some really positive indicators that Brian Nichols' plan is starting to work. It will take time to fully translate into sales and earnings, but there's a lot to like from this first quarter that he's been with the company.
How do you like them saying that they're going to reduce 30% of the menu? It's too complex. It's going to include food and drinks, too much, too busy. They've been trying to reduce the wait times when you order something, and they don't want to be a public bathroom. They want to be back to the cool coffee vibe. Andrew, your thoughts?
Yeah, so on the SKU rationalization, you're right. It's 30% of ingredients or food and beverage items. And so it's not 30% of sales, to be clear. They are expecting a modest impact to sales, though. They hope they can get some sales transfer instead. The impact to profitability and margin dollars, though, the goal is to be neutral there. And so I think what you'll see is that a short-term, we've seen this before in the restaurant industry, a short-term impact to sales, but that should rebound. The neutral impact to profitability, though, will be better. It'll improve speed of service, and so I think this is a pruning the menu that's frankly overdue. So we're pleased to be seeing it coming. And look, on the bathroom issue, if you will, look, Starbucks obviously ran into some trouble in Philadelphia a few years ago. It clearly seems to me to be a friction point for the baristas, that to have anybody allowed in the stores at any time, something that they, a win for the baristas, if you will, that makes it easier for them is where I think is the move there.
There was a safety issue, particularly after COVID. The pandemic brought a lot of quiet times and folks into places that may have scared baristas and things like that. We were reading about that. Maybe we've passed at least some of that. RJ, when you look at this name and this group, you have Starbucks, which seems to be making progress in the turnaround plans. People are giving it a pass, it seems, across the board. I mean, for example, Andrew has a $115 target. What names are you following most closely right now as winners right now, RJ?
Yeah, I think we're continuing to look at a lot of the fast casual players where not only strong unit growth, but we're also seeing great visitation trends in new markets. So that would include groups like Cava, Sweetgreen, Chipotle continues to do very well as they push into secondary and tertiary markets. So I think that there's that fast casual trinity that continues to hold it very well. Casual dining is another area that we continue to see strength. Obviously, last year was all about Brinker and Chili's was a big story, but we're starting to see some rebound from some of the other groups in there. Applebee's starting to show some interesting numbers there as well. So casual dining is a space that's seen some challenges, but we're starting to see some indications that people are trying to get back out there. So a lot to like across kind of that upper end.
Andrew, you got to have folks spending. We were noting that the discounts, they pulled back on some of the discounts, and that at least helps sales. And I don't know, I never saw any discounts, and I'm a Starbucks member. I don't go there often, but I don't really see the discounts. Today I went, looked pretty nice in there. And so the final thought here, Andrew, which names are best positioned in the group? I know you cover other names. You have this one here that you think has upside potential, and the others that you like, Andrew?
Yeah, first of all, the proof point's there. I mean, you went to a Starbucks without a discount or without a promotion, so there you go. The strategy appears to be working. Our top idea is Dutch Bros. It's also a coffee shop player, ticker BROS. We're really excited about the drivers they have in place around mobile order that just launched at the end of third quarter. Food will be coming in 2026. And then longer term, we're bullish on the coffee shop category. We did a deep dive that we published about a month ago, really focused on the fact that there's a generational opportunity with coffee shops, that caffeine consumption increases as consumers age. particularly going from the 18 to 24 age cohort to 25 to 39 as that consumer enters parenthood and enters the workforce. And so in an aging U.S. population backdrop, the aging of Gen Z, where Dutch Bros skews more to Gen Z relative to Starbucks, though we think Starbucks will have some benefits as well from this, really a big opportunity to windfall, specifically as iced beverages as well as digital ordering are things that will keep the customer sticky at coffee shops.
All right, Andrew Charles, RJ Hottovy, thank you both. That's going to do it for us here on Trading 360. Thanks for being with me. I'm Nicole Petalides. Dow's up 6 points. Fast Market is next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Join me, Oliver Rennick, alongside Schwab Network's options experts as we explore the second derivative. Gamma On is a brand new limited series to take your trading skills to the next level. Subscribe to Schwab Network's YouTube channel now. Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage and insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome to Market Overtime on the Schwab Network.
Quality focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
Good afternoon, traders, and welcome to Fast Market here on Schwab Network. I'm Diane King-Hall. I'm in for Tom White. Kevin Hinks will join me shortly. It's a pivotal day in the markets, and we've got a packed show ahead for you. Microsoft, one of the big names, reporting earnings today after the bell. We've got a few from the Mag 7. We'll preview what's ahead with Kevin Green and bring you an example trade. The team over at Folio is bringing its proprietary data on Tesla ahead of its earnings report. Now, Tesla shares had a big run up, you'll recall, post-election, but are down 20% from all-time highs hit in mid-December. And shares of MasterCard hit an all-time high yesterday. It's not just about Meta these days or what's happening over in the tech sector. This for MasterCard happening ahead of Thursday morning's earnings. We'll get a closer look at the state of consumer, breaking down that name with George Sillis. But let's start out with a broad check on the market action just after noon Eastern time. You're seeing investors take some chips off the table ahead of the decision from the Fed later today, and really the commentary from the Fed with regard to the path forward for interest rates for 2025. So you're seeing the S&P 500 a little lower right now, down by 0.3%. Dow flat at the moment, really not moving the needle much at all. NASDAQ 100 off by 0.3% as well. Small caps flat at the moment as well, mirroring some of the movement that we're seeing in blue chips. I think it's a good time to bring in our co-host, our Fast Market co-host, Kevin Hinks. He's over at the CBOE. You know we've got you covered from exchange to exchange. Kevin, what's your take on this market movement ahead of the Fed? It seems like kind of par for the course, what we usually see on a Fed day.
Yeah, a little nervous, Diane, a little jittery ahead of so much coming out, right? Think about this, between 2 o'clock Eastern today and the close Friday, that is a gauntlet of large cap tech earnings and economic data and a Fed meeting as if there wasn't more. So there is so much going on that a little hesitation, a little nervousness ahead of that is perfectly warranted. Now, we still have to trade these markets, and we're going to figure out, but so much is going to be talked about. Remember, we were going to be talking about CapEx and the significance of it before DeepSeek, jumped onto the market on Monday morning and caused such an uproar. So I think there's a lot. Remember, we still have, after the earnings that we get, tomorrow we'll get GDP in the morning. First look at fourth quarter GDP. We'll get Apple's earnings after the bell. I think Visa and MasterCard, one that we're covering today, are a huge look at the U.S. consumer. Then we'll get personal income and outlays, inflation data on Friday. That's another important one. Why? Because right now the expectations are for headline year over year PCE to be up 0.2 from 2.4 to 2.6. Core to stay flat at 2.8. There's a lot going on here, Diane, so a little nervousness before we get into some of the data, perfectly acceptable.
Agree. And it's not like we're missing any catalyst to dive into today, although really the slew of it comes this afternoon, or the bulk of it comes this afternoon. Joining us now, though, we've got Schwab Network Senior Markets Correspondent Kevin Green. KG, when you think about, you have your finger on the pulse of what's going on. There is still some leadership, but there's some laggards. Tech seems to have turned, especially given how things started out today's session. What stands out to you the most in terms of what you're watching today?
Yeah, I mean, Kevin already called it out. It's defensive positioning, and you can see that with the advancing sectors today. Financials catching a bit, up about 0.5%. Utilities about the same, and actually consumer staples, they're all up about 0.5% right now. So this looks like more defensive positioning as we lead up to the Fed meeting, and this is not out of the ordinary. Sometimes we do see these 25-point or 30-point ranges to the upside and downside before we get to the actual Fed meeting itself. And so until we get that, I think you kind of play that range-bound trade. There is some commentary coming out of Capitol Hill right now, which I think is kind of very interesting. Robert F. Kennedy Jr. is doing his confirmation, and then the Commerce Secretary also had some commentary around tariffs that caused a little bit of volatility in the markets. You had the Bank of Canada also giving out their rate cuts as well as their commentary, and a lot of their commentary was around the tariff policy itself. So some intraday news that might be causing a little bit of pressure, yields moving up to the upside here a little bit, but not out of the ordinary when you see a 25-point move to the downside or even a 30-point move to the upside before a Fed meeting. And usually we come back into balance right before the announcements actually released. So I wouldn't be surprised if we actually see a nice little bounce back and we're almost flat by the time that they actually announce.
Yeah, KG, I'm glad you brought that up into the conversation because, Kevin, I know you've pointed this out before, that we're in a period of time, like we were in the first Trump administration, where you'll get a lot of reaction and you have to pay attention to those headlines that come out of Washington. And I know we're not expecting a rate move from the Fed today, but over at the CBOE, Kevin, what are you waiting for, bracing for? What does it seem like the CBOE is bracing for from Powell's remarks later today?
Yeah, we got to go one thing at a time on days like this, right? Before we get to Tesla and Microsoft and Meta platforms after the bell, we get Jerome Powell at 2:30 Eastern time, 1:30 Chicago time. So that's the first market moving event. And they're not going to move on interest rates. And historically, this wouldn't even be a press conference, Diane, but the new Fed, the new, more transparent Fed, he's going to stand up there and answer questions. And I think he'll try to get in and out of there, like you and I talked about this morning, Diane, without saying as little as possible, right? Read from the same script. We are data dependent. We're watching some of the numbers. The economy is strong. He's going to give an outlook that the market will probably react to. And then when that dies down, just as that seems to simmer down at the bell, we'll get Meta platforms, Microsoft, and Tesla. And that you've got three different views on three different large cap tech names, and they're going to come out and play out, right? There's kind of a negative sentiment, as you mentioned, with Tesla as it's come down off its highs. There's really positive sentiment about Meta platforms, and then there's who knows about Microsoft, right? That can go either way on their earnings. So that's the way I'm seeing the market lay out the rest of the day. Jerome Powell, and then large cap tech at the end of the day, Diane.
KG, when you think about the Powell presser, I mean, I think one of the Fed itself is not a wild card typically, right? We kind of, especially now, as Kevin mentioned, we have a more transparent Fed. They kind of telegraph what's going to happen before it comes. Sure, we won't get the SEP this time around, but, you know, we know at the last press conference, we got that language that was introduced to optionality. I wonder if you're expecting the continuation of that language, leaving the door open for optionality. But then there's the wild card of the unpredictability of the Trump administration and the pressure that comes from President Trump about interest rates. How much do you think that's going to weigh in the press conference, KG?
I think if he gets asked the same question 3 or 4 times, I think that'll probably wear him down, where he might be a little bit more, I don't even call it aggressive, because he's a really good speaker, but that might maybe get him to relax a little bit more. Maybe he says something that kind of goes outside of the bounds that we're usually used to when it comes to Chairman Powell. And you have to give the Trump administration credit too, right? I mean, they're only, a week and a half in, so you're not going to get all the policies out there. I think Chairman Powell will probably acknowledge that as well. I think the key is around forecasting moving forward. Are they already kind of putting into place maybe a 2 to 2.5% tariffs across the board? That seems like that's the commentary that we heard from the administration, some of the members yesterday. Are they going to put that into their forecast? And I think he's going to say that they're data dependent until the data shows otherwise. Either you see a crack when it comes to economic growth, or you see a crack when it comes to inflation to the downside, or the labor market, falls off a cliff here. I think they're going to stay on the path that they're on right now. What is interesting today, the Atlanta Fed GDP now did see a substantial drop, though. It was sitting at around 3.2%. Market was expecting 3.2%. That was dropped down to 2.3%. And that's after the Advanced Economic Indicators report came out from the Census Bureau. And they actually indicated that they saw a substantial drop in exports in December compared to what we saw in November. And so you could say, all right, well, GDP might be moderate. This is the last estimate too. So if GDP kind of comes down a little bit more in line, doesn't show that it's running as hot, you could make the case that, hey, maybe we are a little bit closer to a rate cut. But there's a lot of wild cards that are still out there.
That's a good point. Yeah, that's a good point, because I talked to an economist earlier today that she said there are some troubling things in the economic picture, but her projection is we won't start seeing rate cuts until the second half of this year, and her projection is 3 rate cuts. Do you think, I know, Kevin, you said that we take each of these things that we're going to get today, the Fed decision, the mega cap tech earnings, piece by piece, but KG, I want to hear your perspective on if you think that it will be a bigger catalyst for the market, especially since we get these earnings after the bell today, the Fed.
I think the bigger catalyst is that Jerome Powell says exactly what the market's expecting, where we are not really trying to have a little bit more of a hawkish tone. If it comes in measured, I think the market's going to rally off of that. If he has a dovish tone and comes in more like Waller, then I think that's where we really rip. And you can actually make the case on the options flow standpoint that 6130 could be a pretty key area for us to potentially touch for today. So that's where I'm at with the market. And then once we have this report, the headlines are going to be around mega cap tech, and we'll get down in the nitty gritty when it comes to the earnings data. But I feel like it would be a very big shock if Powell comes in and tries to knock this market down again. And usually we don't see back-to-back knockdowns of the market because of a Fed presser. You know, we already had a drawdown of what, a 1.5%, 2% down day last time around. Usually the market's prepared this time around.
That's a good point. And Kevin, I know that you've talked a lot about this DeepSeek rattling that we got at the beginning of the week. It was kind of the biggest wild card, speaking of wild cards, that we've had so far. How much do you think that will impact what we hear on these mega cap earnings calls?
Well, originally, right, the theory is that if DeepSeek can lower the cost of AI, that would make less need for CapEx spending, or you can spend less of it, or your dollars will go further. Now, the whole DeepSeek thing, that whole topic is really coming under a lot of question. How many chips they use? How much is it really 5 or 6 million? There's serious doubts being thrown at that. Now this morning, the news that DeepSeek was taken off the App Store and the Google Store App Store in Italy. So there's so much doubt around what's going on with DeepSeek that there's just uncertainty there. So I just think, but I don't think that'll stop the questions about CapEx and is cheaper AI better for these companies. For the users of these companies, it's actually much better than that. But the surprising part of this is NVIDIA's trade, right? Because DeepSeek, no matter what they're doing, they're not a competitor of NVIDIA. They're a customer of NVIDIA. So there's the kind of the question comes in about margins and how many they're going to sell, and do they use less chips? We all know that eventually AI is going to slow down and CapEx spending is going to taper off towards AI. But there's no signs of that happening right now, right? Microsoft, 80 billion. Meta Platforms, 65 billion. Stargate, 500 billion. So all that really does is push out that, when that deceleration may happen into 26. Is it closer to the end of 26? There's what everyone's trying to wrestle with now. And there's uncertainty. There's the biggest thing. There's uncertainty now around what looked like such an obvious trade, and that is probably hitting the price of some of these AI companies.
Speaking of these tech companies that we've got to focus in on today, I mean, we're hearing from a significant chunk of the Mag 7 KG. Which one do you think has the most riding on their earnings report today, especially when you think as a group they're expected to deliver growth of more than 20%? And you compare that to the rest of the S&P 500, it seems like it's a lot riding on it, but which one matters the most today?
I think it's going to be Microsoft because they have the cloud exposure. I think Azure estimates right now looking for around 30 to 31% year-over-year growth. So that's going to be key. That kind of ties into this whole AI narrative. And then they also have the software offering with Copilot. And what's the take rate with that? What's the profitability? Are they seeing any type of issues? Are they seeing a rapid amount of adoption when it comes to the enterprise there? And so this is actually probably going to give us the most insight today out of all of them, in my opinion. for this AI trade and this AI narrative. You know, I do have to just comment too, as time goes on with this DeepSeek story, there's a lot more, there's some things that are coming up that are a little bit more questionable that I think we just need to have a little bit more time to really try to develop and see if this story is actually what we're told initially. And if it's not, then I think there probably could be a reversal trade for a lot of these hardware names, but something doesn't add up, Diane.
Something, potentially some fuzzy math, or to use a term I've heard thrown around down here, a little fugazi business. All right, but I think that's a great point for us to head to break. Coming up, though, KG just talked about one of the big heavy hitters that we're focusing on today. Microsoft set to report earnings. We'll get a first look at that after the break. It reports after the close this afternoon. The stock, though, has been range-bound over the past 6 months. It's up just 10% over the past year. We'll preview earnings, and Kevin Green will have an example trade. That's on the other side of this break.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Schwab.
Have a choice in how you invest with Schwab.
Welcome back to Fast Market. The microscope is on Microsoft today as it gears up to release its latest quarterly numbers. But there may be more questions than answers. Besides its results, the street will likely have questions about DeepSeek. We were just talking about that. Let's bring back in Fast Market co-host Kevin Hinks. He's over at the CBOE. I'm here at the New York Stock Exchange. We also want to bring back into the conversation senior markets correspondent Kevin Green. All right, KG, you just kind of teased this a little bit when you think about the focus when it comes to its earnings. It's expected to report EPS on an adjusted basis of $3.11 a share. Revenue is expected to top $68 billion. But you say Azure is the metric to watch. Tell us a little bit more about why you expect that to be the focus.
Yeah, well, if Azure is able to hit that growth rate of around 30%, now the year-over-year comps are going to be a little bit distorted, which is why you're going to see that amount of growth in some respects here. But if that's going to be the case, it probably is going to be the fastest grower when you're looking at compared to Amazon or even Google Cloud on a year-over-year basis. And so I think that also kind of aligns with the fact that not only just ChatGPT, but Copilot and some of the other AI offerings are actually doing exactly what they expected. And if that's going to be the case, I think that's going to drive top-line earnings as well as profitability. And this actually keeps together their OpEx story moving forward. I don't believe that we will hear about any adjustments around OpEx from any of these companies, especially when it comes to Microsoft, just because the dual use for those GPUs that they're getting from NVIDIA, they can utilize them for training which a lot of these companies have already done. And they can also utilize them for inference. And so this is going to be actually a tailwind for Microsoft moving forward. Even if the prices for those GPUs actually go to the downside, that'll actually help them out. And I think they're trying to make a long-term run here when it comes to not only AI, but also the cloud space. So, there's a lot of opportunity here. The stock does not really do that well when it comes to earnings just in general, because their executive team is very, very conservative and usually has kind of a dark cloud over the economy and their outlooks. And the market usually doesn't like that. But I think the underlying numbers that they'll report today might be pretty decent.
Kev, a lot of the discussion topics about DeepSeek and what they're going to do to AI spend, everyone expects over time the cost of AI and chips and efficiencies to come down slowly. People are talking about, 5 to 12% AI costs starting to come down, but not to the levels that DeepSeek is talking about. I think that's the key talking point. Remember, Microsoft made headlines a couple weeks ago with $80 billion projected CapEx spending in 2025. Obviously, that's going to be the first question they're asked. What does this DeepSeek do for Microsoft? Does it change? This may be one of the first comments, Kev, on, hold on, we're not ready to go with a Chinese company to enhance our AI. We're going to do it, ourselves, and we're going to spend $80 billion, and the costs will come down over time, but not yet. Kev, your thoughts on that topic?
Yeah, there's a lot there, man. So I'm going to try to keep this very concise. Once again, I think that this story has to really kind of develop. And I think you're also kind of seeing this when it comes to Meta. ChatGPT's already had a little bit of commentary when it comes to DeepSeek, and I'm sure Microsoft is also going to have some commentary. That $6 million number also does strip out a lot of the different comparables that we have here in the United States. And I did, hear this commentary yesterday, and it does make sense. If you think about the cost of compute, it for the most part actually goes in half or gets cut in half almost every year. So if you kind of equate it to what ChatGPT rolled out the first time around, which is around $23 million for that offering, and they were able to launch that same offering today, that would bring it to around 10 million, let's say $9 million. So there's also an unfair comp when it comes to compute cost that DeepSeek has the advantage of right now. And I think a lot of these hyperscalers and these companies really do know that. So I don't think, once again, they're going to take this story at face value. I think that they're just going to continue to move forward when it comes to their CapEx spend, really talk about the outlook here. Because if it is true that they actually did lift their models, a significant portion of their models from ChatGPT, and also utilizing some of the answers from ChatGPT to train its own models, that also will reduce compute costs as well. So there's a lot of factors. And then you just so happen to have Baba kind of like release their model today. There's a lot that's going on there. I think they're going to stay the course for right now until they actually get more clarity as to the landscape. I'm not sure analysts are going to appreciate that, but I do believe that we have to discount some of these some of the things from DeepSeek. There's a Singapore element that's in there. The whole thing, it's really murky. And I don't think any good executives are going to take it at face value as to what we heard over the last 24 hours.
Yeah, I think so. I think you made a great point. I know we had a conversation earlier about not expecting to see a major shift in, say, spending plans as a result of this, because there's just so many murky details around this. And then we've seen the reports like you, KG, about them lifting some of their data from ChatGPT. But given the context of this and given the earnings coming up for Microsoft, KG, how would you go about structuring an example trade?
Yeah, usually, Microsoft doesn't really hit the mark when it comes to their commentary and their outlook. We usually do see a fade if you look over the last 3 years here. So I'm actually looking at a bullish trade, but something that's pretty far out of the money here to try to avoid any type of drawdown in the market. So this is actually selling a put spread, looking at the 420, 410 put vertical, selling the 420, buying the 410, doing this for a credit of $1.15. Max loss on the trade is going to be $885. That's the difference between the credit from the spread width. Max profit $115 with a break-even point of $418.85. From a technical standpoint, that 420 level is actually very key, and we've seen some buyers kind of step in here before, even if we do get a break. And if the stock actually does not make any type of movement or moves to the upside, this is where this trade would actually max out when it comes to profitability. And then you also have the ability to readjust the trade if there is some form of a massive gap to the downside here. So trying to take advantage of high IV, low probability of it being at the money or in the money, while also getting some upside potential.
Yeah, Kev, almost an 84% probability that the 420 put will finish out of the money. That is, in the higher end of the range. And that's what the high, tell our viewers, Kev, what you're thinking, because that, the high implied volatility that you're seeing in this front expiration, when you get that, it allows you to move that strike further away from the money, making it a higher probability trade and still collecting, $1.90 on the 420 put, $1.92, still plenty of profit to be made. Not as much, remember, you get more if you move that strike closer, but that lowers the probability. So a pretty high probability trade here, Kev, for a short put vertical. Your thoughts?
Yeah, definitely. And looking for that IV crush after the earnings announcement.
But that lowers the probability. So a pretty high probability trade here, Kev, for a short put vertical. Your thoughts?
Yeah, definitely. And looking for that IV crush after the earnings announcements. I want to kind of preface, Microsoft really doesn't do that well when it comes to earnings, right? There might be a pullback here, but the risk reward is that the pullback will not be as aggressive or get to that short strike. And then you have the IV crush after the event, and then you can actually take the trade off. This probably wouldn't be, from this example, a trade that you would hold until Friday unless you have a massive bullish move to the upside, but it does allow you to kind of take the trade off. You have the IV crush, meaning implied volatility goes lower. You have event risk, obviously subsiding to the downside, and that's where you actually get a lot of the profitability for this trade. And once again, if you do have something that goes awry, you have a move to the downside, you can also readjust this trade and try to minimize the losses, if you will. And I just like to align my trades with the examples with technicals, and that 420 level on a technical basis looks like some buyers have stepped in here. So some confluence when it comes to technicals as well as the IV structure.
Kev, this is a different way to look at a trade like this, right? Because with an expected move of about $18, you're going a full $24 outside the expected move. And what it shows our viewers is that you don't have to be in line with the expected move. Go to that spot on the chart where you feel safe or you feel there may be some support, understanding there's the expected move for the day, $18. The expected move for the week, right around just under $20. You're going $24 outside. So this is a higher definition of high probability. When you're in the mid 80s, this stock could sell off like you mentioned, or weaken like you mentioned, but still you're more than a standard deviation outside the current level of the stock price. Kev, your thoughts on that?
Yeah, I would agree. And you could also look at this as like a cash secured equity put, but with that long call to be able to reduce the margin requirements on it as well. So this is, once again, as you talked about, lower probability of being at the money or in the money. Obviously, you're going to get lower premiums than being closer to at the money, but this is more risk reward. What could actually happen? What has been the trend, which the trend has been to the downside for the most part when it comes to earnings, but you're hoping that the market makers have this priced in effectively pretty decently. And so the market makers are priced in around a 1 standard deviation move to the upside or downside. You are right. This is more of a 3 standard deviation event that would have to occur for this to actually get in the money, which can happen. And that's why the risk is also, over $800 you could take a loss on if it does have a massive gap to the downside. But risk reward, this one from an IV structure just looked like it was, it aligned really well with the technicals. That's how I kind of put it.
That's an example trade right there for Microsoft. Keep in mind, Microsoft reports earnings after the bell today. Thanks a ton, Kevin Green, senior markets correspondent, for that breakdown. And Kevin, both of you guys, the Kevins, the band, together breaking down that example trade. Coming up, we'll take a closer look at Tesla ahead of today's earnings with the team from Likefolio. What does the data say about Elon Musk's EV giant? That and more when Fast Market returns.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab. Schwab, a modern approach to wealth management.
Welcome back to Fast Market. I'm Diane King Hall, live at the New York Stock Exchange, alongside Kevin Hinks over at the SIBO. Time now for our cash tag segment. For that, I want to bring in Landon Swan, co-founder of Likefolio. We're going to dive into Tesla ahead of its earnings. Now, Landon, shares of Tesla have had this steady climb since the election. The pace of gains have moderated this year, though. So what does your data show you about Tesla?
Yeah, I mean, this stock has been on a nice run over the last 6 months or so, but a little bit of a pullback recently. And, you know, when we look at the data, it's pretty strong. It's, you know, everything that we've got is strong for Tesla. The consumer is big on EVs. I mean, people are searching for EVs in general. They're also searching for new Teslas. We did see a surge in searches ahead of the, potential removal of the EV credit. I think people are trying to get in on that before Trump takes that away. So we'll see how that is reflected in the earnings. But, you know, web searches are up significantly, 20% over 6 months. January was actually up 30% on a year-over-year basis. We know that they have lower production costs, and you know, as I said, people are searching. You can see here, people searching for new Tesla is up significantly. I think the push from the full self-driving version 13.2 was really a big eye-opener for people. It's got 5x the compute powers before. It's on its way to full autonomy. If you ever speak to someone who's been in a Tesla when it's on self-driving, you know, they're going to talk to you about it for an hour because it's so incredible, so impressive. So, you know, this is it's obviously, you know, bullish for us. This is, you know, we don't talk about this a lot, but Likefolio has a very short list of what we call infinite hold companies. This is a company you can throw in a vault and lock the keys, and this is one of the three. So for us, Tesla is one that we love long term, but, you know, we're talking about earnings here. So how do the earnings look? How does this quarter look? I think that with the pullback in the stock from those all-time highs, even though it's on a nice little run, it has pulled back. The data that we're showing is that everything's moving in the right direction for this company. And what's interesting is, you know, the markets have about a 7, maybe 8% expected move priced in here. And if you go back and look, that's not that big of a move for Tesla. It's big for most companies, but not that big of a move for Tesla. So I'm interested to see what the trade that Kevin comes up with is, because, you know, normally I would be a premium seller, but generally on this one, it looks like the historical move is larger than this expected move. But overall, you know, when we look at it, when we take the score from negative 100 to positive 100 on earnings companies, this one is coming in at plus 62 this quarter. And, you know, we're obviously very bullish going into it because of the increase in the number of people looking for EVs in general, Tesla specifically, also the number of people going to the website, searching for these kind of terms, and the consumer happiness. I mean, again, anytime you get somebody on social media talking about full autonomy, they're blown away. And really, for us, it's almost like, yes, they're clearly a car company, but you could make the argument that they're an AI company before they're a car company, and I think that's what's going to separate them. Before it was the electric aspect of their vehicles that separated them, but now I think it's the full self-driving and the AI integrated that's actually separating them.
You know, Landon, I read a very popular website, and I like it because it gives you a whole plethora of information. And there's 10 analysts on this website. And right now, one buy, here's the analyst list: hold, sell, sell, strong sell, hold, sell. Here's our one buy, sell, sell, and hold. So the overall sentiment on Tesla right now up at these levels is extremely negative from an analyst perspective. Now, your data, which is much more high frequency, much more on the pulse of where Tesla is, goes the exact opposite of this. So who's got it wrong, Landon? Because I think I know when I put Likefolio data against an analyst, and you've got a stock, even though it's still up about 105% over the last 12 months, it's down 9.5% in the last month, Landon.
Right, exactly. And you know what? I mean, if I was going to be bullish going into an earnings report, I would much prefer to have 9 out of 10 analysts disagree with me than agree with me. I mean, you know, there's a lot of value in being contrarian in markets in general. So I'm fine being on the other side of this one. And of course, we don't get them right every time, but again, we've been on Tesla for over 10 years now, since we first saw that initial spike when their first car came out and people were blown away. You know, this has been one that's kind of been on Likefolio's radar for a long time. Now, we've had some bearish quarterly calls on Tesla that we've hit, and you know, we're not always bullish on it, but the data coming in on it this quarter is strong. Everybody's looking for ways to buy a Tesla. They're looking for more information about it. They're talking about it online, and when they are, they're talking about it positively. So this is all signs point to consumer demand increasing kind of situation, and we know that, you know, they're able to deliver right now. I mean, if you rewind 6-7 years ago, everything was, yeah, okay, maybe they have great cars, but they can't actually make that many. I mean, they just delivered 500,000 in Q4, up 2% on a quarterly basis. So they're delivering cars, they're making them quickly. The prices have come down tremendously. The technology is unbelievable, and everybody that speaks about it, that uses it, is talking positively. So, you know, maybe this is the quarter that they surprise to the upside. Maybe it's not. I'd rather bet on that than not, again, because of that expected move is somewhat low compared to historical moves. And I absolutely love being contrarian against a lot of those analysts, so I'm fine with that. Long term, this is, like I said, hold and forget. Just lock it in the vault, check on it in 10 years, you'll be happy. But on this quarter, we are definitely willing to bet to the upside with that plus 62 score. As you guys know, we don't get a lot of scores over 50. I mean, every once in a while we'll get a 60, 70, and occasionally an 80 or 90. So 62 is a strong one to take into account. And again, it does look at all kinds of things, from social media to web visits, search visits, all that kind of information, as well as the stock performance. So, you know, I'm happy where we're at now. We'll see tomorrow if we're right, but I think that we have a greater than 50% chance for sure.
But Landon, to me, it begs the question on how are you looking at Tesla? You made the point earlier that, you know, and the way some analysts would measure it is as a car company, as an EV maker, right? But then there is the argument that is an AI company, which I think is the argument that Elon Musk is pushing for. So when you think about the data that you're presenting, is it from the perspective that this is an AI company or car company? How are we measuring it?
Yeah, it's really measuring it from the consumer perception. What do consumers like? Do they like the product that's out there right now? And that is, it's a clear yes. It's a clear yes that the consumers love this product, especially at the price points that they're seeing right now. Now, when you're talking about the future, that's more when you get into the AI, because then, you've got a situation where if they control the 100% of full autonomous driving vehicles, imagine the things that they can do. I mean, they're going to pick up the phone and call Uber, and that's going to be an interesting conversation, right? I mean, all of the stuff that Tesla can do, being the first and only fully autonomous car, is going to be very, very powerful. Not to mention the fact that, it never hurts to be really good friends with the President of the United States and to have helped him win an election, right? I mean, that's always a good thing. So,
yes.
I like where they're headed in the long term.
As long as he can remain first buddy, because sometimes we know, sometimes those relationships, like in the first term, we know sometimes those relationships took a different direction. So as long as he stays on his good side, that probably will bode well for Tesla. All right, Landon Swan, we're gonna put a pin in our conversation. Landon Swan, thanks a ton for that data that you brought us on Tesla from Likefolio. All right, so Landon asked a great question. He can't wait to see an example trade. So Kevin, how would you structure this when it comes to Tesla?
So the easiest way to attack something like this is to admit it could go in either direction. And so I look at this as an opportunity to play the divergence between that front expiration, which currently sits at 158 implied volatility, and the second expiration, the February 7th, which sits at about 94. Think about that. That's 64 points between those two. So if you are bullish, if you are bearish, or you're not sure, this is a trade you could look at, and it's called the double calendar. It's buying the February 7th, selling the January 31st. Let's set that. Looking at the expected move in Tesla of about $35. Now, that helps us do what? It helps us set our strike prices. So I went to the $360 put and the $425 call. And so there's about $30 to $35 in either direction right there for those expected moves. The $360 strike put, it was trading about 270. It's trading about 278. It's right there. So volatility is holding in. The $425 call was trading 3.5. It's trading about 3.5. So if you think 270 for the put, 3.5 for the call, that gives you about $6.20 in net debit for both. And now, as you can see on the graph there, this spread peaks out at those strikes. The 360 put on the downside, the 425 strike on the upside. Now you're collecting, just in a one lot double calendar, you're collecting about $500 in theta. Now, this is less expensive than you would normally look at because of the divergence between the front expiration and the second. So you could do either one of these, Diane, or both. That's why I priced them individually. The double calendar's trading about 620. It's about 270, 275 on the put calendar. It's about 350 on the call calendar. Pick one, pick the other, or pick both, Diane. But this lines up with that expected move. Now, Landon made an interesting point, Diane. If you think that move is too small, right, that expected move, that market maker move on the Thinkorswim platform, that's not the answer. That's part of the question. And if you think that move looks small, it could go further than that, then widen those strikes out more, because you'll pay less for the further out calendars. So make sure you understand that. Set your strikes using, set your basis for the strike using the implied volatility numbers and the expected move, but feel free to move them lower, higher, anywhere you want, because that's where you target on a calendar spread, Diane.
All right, that's a great setup for double calendar spread for an example trade for Tesla. Tesla is reporting after the bell today. That's a fun segment. Coming up, our final example trades. George Silas will join us to take a closer look at MasterCard. The stock trading just below all-time highs. It hit them yesterday. Going into tomorrow's earnings report, Fast Market will be back after this break.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
Welcome back to Fast Market here on the Schwab Network. Before we dive into MasterCard, let's do a broader check on market action. We'll start out with some of the equity movement. We've been watching some choppiness, some fluctuating across the equities from the S&P 500. We'd seen some of them tick a little higher, gone back lower. The S&P 500 lower by down by 0.3%, down pretty flat still. NASDAQ 100 off by 0.3%. Russell is flat as well. We're also watching crude oil, which is taking a leg down in the last hour. We're looking at WTI under some pressure after tariff comments. Some more commentary from Washington from Commerce Secretary nominee Howard Lutnick. Now, Lutnick told a Senate committee he prefers across-the-board, country-by-country tariffs, and that Chinese tariffs should be the highest, but the U.S. may need to impose new tariffs on allies. So you're seeing crude oil prices tick lower, down about 1.5%, trading approaching $72 a barrel. Now, let's bring back into our conversation Fast Market co-host Kevin Hinks over at the CBOE, and we also want to bring in George Silas, senior markets correspondent here on the Schwab Network. All right, George, we know we've talked a lot about big tech this week, but it's not just all about big tech. We've got some earnings coming from MasterCard. So, George, what should we expect?
Well, I think when you look at MasterCard and Visa, you have to really consider, the duopoly position that these two companies have when it comes down to, merchant business and payment processing networks and all the transactions that are done both domestically and internationally. And these two companies really are the leaders in, transaction network and overall stocks are just not serial trenders. They've been trending higher for years. And I think the expectations for MasterCard, which is the second largest payment network provider behind Visa, but one of the things about MasterCard, they do have quite a bit more exposure from an international standpoint, where they generate about 61 or 67%, of their total sales. So if you're looking for international payment exposure, this is the one compared to Visa, which is about 51% international exposure. But nonetheless, if you consider the EPS estimates for MasterCard, they're expected to be quite robust at $3.68. That's higher by 16% compared to the same quarter last year where the company earned $3.18. And then for sales, they are expecting about $7.38 billion, around 12.5% to the upside. Now, last quarter, if you just look at some of the metrics, total global gross dollar volume did increase to over $2.5 trillion. That was higher by 11%. Payment transactions higher by 11.4%, as well as cross-border volume, dollar denominated, was higher by 17%. So there seems to have been, at the very least last quarter, a pretty significant pickup in the transactions volume overseas, and I think that's where MasterCard generates a lot more benefit than Visa, irrespective of the fact that it's a much smaller company from a total payment volume standpoint.
George, a lot of what you said is so accurate. Cross-border doing extremely well. E-commerce, the U.S. consumer doing extremely well. The stock is sitting at all-time highs as we speak. That stock, that's doing really well. But, George, the valuations, 36 times 2024 earnings. This stock is getting extremely expensive, and they've got higher expenses, rebates and incentives that are coming higher. They make money off of the swipe like Visa, unlike American Express. But, George, American Express put up good numbers a week or so ago, and that stock sold off. Why? Because it had rallied so far. No matter how good this company is, George, at some point I want to be long it, at some point I want to be short it. As this stock, is it just valued too high?
Yeah, so you're right. If you just look at 2024's earnings, again, if you look at the numbers, $14.50 rounded up, it is trading around 36 times this year's earnings. If you do look at next year's EPS, the company's expecting $16.27. So based on 2025's earnings, it's trading around 33 times this year's fiscal year's earnings. Now, if you look at the historical average, it's around 36 times. So right now, it seems to be valued at the higher end of that valuation range. And I think that's what we're actually seeing from the standpoint of the market kind of reaching these peaks in MasterCard. I think the other thing to keep in mind, and perhaps it's a little bit different than American Express, is American Express also has some bank financial risk, whereas MasterCard doesn't, because MasterCard is really a technology network company with quite high, net income margins at around, 45% of sales. Gross margins for this business are just tremendous. So therefore, you have to consider financial versus non-financial risks. And of course, American Express would benefit when financial risks are better versus a MasterCard, which again doesn't have that sort of risk or exposure to the lending markets like American Express does.
It doesn't, but it does have some Forex risks, especially as you mentioned the context of their exposure internationally. But that was a great breakdown in terms of the setup for MasterCard earnings coming up. George Sillis, Senior Markets Correspondent, thanks a ton for that breakdown. All right, Kevin, in the context of that, the setup for its earnings, how would you go about an example trade for MasterCard?
I have the mind of a trader, and I see everything through the prism of trading, Diane. And all I know is American Express put up really good numbers and wasn't able to hold the price levels that they had pre-earnings report. So based on that, the complex trade that I put on here in paper money is this: selling a call vertical to finance buying a put calendar. And in this case, I went to the January 31st, just this week, 2.5 more trading days. I sold the 565, 570 call vertical, Diane. Then I used that credit to purchase the February 7th, January 31st, 530 put calendar. So I'm selling the call vertical above the market, buying the put calendar below the market. Now I do that. That whole thing is trading about between 15 cents and 20 cents credit. So we really put no money, which means if nothing happens, you make your credit and everything goes to zero and you just keep your credit. But if you do get a move slightly on the downside, the expected move here for one day, about $18. That would take you very close to that 530 range. That's where this maxes out because the call spread goes to zero and the put calendar goes to its max level. So all I'm doing here is lining up the expected move with the strikes that I'm using. 565 short call vertical on the upside, 565, 570, 530 on the put calendar, Diane, collecting about 20 cents net credit.
All right, that's an example trade for MasterCard, who's got earnings coming up. And keep in mind, this comes in the context of it hitting all-time highs this week. But that's going to do it for us today on Fast Market. We've got you covered from exchange to exchange. I'm Diane King Hall here at the New York Stock Exchange, alongside Kevin Hinks over at the SIBO. Tom White will be back with you all tomorrow, along with Kevin. Download the Schwab Network app. It is available in the Apple App Store. Tune in 24/7 on schwabnetwork.com. But stick around, because Next Gen Investing is coming up.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Join me, Oliver Rennick, alongside Schwab Network's options experts as we explore the second derivative. Gamma On is a brand new limited series to take your trading skills to the next level. Subscribe to Schwab Network's YouTube channel now. Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Welcome to Next Gen Investing. I'm Jenny Horn alongside, of course, Alex Coffey. And we are seeing some pressure today right now as we are just about an hour away from the key Fed announcement. So I do feel like as we know, historically speaking, it feels like the markets somewhat pause as we await the next major catalyst for these markets, which is the Fed.
Yeah, no doubt. And I guess I'm not totally surprised that we have a little bit of weakness, a little bit of uneasiness. Think back to, middle of December. This is really what set off what's been a little bit more of a choppy, volatile last month and a half. And so for Jerome Powell to be taking the stage, in about an hour and a half, market be a little bit red, a little bit of uncertainty building here. Not a huge surprise.
Yeah, not a huge surprise, especially because I do feel like right now the pressure of the unknown doesn't seem maybe as significant because Fed's pretty largely expected to hold rates steady, though, of course, we'll wait and see. I will not be a predictor of what could happen in the next hour or so. So we will step away, though, from overall the price activity we are seeing with the 4 major averages. As you can see there, somewhat bottoming, but actually it's now starting to peak off of those lows we saw for the session here. So hopefully we'll see some recovery, but we'll start things off on our show, as always, with upvote and downvote. We'll be charting and trading those upvoted names. FOMO today, we are looking at Meta ahead of its earnings out today after the close. We'll also be previewing ServiceNow ahead of earnings due out later today. And we'll close things out with a nice Fed preview from, of course, George Tillis, who's going to discuss some more of what we can expect from the macro. And, of course, this is a 2-event type afternoon. We first get minutes, and then we get the decision, and then we get, of course, Jerome Powell. So then I think we'll really start to see some volatility.
And there's almost like a two halves to Jerome Powell's piece, too, where it's like he has this prepared statement where he sort of reads what we heard from, the first initial announcement and like the Fed statement, maybe adds some clarity to that. And then it's the questions. And the questions is where things get fun. All sorts of different characters are asking them. Some, really know what they're talking about, and others you wonder, why are you in that room? But it's always fun to hear the answers.
I know, you're right. This is basically a 3-part event. So you're right. The prepared remarks, and then you get the real fireworks when the real volatility starts creeping in the markets, and then we get the questions asked that perhaps we are all wondering at home, and we get some answers, hopefully. So we'll step away from our Fed speak, though. We'll be diving more into that later on the show. So looking at upvotes, downvotes here, we have all earnings previews. So no better place to start than Tesla, which is, expected to release its 4th quarter results today. Luckily for Tesla, we do already know from early January they reported deliveries for the 4th quarter that were around 495,000, just over that figure. For the full year, deliveries came in about 1.8 million, marking the company's first annual decline. So deliveries are at least the closest approximation of sales reported by Tesla, but not necessarily defined as such. So when you look at their overall revenue, we are expecting around $27.25 billion, earnings per share at 75 cents roughly. To end 2024, though, they did offer this range of discounts on inventory and vehicles and special discounts for buyers in North America who were referred by another Tesla customer. In China, we know they've also recently cut the prices on their popular Model Y SUVs before debuting a refreshed version, the Model Y Juniper. So given the discount on vehicles, we're expecting margins to likely remain in focus for this earnings call. Guidance also on their core automotive and energy businesses in 2025, I also think will be critical. But as we know, this has basically been post-election, a volatility trade into the Trump administration. Elon Musk has such close ties now with the current president that I feel like there's no way to avoid the volatility that comes with the administration right now.
Yeah. When I look at Tesla, it's never been a name to me that's been as volatile as you'd perceive it to be around earnings, because you get those delivery and production numbers at a different time. So you can sort of start doing some of the math and figuring out roughly what their numbers are going to look like. So it doesn't tend to surprise one way or another as much as some of these other names that we're going to talk about. However, with Tesla, because so much of it is the story and what is going to be in the pipeline, and what are you working on, and the excitement of somebody like Elon Musk at the helm, and the things that he's gotten, in their plans in terms of the timelines for autonomous driving and what that might mean. Oftentimes, when there is volatility, it's from something that the company's talked about or said, and that not jiving maybe where the market was. So, to me, this isn't the numbers as much, unless there's a massive beat or miss, which, when you got part of the story, it's hard for that to happen, but not impossible. So what I'm looking for here, margin story and commentary from the company.
Me too, because again, this is an earnings call that I feel as though it's almost a Jerome Powell speaking type event where anything he says is so highly scrutinized. We usually see some market movement even after hours because of how closely this name is watched and as following traded. So one we'll definitely be watching. I'll be tuning in, I'm sure, to that earnings call because it tends to unveil a lot more than just the numbers themselves, as Alex pointed out. But next name today is Microsoft. And Microsoft has been seen as this bastion now of like savior when it comes to some of the tech volatility, at least as far as its earnings as of late. Now, I can recall a time where it actually was somewhat of our laggard of the bunch, but it's important to note that the big tech cohort and Microsoft are investing tens of billions of dollars in data centers and infrastructure that are needed to train and deploy AI software. This name has obviously taken a bit of a hit as a result of the unveiling of DeepSeek. We really saw that volatility in the markets Monday, but Microsoft now has risen just about 9% over the last 12 months, with Amazon and Google shares up about 50% and 27% over the same period, respectively. So they've underperformed as far as just price. So now as far as what we're expecting for the quarter, earnings of around $3.13 a share on revenue of just shy of $69 billion. Now, when it comes to right now expectations for the commercial cloud segment, which includes their cloud services sales, they're expecting to come in around $41 billion. Also, that would be an increase from the $31.9 billion in the same period a year ago. Intelligent cloud business, which does include its Azure platform, heavily watched, is also expected to rise from about $21.5 billion to $25.8 billion. So we're expecting some significant growth. I was reading a note out of Evercore ISI that said the stock could be set up for a mini revenge trade as AI sales do increase. But its Copilot adoption rates are also expected to improve. CapEx is expected to moderate. So will we get any of this maybe in the earnings call? I'll have to see. But this is also like a two-part event where we get the numbers and then it seems like they wait for dust to settle and then they have their earnings call.
Yeah, I've said this a few times with you, Jenny. I'm no way I can know this for sure. I think they look and see what the reaction is, and they tailor how positive of a picture they spin or how conservative a picture they spin based off of that. Now, look, I don't know. There's no way for me to know that for sure, but I watched them put some pretty bad numbers out in 2022 in the middle part of the year. The market was on the ropes, and all of a sudden, the guidance was the strongest guidance I've ever seen. It turned the market around. It was the low point of the middle part of 2022. So they know the importance that they play in the marketplace, and they know how to tailor a story, I guess I'll say, to give a market just enough to soften the blow, even on disappointing numbers. But cloud story for sure. The AI conversation is going to be impossible for them to avoid. It's a very fascinating earnings event that I'm looking forward to checking out. Stock's still down 6% from its July peak, though. So this is not a name that really participated at all in the second half of last year with all that excitement post the election and just general risk assets swelling.
I know, so that makes it, I think, even more interesting, given, again, its underperformance in its respective Mag 7 space, although some of the Mag 7s now faring a bit worse, at least as far as a 12-month basis. But next name today is IBM, and another, I would say, beneficiary of recent AI hype, although it has pulled back about 5% from its highs. But momentum in AI and the acceleration of Red Hat business are areas that will also be closely watched or subjects to watch in this upcoming report. IBM could be looking at as much as first quarter revenue of around $17.5 billion, mostly, though, due to these foreign exchange rates. For 2025, though, right now, Street is estimating about 7% year-over-year growth, with free cash flow totaling around $12.5 billion. Now, right now, their enterprise business is expecting to see around $1 billion through the quarter end of October, with its now book of business related to generative AI exceeding about $3 billion inception to date. Investors will wait for more news, though, about AI and the coming ways in which they're trying to unveil different technology to enthuse their customers. Recent news from IBM includes the release of their Rise with SAP on IBM Power virtual servers, which is aiming to really support further AI businesses as processes while working with AI hyperscaler CoreWeave to train the next generation of these Granite AI models per IBM. Also, we know that they had at one point, like legacy businesses, they're trying to really reform and shape to various AI. You can recall Watson was at one point like a leader in the space. So that being said, there is some still scrutiny over HashiCorp that was expected or announced back in April, had plans to close the deal last year. But the deal had received lots of scrutiny from UK's Competition and Markets Authority at the start of 2025. So any clarity also on that, because the $7 billion acquisition is definitely not nothing when it comes to IBM.
Yeah, no doubt. This name is going to be overlooked this afternoon just simply because of all the other names that are reporting. But it's one of the ones that, Big Blue, that's what they used to call it. This was a really important company. It isn't quite as important, but turned things around a lot in 2024. And I think that was important for investors to finally see some upside in a company that struggled for many, many years in the recent decade. So one to monitor. And as far as the major takeaways, how is their kind of core business, the stuff that they do within consulting and stuff, where it's expected to be disappointing, how much is that going to weigh on it? And that's ultimately going to be there are things that are working for IBM, but kind of like GE before it's split off. They're unfocused. They got a lot of things going on, and there's almost always something dragging on the performance. Just how bad is it?
That is true. How bad is it, and how much will guidance be scrutinized, I feel like, for all of these names? And last name today here is Lam Research. Another name that I do feel like is going to be overlooked just given the massive companies reporting alongside, like in the next 24 hours or so. But Lam Research has had a decent history of beating earnings. They actually beat revenue expectations last quarter by about 2.5%. Revenue was up almost 20% year over year. It was a very strong quarter for the company with an impressive beat of expectations for operating income estimates, a solid beat as far as earnings. So now for this quarter, we're expecting revenue to rise about 14.5%. Again, that would be a pretty stark reversal from the 29% decrease they saw in the same period a year ago on adjusted earnings of around 88 cents a share. Looking at their peers in this segment, unfortunately, if you were just basing it off of Seagate Technology, which actually saw revenue up 50% nearly. Texas Instruments, though, was one that was maybe a bit of a concern. Again, hard to say peers, but these are pretty much the only two names we've gotten in the AI space. Texas Instruments saw its revenue actually contract almost 2%, and then shares traded down about 7.5% following. So different types of companies, but so far the AI chip names have not performed quite so well post earnings. We'll have to see if we can break that trend once we get a little bit more insight really into the AI world.
Yeah, this is a name, and this is such a fascinating part of this particular marketplace at the moment when it comes to chips and all the things that go into it because of what DeepSeek brought to the table this week. Who knows if it's ultimately the case, but deflationary wave, not impacting Lam Research the same that it is with some of these other names here today. And that kind of brings us to a piece of breaking news as well, Jenny, which is a Bloomberg report. And I'm just going to read it basically word for word here. Trump officials discussed tightening curbs on NVIDIA China sales. You saw the market itself move dramatically on this news. I'm looking at S&P 500. Futures went from about 60.70 down to sub 60.50 in a handful of seconds. Has recovered that, at least in part. Let's call it, half of those, losses have been caught, but we're still near what would have been and would be session lows, with the exception of that spike to the downside. So something to monitor there. You look at NVIDIA, now down $7.50. So almost giving back now, Jenny, all of yesterday's, bounce. Goes to show, we talked about this, volatility in this particular space, which, of course, given the concentration nature of the S&P 500 and the NASDAQ 100, there's going to be exposure there as well. When you see a $25 or 25 whatever it was decline in NVIDIA, that was telling you that maybe this is something more than just a one-day story.
Absolutely, and I think that has been definitely proven by these markets, but the NVIDIA jitters definitely do still continue. As we said, we were somewhat bouncing off of lows here to start the show, and then NVIDIA now somewhat nearing it, bouncing off session lows. I'm watching in real time, but still down about 5.8%, like you said, over $7.40. So pretty substantial move in NVIDIA. Somewhat actually highly correlated right now to the S&P 500. If you're watching that move with the SPX, you're also seeing it in NVIDIA.
One thing I want to add to this too, this move dramatic, no doubt about it, would have been dramatic at any point, but be it around a Fed number, a CPI, jobs data. But the fact that this dropped at a time where, many maybe are running, grabbing something to eat real quick ahead of the Fed. Maybe they went to the bathroom, grabbing some water, whatever it may be. The pocket of illiquidity in this market, it was almost like a vacuum. Mm-hmm. This news dropped, and there just wasn't the depth of market to support it. You can already see a pretty dramatic bounce back. Doesn't mean that this story doesn't have legs. It doesn't mean that this doesn't have an impact to NVIDIA. the stock's at almost $2 off its lows in just a handful of minutes because some of that movement was also just due to an illiquid market.
That's true. Yeah, if you thought that you were taking a nice hour break before the Fed, I guess, again, we got news out of NVIDIA that's definitely at least shaking some of the narrative regarding, I think, the future of their AI demand, which, again, I think that we'll get more clarity on that, but headlines right now are definitely interesting. So we'll actually be focused more on Tesla and Microsoft, our two behemoths that are reporting today after the close. We'll be looking more at some example trades of both of those names, as well as some key technical levels to keep on your radar. Stick around. Next Gen Investing. We'll be right back.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's now time for Chart Master. So joining me, of course, is our Chart Master of the day, and always pretty much is Rick Ducat here to break down the technicals for us. And Tesla and Microsoft, two mom and pop shops, as we like to joke. But we'll start off with Tesla. Already down about 2.5% here on the session into this report. Thankfully, we do already have a really good glimpse of their fourth quarter deliveries, their previous year, really deliveries overall. We got those early this month. So walk us through what we're seeing from a technical front, because thankfully this name isn't typically hugely volatile on earnings, but you know, as we know, price not indicative of future performance. Anything can happen when it comes to Tesla.
Sure, and you know, there's kind of two phases of this chart. I think that for our purposes, we can see that after we hit this point, we established a ceiling at this level near 265. We couple that with our trend line starting across at those lows, going across these subsequent lows, giving us kind of a ascending triangle type of shape with you know, higher lows and consistent horizontal resistance. Then we had our big breakout. We formed another similar resistance ceiling around 360 before surging upward once again. This time we topped out at 488.54. Now things have moderated a little bit. We've got this shorter term white downward trend line to consider. You could also draw an accompanying upward sloping trend line going across those lows to give us this triangular type of shape here. A low volatility shape that is often a precursor to high volatility when the eventual breakout does happen. The upside, I think, is a little more interesting. We've got our yellow 21-day EMA very close to that white trend line there. If we were to break out to the upside, traders probably would be having their eyes on those highs near 439, Jenny.
Okay, yeah, 439 would not be a bad place to be at, especially because we are right below. We are actually right around 388 currently. So as it stands, definitely looking for some upside here if you're of the believer in that nature, of course. But walk us through the momentum. Are we seeing any divergence as far as RSI?
Well, divergence, not really quite so much here. I mean, I guess you could argue that we did have some divergence from here to here. I think we kind of had a reset and then a new trend here. But the more recent shape would be this downward sloping trend line on the RSI. This suggests rather listless momentum, a lack of clear directionality, which makes sense given that we're bouncing back and forth in an increasingly narrowing triangular range here. So look for RSI to perhaps break above not only that trend line, but also that 50 midline, as it were. If it were to concurrently do that while price was breaking out as well, that would be a noteworthy sign.
Okay, yeah, so last but not least here, as far as some key levels of support and resistance, when we're watching Tesla, I will say that price has been very difficult to gauge for this name because, again, it's so volatile. Still in a pretty steady uptrend, but pulling back now about 20% from its highs. So walk us through some price you're keeping on your radar.
Well, remember our two phases of our chart that we were talking about? It's very obvious when you look at volume profile. You can see that all the heavy volume is before we had our big breakout above our initial level of 265. From there, I mean, there's some volume around here near 330, around here near 420 or so, but not really anything close to the useful large nodes that we have to go off of for our longer term time frame there. So in the shorter term, like I said, this area is the breakout point. Then we've got our highs here, pretty close to our +1 standard deviation channel near 448.60. Ultimately, then those old highs near 489 or so are a mark to watch. To the downside, 360, that level I mentioned before, another of our ceilings, pretty close to the 63-day EMA and our linear regression line. So like 360 to maybe 370 or so. And to give a quick look at the longer term perspective on this automaker here, we can see that we are pretty close to our +2 standard deviation channel, or rather we were close to where that would have been at the time here. Now we're in between. +1 to the bottom, 366, +2 to the top, 450 or so.
Yeah, Tesla's chart is always so fascinating because you can really see that post-election run-up in share price, and then that's truly like the giveth and taketh. I'm not saying that we've given back all that strength, but clearly a name that's pulled back from at least its recent highs and that post-election hype that really followed all things Tesla. So now when we look at trading this name, I mean, walk us through your thoughts, because I do know this is definitely one, whether it's super volatile on earnings or not, it's definitely heavily traded.
This morning, I previewed this one with Oliver Rennick, and I had mentioned that there had been 7 analysts that I saw update their feelings on this stock, and 3 were sells, 2 were neutral, and 2 were buys, all on the same day, all looking at essentially the same available information. So it goes to show there's a disagreement with this stock as to what it should be worth and where it might be going. I think there's also a perception that right now maybe it's not the business itself that's driving the activity. Perhaps it's policy decisions and things that might be happening. So if that's the case, maybe a neutral trade's in store because earnings just might not matter that much. And I looked at an iron condor, selling iron condor around basically the current share price, 430, 435 call vertical, 345, 340 put vertical, all expiring Friday. Looking for a $1.50 credit. You can make 150 on 350 in risk. You see the 2 break evens. Big wide range. Looking for this to be quieter than expected, Jenny. Break evens between 340, 350 and 430, 150. So almost $90 basically high to low.
Yeah, and one that obviously you can see some wiggle room here because of the fact that you have a pretty wide strike selection. So you can consider moves to the upside, maybe even, I mean, like a modest, I'd say definitely a more neutral to bullish strategy here, but you can definitely have some wiggle room as far as like price flexibility. So now, when we look at Microsoft, as we've been joking, this has been our savior of the tech earnings as of late. We know that's not always the case, though, because a lot of times this name has actually pulled back on earnings. It just has felt like they've catered their commentary quite well on their earnings call to the market. That being said, though, walk us through this chart because we've underperformed a lot of the Mag 7 names now on a 12-month basis in Microsoft.
Actually, kind of a more difficult chart, really. A lot of chop, a lot of sideways price action, a lot of swings upside and downside here without a lot of clear trend direction here. So depending on your trading style, maybe you like that. Maybe if you're a mean reversion type trader, if you're a trend following trader, this is a challenging situation here. Nevertheless, when we look here, we can see that for the most part, a lot of the price action fits within this triangular type boundary here, starting with our highs and lows on a 52-week basis. So once again, a type of triangular shape where price is compressing in an increasingly narrowing area. In this case, it's a much larger area, though. We're not really seeing that type of extreme narrowing condition here, but we are crossing above not only this set of old highs, but also our moving averages, yellow 21-day and orange 63-day. We were making a strong close above them recently, but then a big misstep on the news of the DeepSeek AI stuff. Now we've recovered mostly. It's just a good reminder that a lot of times these things can result in very extreme short-term moves that moderate in the coming days. So don't panic when crazy things happen. Notice as well, on pace for a Harami candle, completely contained within the previous day's large green candle, is today's smaller red candle.
Gosh, Rick, I wish I could shout that from the rooftops on Monday when everyone was saying the sky was falling. It was like, hold on a second. This is one component of AI. If you're still a believer in a lot of the AI trends, especially for, some of these major competitors, I don't think that necessarily completely changed the narrative, but obviously price is king, so you can't argue with the way stocks reacted, frankly. So with momentum, then, are we seeing anything interesting here?
I have to wonder, too, this was in reaction to a free open source app. What do you think Microsoft has that we don't know about? You know what I mean? Like, what kind of products are they working on or whatever? Anyway, but so to look at RSI here, we can see that we are trending downward off of those highs here. So RSI mostly matching up with the expectation here for a series of lower highs. We also have this green trend line you could consider as well. We broke above the 50 midline, but we have a triangular shape once again here in terms of momentum. So look for a break beyond either of these two trend lines and an accompanying break in price for further directional clues.
Yeah, I will say the same. Definitely directional clues seem to help, but earnings have always been able to reset sort of your pre-expectations. So now when we're watching, again, some key levels of price, considering standard deviations, what are you watching?
So when you have these sideways periods of price activity, it can be very helpful if it takes place in kind of an isolated region. When the whole chart is just chopping back and forth in a big range, the volume profile is not super helpful except to tell us where the most trading is. So right around here near 415 is kind of the key area in terms of trading activity. Once we start getting above here, though, above like maybe 430 or so, it really starts to thin out. And we can see that we do have two very subtle nodes here right around maybe 446 and 441 or so. So those are some short-term areas to keep an eye on, but also the old highs here match up with that 21-day EMA and our blue linear regression line all around 433, 434. To the upside, +1 standard deviation channel, pretty close to yesterday's high close near 447. And then I think traders might be on the lookout for this red line here that matches up with the old highs near about 454. To take a quick peek at a longer term chart here, we can see the heavy volume node here gives us a level to watch near 420. That's also our linear regression line. So on a longer term level, this looks like a key support area, pretty much where we are now.
Okay, yes, so this will be a very interesting earnings event. And of course, the overall market is also getting more and more interesting as we get closer to that Fed announcement. So we'll be watching that as well. But when looking at now trading this name here, Alex, we looked at a more neutral leading strategy in Tesla. As we always say, neutral still, conviction, especially in these markets. So looking to lean into them, maybe neutral to bearish, and for an example purposes for Microsoft.
Yeah, stock that has not joined the party the same way that many of its peers have over the last 6 months. Neutral to bearish strategy, focusing on that level that Rick highlighted around 455 as a potential resistance point, and then going just above that with the 460, 465 call vertical expiring this Friday. So short term, again, looking at the 460, 465, as I said, for the $1.25 credit, you can see right here, max profit 125, max loss 375. Simply add that credit to the short strike, you get 461.25. That's your break even. Jenny, this isn't saying Microsoft needs to go lower. It's just asking it to run into some resistance and hang out there at least through the end of the week.
That's true. And looking just for a lot, maybe more of the same. So two strategies that utilize maybe flexibility again with some prices, because as we know, earnings are difficult to pinpoint where you'll end up, especially given the volatile nature of these markets this week. But we'll leave it there for our chart master discussion. Now, coming up next time to talk another name with earnings due out today after the close. That is Meta Platforms, which has been the face of resiliency and volatility this week as we're modestly lower, but still up on the week.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab Investing Themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360. Only on Schwab Network.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Next Gen Investing. It's now time for FOMO, and we are previewing Meta Platforms ahead of their earnings. So I know that this has been a tough week, and gosh, we have all felt it in some way because it's been volatile, but you would not know it looking at Meta's chart as this name continues to be really the face of strength in terms of the overall market volatility, especially for tech. I mean, this name as well as Apple, which Apple's now pulled back quite considerably, but faring the volatility storm quite well. We were pretty much at highs here. We've pulled back now about 1%, but we're in correction territory from recent highs in so many of these names, so much even beyond that now, that to look at Meta and see this stellar chart is impressive to say the very least.
You know, if you would have asked me on Friday, in which I think I probably had these discussions on Market on Close and in other, network programming, to kind of rank order the Mag 7 earnings for this week from Apple to Meta to Tesla to Microsoft, I think I would have put Meta Platforms last in terms of ones that were interesting me. But after the news on Monday, I think it vaulted to the top. And so I think it's the perfect candidate for this particular segment. And I'm excited to preview it with all that's going on in terms of investment and TikTok uncertainty and AI and advertisement and everything that is unfolding in front of us. Meta is like squarely in the mix in all of it.
It is. And so thankfully for them also, I know we were saying from a PR standpoint that Mark Zuckerberg tying himself, from frankly a business standpoint, it's so much more than PR, tying himself to the success of the administration. I mean, I think that it's an interesting move, but it seems like it's only boded well for Meta Platforms here. Plus, we got news last week on Friday that Mark Zuckerberg had announced a huge leap in their capital spend this year to be between 60 and 65 billion, and an increase by as much as 70% from 2024 levels. Incredible. Of course, coming just days after tech rivals did unveil this $500 billion spending plan known as Stargate. Amazing how DeepSeek has been our vocab word of the week, whereas Stargate, I feel like, dictated so much of last week's, but it's amazing how quickly the news cycle tends to move on, as we know. But the spending plan is, again, a roughly $14 billion jump from even what the street had been expecting for 2025. That's huge. We haven't released, of course, their 2024 CapEx numbers yet. I'm sure we'll get that clarity today after the close, but we were expecting it to be pretty significantly above, again, 2023 levels. So they've broken ground on 6 new data centers now. They do expect to bring 1 gigawatt of computing power online, as well as build out data centers in Louisiana that they have claimed could be so large that it would actually cover a significant portion of Manhattan. I think that is wild in itself. They expect to end the year with more than 1.3 million graphics processing units. And we know that jacking up these investments on AI is not a specific story to Meta Platforms. Really, since we've seen the AI infrastructure need to be built out in the last 2 years, I do not think that DeepSeek is one that's able to completely shift that narrative. I've been making that argument all week, but to your point, Alex, it's one of those events that either it's true or it's not true, and I guess we'll have to find out. Analysts are expecting, though, about 17% year-over-year revenue growth when we see earnings, and on average, Street's expecting earnings will rise about 27% on an annual basis, while CapEx is expected to, again, have increased pretty substantially. Further boosting to the stock, though, is I think the entire narrative surrounding TikTok. And I hate to mention TikTok as much as I have as of late, but it is definitely an impactful part of Meta's story, because right now, with so much of the focus on censorship and what that means for consumers, I think that everything TikTok, well, it has been reinstated, yes, temporarily. The fallout of TikTok is definitely not bad news for a name like Meta Platforms.
Yeah, there's a lot of uncertainty, and even just the existence of that uncertainty can drive spending on advertisement to a platform that might be seen as a little bit more stable in terms of its trajectory. But when it comes to the DeepSeek news, like, this is actually good news for Meta Platforms. If I only need 5% the power or processing power to do some of these things that I thought, and I'm still building out this giant facility, can I do 20 times more? Can I push the envelope that much further now? They've already spent this or already planned to spend this. I think the fallout is much more on the companies that need to continue to sell these products. So for the case of a Meta, for the case of the individual consumer, the fact that this is getting cheaper is a good thing.
Yeah, that was, I think, a huge reason that this name continued to hit all-time highs this week. Also, I think the same narrative could be applied to even Apple, which on the DeepSeek sell-off day of Monday, we saw Apple actually remain positive all throughout the session. And I was reading an analyst note that I can't recall which analyst, this was, I think, widely thought, really, that maybe perhaps the reasoning of being that they hadn't spent a ton on AI yet. So their AI can still be reshaped and reformed and perhaps utilizing a lot less power and technology than perhaps it even been guided for, which again is not all bad. I think that the DeepSeek news for both of these companies is going to be not like the sinking ship that drags all the others with it. I think that we're going to see the emergent winners and losers of perhaps building out AI not as costly or as power needed as we had thought, which again isn't a bad thing.
Exactly, and whether it's exactly 5%, like some of those stories were saying, or if it's just marginally more efficient. Again, good news as we're watching this become more and more commoditized. But as a company that's implementing this, like Meta is, not just from a chatbot standpoint on some of their apps, but really from an algorithmic standpoint in terms of putting content in front of people in a way that both makes sense to the end user, but also is in a way that they can sell to advertisers as why you should choose our platform. They have so many needs for AI. And so the fact that they can perhaps find those ways to do those, continue to R&D in that space, but perhaps do so cheaper, has to be good news.
I agree. And I think that is definitely been read through, at least as far as some of its performance on the week. Now, when looking at Meta, looking at the way the street feels on this name, I think no surprise to anyone that we have these 72 analysts that cover this name, which is astronomical in itself. Rarely do you see a name that's that highly covered. There's 62 buys, 8 holds, and 2 underperforms. So that tells you conviction does remain strong, although average price target right now is $664. So that would imply some downside from where we're trading. High right now is $811, low is $260. So still very skewed in the conviction as far as price performance over the next 12 months. But what I really want some clarity on is Reality Labs. Amazing how we've forgotten those two words, that has been the area of its business that has hemorrhaged money forever. So tell me about Reality Labs. Are we turning a profit? Are we ever going to turn a profit? Because that has been the area of their business that just like quietly was swept under the rug in the years of efficiency.
Yeah, and probably because it wasn't it wasn't landing the same way AI ultimately did. It's the same way I said, kind of like, you know, you go back in time and technologically sold as the next big thing was like voice recognition stuff with like Alexa apps and things like that. And it just didn't catch on. Like it's catching on again more so now, I think.
Trying.
But like it was sold as the next big thing. When in reality, the next big thing were things like TikTok and short form videos and long form podcasting. And so they're guessing at what the next trend's going to be. A lot of times they're right. That's why Meta is what it is. But a lot of times they're not. And, you know, a lot of their success has been built off, you know, buying Instagram, great purchase. And so looking at ways to implement the different things from the different apps has been useful. I mean, Instagram looks a lot like TikTok now. And even they've changed the shape of the photos and stuff now if you've recently seen it. So this is going to be an important name to watch after the close, not only from a volatility standpoint for the market, but I want to hear what Zuckerberg and team have to say about, because they're going to get the same questions Microsoft is about DeepSeek and you know what this means for the space. I think their answers might be the most interesting of all of them.
I do too. Talk about a great earnings performer, at least as of the last now 2 years. I mean, we talked about Microsoft coming and saving the market. I feel like Meta, you could also say, has done the same, frankly, with a name that's still up so substantially on a year-to-date basis. We're up 68%. We have now also risen still 4% this week. I mean, it's just frankly impressive. So when we look at trading this name, Alex, we've looked at a neutral strategy, more neutral to bearish. So just for example purposes, considering all of these names we get after the close today, walk us through a more bullish leaning example trade.
Yeah, so what I basically looked at was an iron condor, which is a short credit spread on the put side and a short credit spread on the call side. Then we just looked at just the call side short credit spread, and then we're looking at just the put side short credit spread. So vertical spread, neutral bullish, selling a put vertical here below the market in Meta platform, 650, 645 expiring at the end of the week. $1.70 credit means you can make $170 on 330 in risk, break even 648.30. So you got $25-ish in cushion to the downside. Again, this all expires at the end of the week. And the nice thing, Jenny, we've illustrated how you'd basically take the Microsoft trade, you combine that with the Meta trade, and you get the Tesla trade. The individual at home, if they're looking at these names or any of them, they can choose which ones better fit their own particular outlook. But we talked a lot of things that sounded pretty bullish in Meta, and this is the FOMO segment. So in lining with kind of building on our trade examples from the other ones, but also looking at one unique to Meta here.
Yeah, and one that has continued to impress even myself on this week. And I also am a fan of Mark Zuckerberg is like rocking some new style lately. I'm also a fan of that. That guy has had like the most crazy, I think, re-entry into public acceptance that I've seen. And in a good way, I mean, like frankly, I think that his leadership has been definitely one that's been astounding over the last several years. But we'll leave it there for all things Meta platforms. Now coming up next time to talk, of course, another name with earnings due out. That's ServiceNow. Another impressive stock that's up about 45% over the last 12 months and pulling back just about 5% from highs while remaining higher on the week.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. I'd now like to welcome in Kevin Green, Senior Markets Correspondent for the network, to talk ServiceNow. So, Kevin, we've previewed the big names, the Metas, the Microsofts, the Teslas. Now ServiceNow, though, I will say, not to say now about 4 different times in one sentence, but ServiceNow with earnings imminent here, also fairly impressive. And looking a lot more like a Meta chart than a Microsoft chart over the last year or so, because we're still up 45% on a 12-month basis here.
Yeah, and the financial performance has actually kind of complemented the price action to the upside. This is a company that does, cater to the enterprise software space here, but they were probably one of the first leaders that we've seen over the last 2 quarters or 3 quarters that have truly implemented artificial intelligence as a software offering, and they're seeing the take rate just completely skyrocket to the upside, which is leading them to beat and exceed both on the top and bottom line here. And that's exactly what you're kind of hearing from a couple of analysts. We had JP Morgan raising their price target up to $1,250. That's up from $950 here, maintaining their overweight rating. And Citi also raised their price target to $1,432, which is very interesting, up from $1,071. And once again, positive sentiment when it comes to the company just in general, seeing a really good take rate when it comes to the AI offerings, the Gen AI Pro Plus offering, and then also looking at continuing to expand the partnership deals. I mean, they've done deals with pretty much all of the major names out there. If you're looking at Amazon, if you're looking at NVIDIA, you name it, they're pretty much trying to partner with them. So this company has done a phenomenal job. The bar is going to be very high. Obviously, the price is going to be a little bit stretched here, but if you're looking at the past and trying to extrapolate what could happen in the future here, they've been fairly consistent, and I think that's what the market's really trying to price in going into this announcement after the close.
KG, you're kind of alluding to where my question was going to go. I noticed the same thing. This is not a company that's necessarily focused on small and medium-sized enterprises. This is a big fish company, Department of Defense, Amazon, Walmart, you mentioned NVIDIA, United Health Group. We're talking about some of the biggest organizations on the planet. Does that add a different element of kind of consistency to the fundamental data that we get from the company when you have these big stalwart organizations as clients?
Yeah, definitely. You're not going to have as much cyclicality when it comes to enterprise spend, and that's going to be a big key area for their business. 97% of their revenue really does come from the subscription service. They don't have a consumption model so much as of yet. So, this ebb and flow that you're seeing with maybe some smaller companies or mid-sized companies that are pulling back on enterprise spend in some respects, let's say networking, and kind of putting that towards software development and artificial intelligence, they're not going to be as susceptible to that. So for now, they actually have a little bit more of a moat. I think they have also a little bit more of a technological advantage when it comes to the software as a service type of offering, even if you're kind of looking at it compared to Salesforce, which you can make the case that ServiceNow has taken a pretty decent amount of market share away from Salesforce. They're kind of ahead of the curve. They're looked at as the leader, and that's why the market's paid such a premium for it, but they've been able to back it up when it comes to the fundamentals.
That's true, and I know that this space has been seen as, I think, like deeply fragmented. We've seen very different performances from some of its peers, but it's still able to continue to grow, and I guess earnings, we'll have to see if they can continue to please this high bar that's now been set forth, because frankly, rarely do we look at names in tech that are looking as strong as ServiceNow has over the last week and a half, year to date, or even 12-month basis. So appreciate that insight and breakdown. Kevin Green, as always, Senior Markets Correspondent for the network. But we'll leave it there then for our earnings previews. Now coming up next, time to shift gears and look at everything we can expect from the Fed, as we are just about 12 minutes away from the Fed announcement. We'll dive into what the markets are pricing in, what the expectations in the dot plot, etc., with George coming up next.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
We are just about 10 minutes away from hearing from the FOMC for the first time in 2025. Joining us now to preview what we might hear from Jerome Powell and team is George Tillis, Senior Markets Correspondent for the Schwab Network. Georgia, of course, this is a two-part event. No major changes expected beyond maybe some redlining to a recent statement at 1 o'clock or in the next 10 minutes, depending on where you're at in the country. Fireworks expected perhaps, though, when Jerome Powell takes the podium. What's your kind of preview here and assessment of where we might go over the next couple hours?
Yeah, I think obviously if you look at the probabilities, there is expected to be a pause in this meeting and then a resumption at the very least, broader than 50% resumption of cutting rates in June. So if we look at the context, just first off, relative to inflation, the federal funds rate at around 437 basis points right now is about 130 basis points above the core inflation rate. So we're already pretty restrictive right now, and I think that's essentially what the Fed is going to allude to. And then also you have to consider the elements behind fiscal policy. I know the Fed is not in the business of dealing with fiscal policy, which includes tax and spending and sort of international trade policies like tariffs. But with the Fed itself, alluding to last meeting that there are still some inflation risks, maybe the markets will appreciate now sort of a pivot towards language on challenges to growth versus inflation. So I think right now the markets are probably looking for some relief considering what's going on in the backdrop with a lot of these tech names, the mega cap names like NVDA and such that have fallen earlier this week. But if the Fed alludes to that maybe the risks going forward are not necessarily inflation risks, but are balanced towards, challenges to economic growth, and that comes from the fiscal uncertainty that we're facing right now, that actually might appear a little bit more dovish. And if that's the case, maybe the markets pick up on that and start moving back to the upside as a result.
So, George, I'm curious. I know that the Fed acts, sort of independently from the administration, but given the fact that what's been in the headline right now is so much is like the relationships we have with China and the exports and the various tariffs and all the unknowns relating to the administration. I'm sure he'll be asked about this. I don't know if he'll answer it, but I'm just curious your thoughts here on how a new administration really can shape a lot of the tone from Jerome Powell.
Yeah, that's the thing. And that's, I think, what everyone's going to be focusing on, really. I think it comes down to whether or not Jerome Powell reflects and gives us some insights on what's happening from a fiscal policy standpoint, because again, the Fed is independent and they don't necessarily deal with fiscal policy decision making, but they will of course adapt monetary policy after what's happening in Washington, particularly the fiscal stance, also the tariff stance. If we're cutting back on fiscal spending and there's tariffs, that might allude to some challenges going forward in terms of visibility for economic growth. And so I think, again, I think Jerome Powell will probably will remain balanced in that regard to really focus on monetary policy. But, the press conference today, not the statement, but the press will be extremely important. So we may end up seeing an initial reaction in the markets because of the statement, but that can change quite drastically in the press conference, particularly this one, because we're in the midst now of a really, Wild West kind of, environment in Washington.
George, real quick, 30 seconds or so, kind of final thought. If someone was looking to, I know there's not a lot of time left, but, speculate on this and maybe they share some of your sentiment. Where does one look? I mean, stocks are so busy right now with this AI stuff and everything. Is the Treasury market or FX maybe a cleaner reflection of maybe how this reaction might be?
Yeah, I think so. I mean, look, if you look at two-year yields right now, that just using the bond market, around 420 basis points or 4.2%. The two-year Treasury is implying that we will see a cut this year. At the very least 25 basis points, which is expected in June. But, irrespective of that, the bond market right now, at least on the 10-year Treasuries yield, around 4.5% is right at the midpoint of where it really has been in the past 6 months or so, between 420 and 480. So with that said, look for the 10-year yields to make some adjustments, in all yields for that matter, based upon not just, again, the statement, but the press conference is where we'll probably see the majority of volatility going into the close.
Exactly what Alex was saying to start the show, George. So you two are in agreement, but we'll leave it there. Appreciate it. That'll do it for Next Gen Investing. Coming up next, we'll get the Fed, of course, and the watch list.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
Morning Movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning Movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network. Good afternoon. Welcome to a special edition of the Watch List. It's Fed Day. I'm Nicole Petalides. It's 2 p.m. Eastern Time. We are live at the New York Stock Exchange where the Fed decision is imminent, and we will have all the live reaction on the Fed announcement. We'll have a variety of experts for you. Of course, our Fed head, Fed Chair Jay Powell will be speaking. All of this as the market just sold off within the last half hour or so on a few headlines. In the meantime, we wait on this Fed announcement. Not likely to see any cuts at this time. Much more likely to see those in the summer, maybe in June and December, based on the Fed Watch tool. Right now, the Dow's been down just over 77 points, and the S&P's down 32. I'm hearing from the floor and waiting for confirmation. Unchanged. That would be exactly what we would expect at this time. And there you have it. The Dow is down 129 points, down 0.25%. The S&P down more than 0.5%, the Nasdaq down 0.75%, and the Russell down again at 22.85. Oil and gold both to the downside. Gold is down $2, 27.65, confirming unchanged, just as we said moments ago, unchanged. So we will hear more from the language later. There will be no dot plot, but he will have to contend with questions on tariffs, DeepSeek, and the rescinding of what was to be some freeze in Washington, what happens there. And so this is how we're seeing right now the market reaction. I am watching for the 10-year, it went to 459. It was at 456 moments ago. So you're not seeing too much of a knee-jerk reaction just yet. And that is our big picture. And the VIX right now at 1768. So has ticked up a little bit, has a green arrow, it's up 127. We bring in Kevin Green, Senior Markets Correspondent here on Schwab Network, to have this conversation. Breaking news, unchanged from the Federal Open Market Committee. They have a lot to balance in their minds. It was very unlikely to see a move today, though many are still thinking about the 2 cuts in the dot plot. We're still thinking about 2 cuts for 2025. More likely to see those in maybe June and December, or even March, maybe. Some of your thoughts on what's going on here right now.
Yeah, well, we did actually see a little bit of a sell-off when it came to the S&P 500. It dropped around 20 points here, Nicole. I think it's because the Fed statement does not include language that inflation has made progress towards 2%. And that has been something that the market has been hanging their hat on. So does that also indicate that maybe inflation is going to remain sticky, or do they believe it's going to remain sticky? And is that going to be a higher for longer narrative? And I think that coincides with maybe a little bit of a pop in rates, dollar trying to push back to the upside here. But they do believe that there is still more balanced risk compared to the inflation as well as to the labor market. And they did have a vote that was unanimous when it came to the decision of holding rates where they're at right now. So overall, it seems like it's kind of the same statement that we've seen over the last couple of Fed meetings outside of that language about progress for inflation. So I'm sure that Powell will be asked about that. And if he does kind of come back and say, look, we've seen some pressures over the last couple of months, especially with the most recent CPI print, and we are going to monitor the situation until the data actually says otherwise, that we are seeing inflation crack. Powell also, this is a little nugget, he actually does, for the most part, signals the Fed's PCE target that's going to be released on Friday. He already releases his forecast out there. So kind of keep your eye out on that, because we do have a fair amount of estimates there. And if he gives that target that's going to be a little bit hotter than what the street's expecting right now, that could create a little bit more volatility in the markets. But we have to still wait for the commentary. Knee-jerk reaction for right now. Vol's a little bit elevated, but once again, nothing that stands out outside of the removal of the moving towards the 2% target for inflation.
So yeah, they've made progress toward the 2% objective as it had in the December statement, like you said, saying inflation remains somewhat elevated and that the labor market conditions remain solid. It's very interesting because right now there's a lot of uncertainty pertaining to tariffs, uncertainty pertaining to the potential freeze of federal programs that was put out by the White House. It was since rescinded, but there will be more clarity on that. I mean, I don't think the White House gave up on the idea. I think they just rescinded it so they could be more clear on which programs they're trying to put a freeze on. In the meantime, the markets may be, throughout this 1 hour could be volatile as we get more later in the press conference. So some final thoughts, Kevin?
Yeah, I agree with you, and I'm sure he's going to be asked that question when it comes to the fiscal spending policy, as well as just the developments over the last 24 hours when it comes to these grant programs. One thing for the bulls, though, here, Nicole, the Atlanta Fed GDP Now forecast actually did revise aggressively to the downside this morning here. It did actually come in at around 2.3%. Market was looking for 3.2%, and this is actually after a press release or a release of the Advanced Economic Indicators report that saw a substantial drop in exports for the month of December. And so if that also kind of, leads way to maybe the economy slowing down or maybe cooling a little bit, then maybe we could kind of factor in cuts moving forward. But the market's still pricing in 2 cuts for this year. The next one that's being priced in is in June, and I think that's sitting at around 78%. That was before the release of these minutes, though, or release of this data, though.
All right, thank you so much. I'm going to be talking about the statement, too, on labor. Kevin Green, thank you so much. I want to get a look at the bigger picture. Glad to have with me right now Fran Rodoloso, head of fixed income ETF portfolio management over at Van Eck. Thank you for being here. What we're seeing, we did see the market sort of quickly sell off and make its way back. There has been talk about, moving towards the 2%, but that in fact inflation remains somewhat elevated. They also talk about the labor market conditions remaining solid, and that's different. The reference point is different because they had said in the prior that conditions have eased. So they are making some changes when it comes to the labor comment.
Yeah, it seems as if even with the first 100 basis points of easing we saw in the 3 meetings last year, those were somewhat hawkish cuts, at least relative to market expectations. And it seems the Fed wants to somehow, look, I think 100% expectation that they were going to be on pause today, but added a little more hawkishness into that pause. No one thinks they're about to hike, but I also think this leaves them flexibility for, maybe more dovish language if they need in future meetings as well. But very cautious. What we were also looking for is maybe some kind of comment on quantitative tightening, whether or not they were going to put that off until March, like whether they might start reducing the roll-offs, but that was not accelerated. So again, I think they're leaving themselves a lot of flexibility, and probably justifiably, because as we see today, more volatility is probably likely to come out of the White House than out of the Fed, and they may need to be prepared to react to rapidly changing conditions.
They did say the Fed is attentive to risks to both sides of its dual mandate, the balance sheet runoff to continue at the previous pace. That's your point on that, so they'll keep rolling that off. The vote in favor of the policy was unanimous, so no one said, hey, let's cut today or make any other moves today than the one we're presenting. Economic activity has continued to expand at a solid pace. Things are looking pretty good. I guess they don't want to mess with the recipe at this moment. There was a time when they cut, they were concerned about the labor market. And even in the last round, they talked about a labor market easing. In this round, talking about it being solid. Labor market doesn't seem to be a worry, but at the same time, what about if there's deportations? What about the immigration?
Yeah, I mean, this may leave, again, the Fed's leaving themselves room, maybe, if there should be increased tightness in the labor market. I mean, this will take a while to play out. I mean, I think the higher deportation numbers that we're looking at are probably over a several-year period, although the net effect will definitely start being felt straight away, and fewer people coming into the country at the same time. So again, I think that's cause for maybe not being quite as constructive on the labor market easing, given that uncertainty. I think that the key factor here is, as you said, we've been doing well. I mean, growth expectations have been met or exceeded consistently, really throughout the Fed hiking cycle and the early parts of the less aggressive Fed easing cycle. And that is why, we've seen yield curve normalization, I think more so than necessarily major inflation worries or even quite yet, although we think there will be, we will be paying for concerns about U.S. debt fundamentals at some point. Basically, the market is still pretty optimistic on growth, and so is the Fed.
At the same time, you have the Trump administration rescind the freeze on federal programs. I mean, it was my understanding they were really just looking at certain programs, and people started to take it very broad-based, and that was not what they meant. They didn't mean food stamps, they didn't mean Medicare and things like that. So I guess rescinding that, but it could mean you have federal workers that are going to be unemployed if they get tight on that. That could contribute, and that could be part of the dual mandate that they said that they are, attentive to the risks on both.
I think one way or another, there'll be a reduction in the federal workforce. So, rescinding this particular freeze or not, I mean, they've already started eliminating some offices and, this, call it a buyout or 8-month work from home plan. They have the offer they had extended yesterday. So, yeah, I mean, that could provide some relief, I suppose, to the labor situation. But I think the problem with the freeze is more likely just the lack of detail. And so if certain, offices that would facilitate payments weren't able to operate, whether or not the exact programs were cut off, it was just a lack of clarity. Maybe we'll see this return with more clarity at some point in the near future.
So in the meantime, the 10-year bond yield, folks, is at 4.58% right now. So the yield just ticked a little bit higher than where it was at 2 o'clock at 4.56. What are you telling folks for investing these days? I know you have a few ETFs that you could tell us about here. What are maybe some good ideas for folks for 2025, especially since now we've gotten in this breaking news? Yeah, we've been sticking with what's been working in terms of our discussions with our clients, and we have promoted the notion of higher for longer, which, the 100 basis points of cuts notwithstanding, I think versus expectations, we are higher for longer. We thought last year that we would see a curve steepening should the Fed start cutting, and we think that continues. Right. And so that means, floating rate securities staying closer to the front end, taking some moderate credit risk, more in the investment grade space, are good ways still to earn attractive yield. So investment grade floating rate notes above 5% yield, not going down into the loan market or high yield market, and still getting 100 basis points over Fed funds or cash. Or we talked. I've mentioned to you our collateralized loan obligation ETFs. There are a lot of those in the market today. We have an interesting one that covers the whole investment grade universe in that space. That's yields closer to 6% in terms of like the 30-day SEC yield on our CLOI ETF. Yeah, that's CLOI. Yeah, so and the other one was FLTR. FLTR, right? Is the investment grade floating rate note. Yeah. I mean, these are just things we like. They're up in quality versus similarly yielding options out there in the market, and they're virtually no interest rate duration. And while with all the uncertainty out there, duration can be an opportunity, but it's also a risk. We don't see a need to rush out the curve just yet. You also have CLOB. We do. That is in the mezzanine space in CLOs, so it doesn't invest in the AAA collateralized loan obligations, but still high quality, AA down to BB. So it's a yieldier option, closer to 7% current, SEC yield than 6% for a CLOI. But should credit spreads start moving wider significantly, the higher up in quality is where investors will probably want to be. You also said it's not likely to see short rates go significantly lower without seeing probably a recession of risk or some other significant event. Yeah, we don't see we don't see the Fed going to aggressive cuts unless credit spreads are a lot wider. Good to see you, Fran. Thank
Great
you
to
so
see you,
much for
Nicole.
being here and telling us about some of the funds and, of course, handling the breaking news here. And that's Fran Rodiloso of Van Eck. Thank you very much for being here. Right now, the Dow's down 213 points, so we are seeing some accelerated selling. You have the S&P down as well. We'll continue to follow the breaking news where the Fed leaves rates unchanged, said that they are moving closer with inflation towards the 2% target. At 2:30, we'll bring you Jay Powell's press conference. That will be live right here. So keep it right here on Schwab Network. We'll continue our evaluation of the markets and the language. We'll be right back.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome to Market Overtime on the Schwab Network.
Quality focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
Welcome back to the Watch List. I'm Nicole Pedalidi. We're in breaking news, though. Just heard from the Federal Open Market Committee. We're live on the floor of the New York Stock Exchange. We've seen some selling on the heels of the language. We'll have the Fed's press conference at 2:30. The Fed has left rates unchanged as anticipated, but there's a lot to follow throughout this hour. Keep it right here for more on that decision and more of the implications it could have on your portfolio. Here to have this conversation with me, Craig Warnemont is with me, and so I'm speaking here with Craig Warnemont in a moment as we take a look, and he is going to speak with us. All right, we continue to follow the markets. Breaking news mode, Fed Day, and right now we are seeing that we did see somewhat of a sell-off on the heels of the Federal Open Market Committee's decision on unchanged rates, but also within the language of inflation moving towards the 2% goal. But there's so much to unravel here. I'm ready to speak with Craig Warnemont of Venture Visionary Partners to break down some of his thoughts. I mean, you were actually saying that your forecast for the Fed does not necessarily include 2 cuts this year. What did you make of what we've heard thus far?
Sure. So heading into the announcement today, there was 99.5% probability of no change, and no change is what we got. A lot of times my clients call and ask if everybody was expecting that, why is the market down so much? And I think that the Fed comments in December are probably the part that is scaring people, because that was the first time the Fed started to tiptoe away from 2% as a target and acknowledge 2.5%. We've been thinking since the second half half of last year that the Fed would eventually try to artfully describe a way to get to 3% instead of 2%. 3% is actually closer to the long run average for historical inflation in the U.S., and that they were just going to try to march it up there without rocking too many boats. And so, again, today, with removing that line from the statement, the 2% line, that is making progress towards the 2% inflation line, that's probably what is sending the markets lower today.
Right, understood. Look, we already saw 100 basis points when it comes to the cuts. We were just showing them back in 2024, September, November, and December. If they were to do their cut, right, when do you think that first cut could come?
Well, there's so many bits of news and noise that they have to sort out here in the near term with the change in administration. I'm not saying the change in administration is a bad thing. It's a different communication style, and it's a different policy agenda. So things like deportation, everybody asks, what will that do to the labor market? And then you talk about things like improvements in AI-driven productivity gains that might help offset some of the decreased labor market. So there are all kinds of things that they're going to have to take into consideration if they preemptively act and tariff increase doesn't transpire, doesn't result in higher prices. Then those who have already called for rate hikes would look pretty silly. On the flip side, though, if they're counting on inflation to continue to make progress and go down, and there's pressure on the labor market and it stays sticky, or because of home insurance and auto insurance, which were a big piece that kept inflation from dropping towards their goal last year, remain a problem this year after the wildfires in California that give insurance companies a valid reason for hiking rates again this year. If those items stay hotter than expected, keeping inflation a little bit high, they're not going to be in a position to cut either. So it would not surprise us if they sit on their hands the entire first half of the year, no changes at all, and that they try to use the pulpit, the speeches, as a way to either reassure investors on down days, don't worry, we've got your back, we're watching everything, we'll be ready to act, or if the market starts to get too ebullient, that they would use the bully pulpit to jawbone investors to make sure that they aren't getting too confident about those rate cuts coming. So we expect a lot of talk and not much action in 2025 from the Fed. Any rate cuts probably occur in the second half.
Okay, understood. So since we're in this wait and see mode when it comes to the Fed, what do you tell folks who have money sitting on the sidelines or who have already made some money? Obviously, if you made some money, you always take some profit. So let's talk more about what's the investment thesis for 2025, particularly for the first half. If you're not expecting moves from the Fed, what are you telling folks to do to put their cash to work?
Sure. On the putting cash to work side, people should feel fairly confident in locking in some of the yields that are available today. You can get 6% from U.S. government agencies right now. I'm sure that paper is callable in the short term, but those are pretty good yields from a safe issuer when you're talking about Federal Home Loan Bank, Fed Farm Credit Agency. So there are a lot of good options to lock in interest rates out there. The prior guest was given some ETF examples. For those that prefer individual securities, though, like the agency bonds, you can also find high quality issuers that issued what's called fixed to float securities in the last several years, where the fixed rates could be 6.5, 6.75, with the option that it converts to floating in the next few years. So if you're afraid that interest rates go higher because inflation steps up, that conversion to floating rate helps you. If you think interest rates are going lower, you're locking in an above market rate at, like I said, 6.5, 6.75 for the next couple of years until it gets called away. So there are a lot of options for investors who want to lock in income right now. For stock investors, they need to remain focused on the long term, because short-term changes in Fed policy, or really short-term no changes in Fed policy, shouldn't really change the expectation for a growing, innovative company to be able to deliver earnings growth. So focus on quality, focus on companies that have been winning, and you'll be fine in the long term in the stock market.
Yeah, so you're saying go for it. It sounds like
there'll be dips along the way. Like nothing goes in a straight line. I'm sure there'll be several dips along the way, and use those to your advantage. Accumulate on the dips.
Craig Warnemont, Venture Visionary Partners. Thank you, Craig.
Thank you so much, Nicole.
Coming up next, Jerome Powell's opening statements. We'll be standing by. We want to hear what our Fed chair has to say about today's rate decision, the conversation that they had there in the Federal Open Market Committee. That conversation provided a unanimous vote today. Watch this. We'll be right back.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the Watch List. I'm Nicole Petalides. A final look at what we're waiting for from Jay Powell's press conference, the markets. Let's bring in George Sillis. We've been breaking down the language, breaking down the market moves. We have seen selling throughout this half hour. George, what stands out to you?
Well, I mean, I'm looking at the reaction in the markets, seeing a little pickup in rates on the 10-year treasuries, but also on the 2-year treasuries, about 5 basis points. So maybe looking across the board, there's some additional weakness in the markets, particularly the interest rate sensitive areas of the market, like the Russell 2000, which is actually the worst performer at the very least right now in terms of the major indices, not too far off the S&P 500. So right now, you know, this essentially, you know, whether or not, you know, this is a dovish pause, I think is really what the markets were looking at. But if you look at the way the rates are backing up to the, or moving back to the upside just slightly, that this pause was a little bit more hawkish in nature, at the very least so far. So I think, you know, we'll probably see additional volatility nonetheless, as of course Jay Powell has his Q&A and makes his statement coming up in the next few minutes.
Yeah, I mean, look, I mean, now we're hearing higher for longer. That language still sort of stays on folks for here for Wall Street. For example, we just spoke to Craig, and I'm actually quoting him because he said, look, we're likely to have rates stay around. He didn't actually expect to cut until even the back half. You know, so it just didn't seem like there's a rush to cut. And so you can continue to invest in your bonds or your money market funds or things like that. Yeah. What do you think about that?
Well, I think so. I think that makes sense, particularly in the cyclical areas of the economy and the markets, because the economy is still moving, you know, quite robustly to the upside. We're still above 2.5% on GDP. This is based upon, you know, looking at Q3 and, of course, what is expected to be in Q4 of this particular year. So with that said, I think there's going to be a lot of volatility just because of the context the market is in right now with NVIDIA and all of the other technology names. Then you add in all of the fiscal and policy uncertainty coming out of Washington. So that is creating already implied volatility challenges in the market. And so I think the Fed doesn't want to, you know, pour cold water on any movement to the upside in the markets. They don't necessarily want to create this optimistic scenario that they're going to be cutting rates because there's still the inflation problem which the Fed has alluded to. They say that the inflation risks still remain elevated, but at the same time, I think the risks of a rate hike are off the table because right now, the federal funds rate is still relatively restrictive compared to trailing inflation numbers at around 2.9%. If you just use the federal funds rate at the level they paused at, it's about 130 basis points above inflation. So that's still restrictive, and that's still above their long-term neutral rate, which is somewhere between 75 and 100 basis points.
Yeah, we are waiting to have Jay Powell come out to the podium. In the meantime, we've already seen 100 basis points in cuts. And so while maybe a savings fund or a money market fund, those have been getting a slightly smaller, your yields that you're paying out there. But you didn't necessarily see folks know, look, my mortgage rate's still pretty high. And other, car loans haven't downshifted much.
Yep. Yeah, they haven't. And so I think this will be an interesting one because I think the Fed may mention something about the housing market, in particular because the construction, or if you will, residential construction employment markets and manufacturing markets are really strong barometers of the health of the labor market. So I'm sure they'll talk about the housing, and there'll be some questions perhaps in that regard. I'm sure there'll be some statement on immigration. And then again, I'm sure a lot of the questions or in the Q&A will be around what Powell is determining to be the impact of any, tariffs and what's going on with tax policy in Washington. So this will be a tricky one, to be honest with you. But nonetheless, I think a rate hike is probably off the table. But now, whether or not this is more of a dovish pause,
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall and has made significant progress. The economy is strong, is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve. Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
3 questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated this demand to you?
I've had no contact.
Thank you.
Thanks.
Nick.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we really look at movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive, and for that reason, we're going to be focusing on seeing real progress on inflation, or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I'd say you look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Colby from the New York Times.
Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market. And we just chose to shorten that sentence. Again, I mean, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much, and I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do. This is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder, and meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know, and so you're just on hold, waiting to see what comes down. It's a very large economy, and policy is affected at the margin, but we're going to wait and see.
If I can follow up, the idea that you feel the economy, that policy is restrictive, suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you should hold?
We're looking. It's more the other. The way it works is, we are looking at the data to guide us in what we should do, and that's what we do. And right now, we feel like we're in a very good place. Policy is well positioned. The economy's in quite a good place, actually, as well. And what we do expect is to see further progress on inflation, and as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster, we could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy, and so we feel like we don't need to be in a hurry to make any adjustments.
Howard. Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes in answer to your first question, but to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available, and as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is governing.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. Just to follow up on Steve's question, what reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
As I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we.
You've said that the Fed is in wait-and-see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see there are alternative simulations. So that's what they do. There'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark, the policymakers to sort of think and understand about the uncertainties that surround this. So yes, the staff does that, and we're all well aware that that the range of possibilities is always broad, and not just now, but always. And it's hard to be open to just how broad the possibilities are for an economy. No one saw the pandemic coming, and it changed everything. So things happen, but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case, but you don't act until you see much more than we see now.
Katerina Saraiva, Bloomberg News. Last month you talked about a future rate cut as being pretty, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. We want to see, further progress on inflation. And, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And, we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and housing services, the way it's calculated for PCE. You see that coming down pretty steadily now, and that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, that then we seem to be set up for further progress. But being seen to set up for it is one thing, having it is another. So we're going to want to see further progress on inflation. Remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, I mean, how is that broadly, you said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. I mean, we look at, of course, a very broad range. So it starts with unemployment, with the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing. The ratio of vacancies to unemployed. We look at all those things, and you put your finger though on it's a low hiring environment. So if you have a job, it's all good, but if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a. Let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But I'd say we watch those things quite carefully. But nonetheless, overall, look at the aggregate data in the labor market. The labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half a year.
Edward.
Thank you. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. On employment, you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise." Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?
So what's happening is that the flows across the border have decreased very significantly, and there's every reason to expect that to continue. But job creation has come down a bit too. So if those two things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment. I know that tax money is not used here, but Elon Musk alleges that the Fed is, quote, absurdly overstaffed. We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
We run a very careful budget process. We're fully aware that we owe that to the public, and we believe we do that. I've got no further comment than that. Thanks.
Chris.
Chris Rugaber at Associated Press. President Trump has said he will lower inflation by reducing gas and energy costs. Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say, so I'll give you a mulligan.
Okay, thank you. Well, nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision?
Sure, I'd be glad to. So we considered this, really at length, and we did decide to withdraw from the NGFS. And really the reason is that the work that the NGFS does has broadened very significantly. Think about nature-related risks and biodiversity and things like that. In addition, the work of the NGFS is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times, and I think that the activities of the NGFS are not a good fit for the Fed, given our current mandate and authority. So, and I just think it was time to acknowledge that, this process dates back, thinking about it dates back a couple of years. I made the decision to bring this to the board, some months ago. The process just took time to get here, and this is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate. Other central banks have different mandates and belong to the NGFS. We have no criticism of them, but it just isn't. It's not right for the Fed.
Andrew.
Thanks. Andrew Ackerman with the Washington Post. I'm wondering if you could talk more about what further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. We're somewhat above that, as you know, and we want to see serial readings that suggest that we're making further progress on inflation. That's what we want to see, and consumers will pick that up, of course, in the things that they buy at the grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Yeah, you can't know with any precision, of course, as I like to say, that you know the neutral rate by its works. So I think at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria.
Victoria Guido with Politico. So as a general matter, when it comes to executive orders and OMB memos, do those always apply to the Fed, sometimes never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper than that or get into any deeper into this set of issues today.
Claire.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation and growth. If we see tariffs of the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive move? Thank you.
Sorry.
What sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of monetary policy on the basis of it?
Yeah, so first of all, things are a little different now. We've just come through a high inflation period, and you can argue that both ways. You can say that companies have figured out that they do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases, and so I don't know how that shakes out. Nonetheless, you're coming through a situation where we're not quite back to 2%, and that's just different. In addition, the trade, the kind of footprint of trade has changed a lot as trade is now spread around. It's not as concentrated in China as it was. There was a lot more manufacturing. It moved to Mexico and other places. So there are differences, and I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is, because we really don't know. And we didn't know, by the way, in 2018. We didn't really know. And, the range of possibilities very, very wide. We don't know what's going to be tariffed. We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer. Just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Courtney.
Thank you. Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. And then the second question is just, I wonder if the AI-prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
So, let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that rates do appear to be abundant. As always, we stand ready to take appropriate action to support that smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon.
Simon Urbanovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and you know, it's long rates that matter for housing. So, I don't think I think these higher rates are going to they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So, you know, we control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our, as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis, although we'd love to see that, of course, and we will.
And a separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
You know, I want to avoid commenting even indirectly on the conduct of tariffs. You know, it's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, you know, we found in 2018 there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but I think that did matter in 2018-19, and it's one of many things we'll be watching.
Matt.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look from a financial stability perspective at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things asset prices are. And yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. But we look at that. But we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective, and we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions with higher rates. So overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Victor. Hi, Chair Powell. I'm Richard Escobedo with CBS News. One question for you. This month's statement notes that unemployment is stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier, one is that there's a low hiring rate. And so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure. And in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs. And really, it's high inflation for the basics of life. It's not so much the inflation now, it's the price level, because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much slower population growth.
One more question. Some of the uncertainty around immigration policy, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see, there's nothing in the data yet on that, but you hear that kind of thing about construction, for example, and businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But again, I know you don't see that in the aggregate data yet, but yes, you hear it anecdotally.
Nick. Thank you, Chair Powell. Nicholas Jasinski from Barron's. The uncertainty is certainly a theme today.
I guess I'd say this, uncertainty is with us all the time. It is human nature, apparently, to underestimate how fat the tails are in a way. The possibility, we think of things in a normal distribution, and in the economy, it's not a normal distribution. The tails are very fat, meaning things can happen way out of your expectations. It's never not that way. I wouldn't, if you think about it, think about the first few months of the pandemic. That was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? That was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, and that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But So the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are, not for us to criticize or praise, really. Those are policies which people have been elected to implement. They're implementing them with a view to making a better economy. And so I don't think, I wouldn't call this out as one of those times. I wouldn't compare it to the global financial crisis or anything like that, given that we have actually a very good economy right now.
Evan Reiser with Market News International. Chair Powell, is a March cut still on the table? And then additionally, are you looking to see better than expected data on inflation to cut? Or are you looking for inflation data that roughly aligns with current forecasts?
So as I mentioned, the economy's strong, the labor market's solid, downside risks to the labor market appear to have abated, and we think disinflation continues on a slow and sometimes bumpy path. That tells me, and the other members of the committee, the broad sense of the committee actually is that we don't need to be in a hurry to adjust our policy stance. Your second question was?
Whether or not you need to see better than expected inflation data or just inflation data that roughly aligns with your current forecasts?
It's one of those things, we'll know it when we see it, but more the expectation is that we will make continued progress. And, that's what we want. We'll know it when we see it. It's going to have to be something that isn't just idiosyncratic. You're going to want to see, continued progress with housing services inflation. You're going to want to see inflation behaving in a way that builds confidence that we are really making progress. That's what it's going to be. And is that better than our expectations? We expect to see that. It's just a question of when.
Scott. Hi, Chair Powell. Scott Horsley from NPR. In your 5-year review, you said the 2% inflation target won't be on the table. Can you talk a little bit about why? Is that because you think that's the right target, or is it because you don't want to move the goalpost mid-game, or what's behind that?
I think that goal has served us well over a long period of time. It's also the sort of global standard. I think that if a central bank wanted to look at changing that, you wouldn't do it at a time when you're not meeting it anyway. I would not look at changing it anyway, but I certainly wouldn't look at it at a time when you're not meeting it. There's just no interest at all in changing it, if I'm being at all unclear. We're not going to change the inflation goal anytime soon.
And 5 years ago, if I can paraphrase what y'all decided, it was you're going to not raise interest rates preemptively to head off inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of unemployment with no sign of inflation. So why would you preemptively want to put people out of work in the absence of any kind of any evidence that suggested that this was not a sustainable level? It was a way of acknowledging how much humility we have about the starred variables, especially U-star, the natural rate of unemployment. So that was an insight. We'll discuss that again. That'll be one of the many things that we discuss, but I don't think that insight is wrong. We didn't, we said, what we said was that, at times when inflation persistently undershot 2%, we would likely allow inflation to run moderately above 2% for some time. That's what we said. That turned out not to be relevant to what actually happened. There was nothing moderate about the overshoot. It was an exogenous event. It was the pandemic, and it happened. And our framework permitted us to act quite vigorously, and we did once we decided that that's what we should do. The framework had really nothing to do with the decision to. We looked at the inflation as transitory, and right up to the point where the data turned against that. And when the data turned against that in late 21, we changed our view and we raised rates a lot. And here we are at 4.1% unemployment and inflation way down. but the framework was more irrelevant than anything else. That part of it was irrelevant. The rest of the framework worked just fine as we used it, as it supported what we did to bring inflation down.
Let's go to Mark for the last question.
Hello, Chairman Powell. Mark Hamrick with Bankrate. As you know, in the annual report from the Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now? And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
You know, so our role with Bitcoin really is to look at, with crypto, really is to look at the banks, and you know, we think it's, you know, banks are perfectly able to serve crypto customers as long as they understand and can manage the risks, and it's safe and sound. A good number of our banks that we regulate and supervise do that. You know, the threshold has been a little higher for banks engaging in crypto activities, and that's because they're so new, and you know, we don't want to make the mistake. If you're making a choice to conduct that activity inside a bank, which is inside the federal safety net with deposit insurance, then you want to be pretty sure that it's a safe and sound activity. So, you know, we're not against innovation, and we certainly don't want to take actions that would cause banks to, you know, to terminate customers who are perfectly legal just because of excess risk aversion, maybe related to regulation and supervision. So.
And with respect to households and their inclusion in the asset class?
You know, that's kind of it's not really our bailiwick. You want people to be knowledgeable about the financial engagements that they have, and that's why we have, you know, the securities laws that we have. It's why, you know, if you read a mutual fund prospectus or individual stock prospectus, you want households to have the chance to understand the risk that they're taking. And you know, I do think it would be helpful if there were a greater regulatory apparatus around crypto, and I think that's something Congress was working on quite a lot. We've actually spent a lot of time, you know, with members of Congress working together with them on various things, and I think that would be a very constructive thing for Congress to do. Thank you.
Accelerate your market knowledge and shift your perspective into full gear. Real-time example trades, a full hour of trading insights. I'm Tom White. I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network. Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Market on Close. Let's do some earnings prep. Tesla, usually a fun one. Extra fun, and Mr. Ross Gerber's here to talk about it, President and CEO at Gerber Kawasaki Wealth and Investment Management. Ross, how you feeling for this afternoon? What are we going to hear from the team?
You know, I'm not sure that we're going to see a big departure from what your expectations are for them. I'm sure they're going to reiterate, you know, cyber cab and robotics and sort of try to keep people focused on the future because they have nothing to give you in the current. So, you know, we're not expecting much with earnings. So hopefully, if they're good enough, the market will be okay with it. If they miss by a big number, that wouldn't be fun. But I think in general, Tesla wants you to focus on the future because the next year and a half look pretty stagnant to me.
I saw, I'm sure you did too, the video that Elon tweeted out or retweeted of the Teslas self-driving themselves out of the production line. I mean, that's pretty sweet stuff, is it not?
No, that's a gimmick. I mean,
I don't know. Everybody's talking AI. That's the best AI thing I've seen yet.
No, I mean, I've been using full self-driving for years, and basic driving, full self-driving does fine. Like, if you're just driving in a regular, normal environment, full self-driving works. Right. That's not the issue with full self-driving. The issue is all the other abnormal things that happen when you're driving that it's not able to handle. And so we call it, you know, they call it the battle of the nines, which is like the 1%. You know, 99.9% of everything is fine except for that 0.1 when that really matters, and then you run over somebody's dog. So, you know, this is what Tesla has to solve. It's between level 3 and level 4 autonomy, but it's not level 5, and I don't think they can get there without better hardware.
Where do you see the rubber hitting the road then, time-wise? I mean, is the market just completely irrational in your opinion right now, keeping it near $390? Is this thing going to have to get blasted if it's all hype and nothing new?
Well, I think the market is pricing in this future that they've been selling. So you've got a core business that's worth probably $175 to $200 a share, and now you've got, let's say, about $200 worth of what I would call premium based off the future of Tesla. And in the past, Tesla has delivered, maybe late, but they've delivered these products. So the cyber cab, I'm sure they'll deliver. But what the economics of that business are and whether or not that business makes sense for Tesla is still yet to be determined when Waymo is clearly dominating RoboCab at this point. They're all over LA, and I see them every day driving perfectly. And quite frankly, I'm jealous. And so, you know, compared to my full self-driving, which sucks compared to Waymo, it's kind of like at some point, why do we want to compete with that when we could sell EVs and we can sell charging and we can sell battery systems till we're blue in the face? I mean, Powerwalls, I could sell these all day long. After the fire and after everything I've been through, I can easily sell any Tesla product based off climate change. So this refocus of Tesla is not necessarily the panacea of profits that maybe the market is pricing in with 130 price earnings ratio, but we're not going to know this for several years. And so it's really whether the market will be patient enough to see this play out and when it will play out and whether or not these are good businesses long term.
Okay. Fair points. When you look at the company as a pure car model, though, does it also still get that premium of domination versus peers? Because even though their margins have gotten crunched, still like double General Motors, and it seems that gives them some breathing room to you know, have these other bets. Is that fair though? Like, is there a floor to this when they still are behemoth on autos?
100%, and that's where Tesla's strength is they still make the best cars on the road. The software is the best on the road. Nobody can compete with them. You know, the closest competitor now is Rivian, where their software has gotten a lot better, but they don't have anything like full self-driving. Rivian's making a lot of great vehicles, so they're seeing competitors and such, but when push comes to shove, you know, Tesla makes the best products in the world, and that's why people are buying them, because it's certainly not because of Elon. And so, you know, people hold their nose and they buy a Tesla because it's like still a great product. And I think if you sell EVs with Musk, and so that's really the issue is, you know, how can they expand sales when they have what I consider a negative marketing campaign where the CEO literally turns off the vast majority of its customers?
Well, again, that one is still a tough statistic to find because I imagine for every customer.
The sales are down. Any way you look at the numbers,
well, EV sales are down too. I know you don't know that the sales are down because they don't like Trump or Elon. I mean, you could argue that the Trump people are going to want to buy the cars. They're all getting rich off crypto.
Come on,
so.
Let's extrapolate out some reality here. Okay, this is a wonderful product. It was growing at 30% a year or more, and then all of a sudden it takes a big break. You think that's just.
Well, EVs, we've seen all auto sales slip.
No, auto sales have been good for all the EV companies. Look at all of them. They're all showing great numbers. So, BYD is going to be the biggest EV company in the world in 2025. That's a fact. And when you look at the emerging markets, I was just in Mexico City, everybody's buying BYDs. Teslas are way too expensive. And the idea that we're all going to be cruising around in gold cyber cabs anytime soon is kind of a false reality. So, at some point that'll happen, but I got to invest for the next couple of years. And if they don't focus on selling cars, they're not going to grow.
So how many Republicans have to buy a Cybertruck to offset each liberal not buying a sedan, right? Like, we could play this game. Who knows?
Well, we all know that the Republicans are not buying Cybertrucks.
I don't know. They're driving around Chicago all the time. I see them everywhere.
I actually see them among many of my liberal friends.
Well, that's what I'm saying, is that we need some stats here. Hey,
and I drive a Cybertruck too, but.
Right, okay. Well, that's kind of fine. Ross, the potential for them to change the tax credits, do you see that as actually happening, and do you buy this argument that it's going to benefit Tesla in some way?
Well, I hope it doesn't happen because I'm a big climate change person, and I've just been dealing with this personally with the Palisades fire, and climate change is the biggest risk to humanity by far. We're never going to get to Mars if climate change wipes us out in the next decade or two. So let's be real. Selling EVs is the most important thing we do, along with battery systems, to help, mitigate climate. And so if they get rid of this thing, it's going to hurt Tesla, and it's going to hurt all the EV players to the benefit of the oil players. We know the Republican Party supports the oil companies. Trump has made it perfectly clear that he wants to drill, drill, drill. And so this is really detrimental to the environment longer term. And so I really pray that they don't change this EV tax credit and continue to encourage people to buy EVs, because they're the best cars, A, and B, they have a much more positive impact on climate.
Okay. All right. Ross, always a fun chat. Thank you, sir.
Yeah, thanks.
Ross Gerber, President and CEO at Gerber Kawasaki Wealth and Investment Management. Let's look at some options flows, the technicals, and the market with Mr. Kevin Green coming up. We got the NASDAQ trying to flip positive. You got Bitcoin up now $3,300. We got bonds almost to even again. So it's looking like we're taking a bit of a turn to risk on.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
All right, let's get into the weeds here. Mr. Kevin Green joins me for a look at the session. NASDAQ trying to push positive here, KG. Seems like some of the indications are leaning a little bit more risk on than right when the event started today.
Yeah, you're seeing a little bit of a volatility crush in the market, and that's really what you want to see going into the close here, Oliver. Now, unfortunately, we had some other news that hit the semiconductor sector that kind of inched up vol a little bit more going into the Fed meeting. And actually, if you kind of look at the presser alone, along with the price action, it was probably actually one of the more measured press conferences that I've seen when it comes to equity prices. But now, obviously, we're looking at what is going to happen with volatility. So this chart here is showing today's price action, 3-minute increments here, and this is comparing the S&P 500 to the VIX minus the VIX futures contract. So this is really going to show you either a backwardation or a normalization within this curve. And really what you want to see is the spot VIX moving to the downside a lot faster than what the VIX futures is actually showing us. And if that is going to occur, that should be a net positive for the S&P 500. And if you kind of look at that chart, that's exactly what we've seen as the presser did end here, and now we're hitting a critical area. I mean, you and I have been talking offline, but if you're looking at 60.54 in the S&P 500 on an intraday basis, that's really a key area for us to try to break above in order for us to really try to have a melt up to the upside here. And that could be possible if we have a little bit more of a short covering rally when it comes to NVIDIA, maybe some of these other semiconductor names leading into a very big earnings report for Microsoft, Tesla, and Meta, then that's actually going to be net positive for us. So I actually have it highlighted on this chart, that yellow line. We want to close above that line on that 5-minute candle, and then we try to push above. There is a level at 60.60 to be mindful of, but if we kind of break through that on some pretty good volume, hopefully a good market on close buy order that comes in, I think you could actually see a pretty nice rip here. Any type of fade, I think, would be actually a little bit concerning. We want to be able to make a higher high relative to what we've seen in this breakdown on during the middle of the day.
How much do you think that we could move here with the giants lingering post-market? Meta, Microsoft, Tesla, is this a market that can find momentum without fresh information, or do you think that tomorrow will be the bigger move?
Well, tomorrow probably will be a bigger move just because we'll have.
Right, that's kind of what I'm thinking.
We're going to have the earnings that come out here. I think this is going to be technical in nature or mechanical in nature. So we had aggressive sell-off going into the close. Do you really want to be short these names going into the close, knowing that we have these earnings announcements? If you are an NVIDIA short, do you want to be short NVIDIA right now, knowing that you're going to have 3 of the bigger companies that purchase these GPUs talk about their CapEx spend and what their vision is moving forward? That's kind of the notion that I'm thinking about here. Yeah. If we get some buyers to kind of step in, purely mechanical, try to squeeze to the upside. I mean, you will have some pen risk sitting at 60.50. We definitely know that. 60.60 will be a little bit difficult here, but there was actually some positive, call activity that took place beyond that. Once you start getting to the 6100, 6120 level, there was actually some pretty decent positioning there too. Going to take a lot, but anything can happen, given the environment that we're in right now.
It seems like bears have a lot of work cut out for them. When you look at this chart, that we found support on the old downtrend line, that top panel, on the moving averages as well. That's what you pointed out to us yesterday. That was the follow through from the second half of Monday. The advanced decline, slowing, weakening a bit, but still elevated compared to where we were for basically, the last 3 weeks of last year and coming into this year. Your bottom panel, MACD momentum, it seems like still, like at least, 2 out of 3, 3 out of 4 things point to strength and point to trend higher.
The biggest thing I'm concerned about when it comes to this chart is actually that MACD, because it's starting to flatten out a little bit, and it does take some aggressive price action in order to really change direction of a trend when you're looking at that 12 EMA. And that 12 EMA is kind of trying to hinge a little bit lower, and that's what you don't want to see, because that will accelerate, and then you have this 12 below the 26 cross, and that's a bear cross. And throughout not only just looking at the last 3 months, you go back the last year and a half, those actually have been pretty decent signals that a sell-off might be occurring here. But if you're looking at the candle structure for today, we had the nice little hammer candle yesterday. We are still above the 50-day moving average. We technically have an inside candle today, meaning that our high and our low is within the range that we actually saw yesterday. So at the end of the day, you can kind of call this a little bit of a wash, give or take, if you're a bull or a bear. That doesn't really show you a true direction or a breakdown in price action right now. And we're still holding above the 50-day moving average, still holding above that channel line, previous resistance now turning into support area. So I still think that this is still bullish. We still have a gap to kind of fill to the upside. I think it's still bullish, but we definitely need to get some price action, more aggressive advances to the upside here over the next couple of trading sessions, because that MACD starts to flatten out and starts to hinge lower. It just seems like that's more, once that pressure gets on that indicator, it usually doesn't abate easily.
Okay. All right. Like to look here at the intraday and the longer term too. Very helpful. Thank you, Kevin Green. We'll see you in a little bit. Thank you, sir. All right, when we come back, we're going to talk some commodities with Dan Deming. We're going to take a look at crude oil, which had its own separate story earlier in the day, down below $73. Seems like most stories in the crude complex right now are bearish. Coming back, watching stocks, pulling back again.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Accelerate your market knowledge and shift your perspective into full gear. Real-time example trades, a full hour of trading insights. I'm Tom White. I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome to Market Overtime on the Schwab Network.
Quality focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in. We got crude oil down today, lowered to 72.80. Mr. Dan Deming joining us for a little chat about some of the other stuff. Maybe we'll come back to stocks because we're chopping around right now in equities. Dan, good to see you, sir.
Hey, likewise, Oliver. Yeah, chop is the key word today. We were definitely chopping around ahead of these earnings.
Yeah, it's not an easy day to trade. Hey, Dan, tell me about crude. It seems like every story right now generally kind of airs a little bit more bearish than it does bullish for crude prices.
Yeah, it seems to, Oliver, and I wouldn't be surprised to see crude slip back below 7 here in the next week or so, given the fact that we're coming off those recent highs, but the momentum to the downside does not appear to be slowing. And, you're looking at the builds this morning coming in higher than anticipated, as well as refinery runs below expectations. Now, next week, OPEC Plus is meeting, so that also could be a tone changer as far as price action from a global perspective. But it does appear that based on, hey, the downward revision to Atlanta Fed GDP, that was quite substantial. It's not getting talked about from 3.2 down to 2.3. So again, if there's any hint that the U.S. economy might flatten out or slow down a little bit more, it's still showing growth, but maybe slower growth, that would be a headwind for crude moving forward.
Okay. Right now, it seems like it's also one of the main policy initiatives of the new administration. So many things under the sun that were kind of bandied about as being major policy issues. It feels like energy right now, and crude particularly, is like ranking pretty high.
Yeah. Absolutely. Yeah. So, the focus is on the ability to generate and produce more crude and energy in general. So if that is going to be, a constant theme moving forward, you expect that at some point that will take hold, that we will see production continue to increase and new initiatives on the board. And if that's the case, then unless there's a big shift in growth from a global perspective, you would think that crude would face some pretty heavy resistance at these levels, given the fact that it does appear that supply will continue to increase moving forward.
Hey, let's talk about the dollar and bonds here a little bit, maybe a little crypto chat too as we look across some of the other assets. Dollar's been hanging in there. Seems like bond buyers also keeping yields from rising too far. So the fact dollar has been able to stay elevated maybe looks like there's some tariff stuff or some other policy maybe. It just doesn't seem like it's going to go down too far when other central banks are cutting rates.
Well, right now, yes. With the Fed on hold and other central banks cutting rates, that's certainly a dynamic that, as you pointed out, would be, in theory, a stronger point for the dollar, at least short term. But I think, Oliver, we ran up and tested the highs and broke above those highs, but now fallen back into the top end of the range. But there's still a lot of variables out there, a lot of unknowns as far as policy moving forward and what the impact is going to be on the dollar. I still think the dollar is range bound. To me, the risk to the downside are a little bit greater than the upside, as rates have moderated, at least on the back end of the curve. The short end of the curve really pretty much where we have been for the last several months. So if we do see a little bit more moderation and some lower rates on the back end of the curve, that would be a headwind for the dollar. And, looking at gold here looks poised to break the new all-time highs, Oliver. And Bitcoin, to me, I think Bitcoin's going to take out that 106, 138 level. I think that's the all-time closing high, and it doesn't feel like that's poised to make a new high in the next couple of days as well.
Gold and Bitcoin, think they could break out together?
I do. Yeah, I do. I think that, as we continue to see the evolution of the policy changes and some of the other dynamics, and again, the one thing that's underneath this storyline, will be a consistent theme throughout the administration, is the debt structure. And that, to me, is the biggest concern for the U.S. dollar moving forward. So as long as that continues to maintain, and unless we see a significant shift in the debt structure, I think gold and Bitcoin are going to be the viewed alternative stores of value that they're kind of structured to be.
Gold getting pretty close. 28. So I guess we did get above the October high. Yeah. They move at different paces, though. How do you, what does like the gold breakout trade look like compared to the Bitcoin breakout trade? And, how do those differ?
I think that, the fact that there are options available, gold for sure. And then, not Bitcoin, the market continues to evolve. But, one way to look at it and potentially participate and still have some risk mitigation on is, looking at call spreads in the futures markets based on the futures in the gold market. And, in Bitcoin now, the options markets are evolving as well. So there's some opportunities there to, again, design some type of structured exposure, but also have risk definition in place, which I think is key, given the fact that, particularly in Bitcoin, given the fact that it can move several percent in one day.
Spoken like a true Chicagoan there. A little shout out to our friends at the SIBO.
There you go.
Working on a few of those products. Thanks, Dan.
All right, Oliver.
Always like to check in. Thanks. When we come back, we're going to close out the market session with a big picture discussion. Still plenty of time for some action as we're looking for equities to try and close that gap with neutral. Right now we are down. NASDAQ was trying to do it, trying to lead the way, and then faded in the last 15 minutes. We got a good panel coming up. Mr. Mike Townsend joins us to talk some more policy, and Colin Martin's here to talk Fed and bonds. Don't miss it. We got 12 minutes left.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. All so you can trade brilliantly.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network. I'm Nicole Pedalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
All right, let's talk some policy. Let's talk some Fed. The two certainly overlapping, as Jerome Powell's first question out of the gate was about the president and their interaction. Mike Townsend joins me alongside Colin Martin, a great team for this discussion. Mike is the Managing Director in Legislative and Regulatory Affairs. Colin Martin, Director and Fixed Income Strategist. Good afternoon, guys. Mike, how'd you think Powell handled that question about the president?
Well, I think we've seen Powell handle these questions for a long time now, and I think we're going to see it at most every press conference going forward in the rest of the year. But, you know, he kept returning to the fact that we're here to watch the data, and we're going to watch the data and make our decisions based on the data. We're not going to worry about outside pressure. We're not going to worry about, the threats to our independence. We're just going to focus on the data. I think you're going to hear him say that over and over the course of this year.
Why do so many people seem to doubt that the veracity of that strategy and statement, Colin? It seems like they are watching the data and responding to it. They started hiking, they slowed down, they reversed, they started cutting, they slowed down the cuts to wait. Like, where's the cynicism around that?
I don't know, Oliver. We don't have cynicism here. When we look at the Fed, we think they're doing their best. And I think if you look at what we've seen over the past few years with what started as, an innocent rate hike cycle that soon, snowballed into a very aggressive rate hike cycle, and then when will they cut, by how much? It all stems down to the nature of this recovery and how funky things have been in this post-pandemic world, where a lot of the relationships that held, given such an aggressive Fed hike cycle, they didn't really come to fruition here. So we think they're doing their best. We think that, they're going to try to tune out all the noise. There was even a follow-up question, and Powell made it very clear that they're not listening to any other elected official, and they're literally just looking at the data. So they're going to keep doing that. They're going to look at growth. They're going to look at inflation. They're going to look at the labor market, and that's going to dictate their policy moves for the next few months.
Okay. Mike, there is, though, obviously going to be some fairly public pressure, it seems, to lower rates. If I were Powell, I feel like if I got that call from the president, I might just say, hey, I did lower rates and yields went up, dollar went up, so maybe just let me do my job.
Yeah, I think that's right. I think he would say that. And I think the reality is that there's just so many uncertainties with policy right now. Probably the biggest news of all the crazy things that have been going on over the last 9 days is that you still don't have anything really specific on tariffs, when they'll start, where they'll be, that sort of thing. So I think the market is certainly watching that. And I think the Fed is sort of in a place where they've got to wait and see how some of these policies sort themselves out, whether it's trade policy, immigration policy, down the road we got taxes and a debt ceiling fight. Now, all these things could impact economic growth. They could impact the jobs market. That's what the Fed is going to be keyed in on. And I think he would tell the president that, give me some specifics and let me see how they actually work and play out in reality. And we'll do what needs to be done at that time.
What about the economic discussion, Colin? It seemed like this was the most sort of neutral and to the point of data dependency. No one had answers. Powell's basically just saying the reporters did a good job, I think, highlighting a lot of the economic kind of competition of narrative, sticky inflation expectations, it's pretty strong economic numbers generally, but also obviously cracks in some of the employment measures here and there, and some survey measures about difficulty finding jobs, et cetera. What did you make of was there any bias anywhere in his economic understanding?
I'd say no. I didn't see any bias. He was very neutral, and he used the term he uses a lot, that the economy's in a good place right now. And I think there was a snap reaction in the markets if you looked at the statement, because we didn't get any updated projections this time around. All we had was the statement at 2 o'clock Eastern, and we saw yields rise because of the little shift where they shifted the discussion about inflation, and they acknowledged that it's no longer moving or progressing towards the Fed's 2% target, and it remains elevated. That's a factually accurate statement. I think if they kept in that it was progressing, people would look right through that. The fact of the matter is inflation is still too high right now. Powell mentioned that maybe it could trend a little bit lower, and we saw yields come down once he mentioned that housing could become a disinflationary force going forward. But other than that, things are okay. The labor market is solid, as the statement said. We got this little deterioration that started last year, and then it's since come down. And things are looking pretty good right now. So there's any number of outcomes that we can see given all the uncertainty around Trump's policies. Powell acknowledged that their teams are running all these scenarios, but as it stands in the here and now, things are looking okay.
Okay. Mike, what are you hearing? What are the whispers for the next big policy move? If he can't tamper with the Fed, and he's already started swiping the pen and on energy and oil-related stuff, immigration stuff, what comes next?
Well, Oliver, what you're seeing right now is some pushback, obviously. I mean, he's had a couple of things stayed by the courts. I think we're going to see a lot of court action in the coming weeks on some of these proposals. The other thing I'm watching, Oliver, is Congress is really struggling to figure out how to put some of these policies into place. It's going to take a while. The House Republicans had a retreat this past week, earlier this week. Trump spoke there, but they emerged from that retreat without a concrete plan on how to do things like debt ceiling and government funding, which has a mid-March deadline. I think that's reflective of how narrow the margins are on Capitol Hill. And not all Republicans are 100% aligned on everything. So I think some of these policy things are going to take longer than the president would like, and maybe longer than the markets would like to sort out.
Well, I think that's kind of what some of the coiners might be feeling right now, because their team's gonna have to spin up a report and submit it within like 3 to 6 months. So some of this stuff we got to wait on. Colin, how about inflation on Friday? We're not done for the week here, of course. That's a number that's supposed to show a somewhat significant rise.
Yeah, a modest rise. I think a modest rise from the previous month's number, from November's number, which was a good number. So I don't think it's expected to show a sharp spike, but on a year-over-year basis, it's still likely to show that it's elevated. And that's something that Powell highlighted in the press conference today, that the 12-month sum is something they're focusing on, and it's sort of flatlined both at a headline and core level. But that's going to be the main focus over the next few months. If we look at what the Fed's dual mandate is, I don't think they're worrying too much about the labor market. Obviously, they don't want it to weaken, but it doesn't look like that's happening right now. All eyes are going to be on inflation, and if it resumes its downward trend. Something that I've been reminding our clients about is how quickly things can move. And you alluded to this earlier in our discussion, Oliver, how we've kind of been whipsawed with the markets and the economic data. And while right now inflation is sticky, we're not convinced that it's going to just stay here indefinitely. We think there are some forces that could be in play that could bring it down gradually. Of course, the incoming policy proposals from Trump could throw a wrench in that. But when we're looking at the data now, we're not convinced that we'll see inflation, consistently stay above 3%, for example. We think over time it could gradually decline.
And to that point, market doesn't seem too worried about it right now. Bonds, a little change. We might just go unch on the 10-year into the bell here. Thank you very much, Mike Townsend and Colin Martin. Great discussion there. Thank you, guys. Bell in 30 seconds in earnings. Be right back.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Market on Close. Bell rang. NASDAQ got pretty close. So we did see a little bit of a push there, but ultimately a loss on the day for all of the major indexes. Pretty small, though, in considering the back and forth of the previous 2 days. This was not a terrible session, given the big headline event has the potential to move markets as much as anything else. Jerome Powell, Fed, talk of the economy, talk of inflation, talk of no need to cut too quickly, but also no whisper or even faint discussion, really, of having to tighten policy further. So the macros into the day basically unch. I'm pretty happy with that, because yesterday's Risk Radar was all about how bonds and dollar probably weren't going to move that much today, and they didn't. There was a little bit of a swing, a bit of a swoon, too, for Treasury prices, but they came back to even, and that helped firm up markets as a couple big tech winners were able to peek their head above the water. Alphabet barely got there with the 6 basis point advance, but Apple, once again, found buyers pretty readily alongside Netflix, which has also just been very reliable over the past year and post-earnings, too. This afternoon, we have Tesla. That's the car company run by Elon Musk, if you're not familiar, and Meta, That's the social media company and AI business run by Mr. Mark Zuckerberg. And we've got Microsoft, which is going to be a very fun one, given that company has chopped around a lot on the charts. Kevin Green and George Tillis. That's my team this afternoon. It's a good one. Our senior markets correspondents. KG, talk to me about the final moments of the session there. What'd you think? Anything notable?
Yeah, no, I mean, obviously we had that little bit of a fade at that 60.55 level, and that sell-off was actually kind of interesting because vol was not actually spiking at all. It seemed like a lot of long holders in stock were actually selling. So unfortunately, not the best day, but we do have earnings too.
Getting hit.
And yeah, so if you want to go over some of those numbers, we can because Microsoft's getting destroyed right now.
Ooh, Microsoft down to 420. Boy, that's not great. But it's also kind of within the recent realm that it's been in, between about 415 and 450. But obviously, this is going to hurt this afternoon. So